Hey folks, welcome you all to a new video. This is CA Ganesh Bharadwaj. So in this video, we are going to get started with the revision marathon for CMA Intermediate Paper 12 Management Accounting, right? So this is predominantly for students who are going to appear for the CMA Inter exams in June or December 2024, right? If you're planning to appear after that also, this marathon will definitely be useful for you guys, right? So before we get started, first, I wanted to give you guys an introduction regarding the coverage, the chapters that are going to get covered, and all these other information. Now, guys, first, this marathon is going to be in two parts. In part one, we will be covering three chapters: marginal costing, applications of marginal costing in short-term decision making, and transfer pricing. The three core decision making chapters will be covered. In part two, we'll be covering standard costing, forecasting and budgeting, divisional performance measurement, and ABC. Clear with this, guys? So these are the 7 chapters that we are going to cover, and the coverage is going to be, so it's going to be, from the first part, it gives a coverage of 30 marks, and in the second part, you have an overall coverage of 50 marks. So put together, this marathon is going to give you guys a coverage of how much? A coverage of 80 marks. Clear with this? To this extent, we are going to completely revise. Now guys, no sir, what about the other 3 chapters? Because in CMA Inter paper 12 we have 10 chapters. The other 3 chapters that are not covered in this marathon is chapter number 1, your introduction to management accounting, right? Then the second one is regarding responsibility accounting, which is again a theory chapter, and then finally you have something called as decision theory. These 3 chapters alone we are not covering in marathon. Apart from that, all other important chapters, core chapters, are getting covered in this particular revision marathon. Clear with this, guys? Fine. Now, one more thing I wanted to tell you guys. Of all these chapters, this chapter, marginal costing alone, we are taking the recording of the revision recording that we did for CA Inter, for a simple reason that the concepts were exactly the same. And the marginal costing chapter revision that we did for CA Inter, the recording was quite comprehensive and it was well received by the students also. Every single concept in that particular chapter gets revised, and this chapter alone, we are covering it for about 4 hours. Because as you all know, in paper 12 management accounting, the core of this entire subject is only marginal costing. Based on that only, there are different off routes that are being termed as different chapters. So you need to be fundamentally strong in marginal costing. So what we have actually done is, since our CA Inter revision recordings have come out really well and that are also equally applicable for your CMA Inter, that chapter alone in paper 12 revision we are taking and we are giving it to you. All other chapters are exclusively recorded for CMA Inter only. Are you clear with this? This is number 1. Number 2, in our regular batch recordings, I want to clarify this. Not even a single minute we are taking from CA Inter. Our regular batch recordings, every single chapter are exclusively done only for CMA Intermediate, because we don't mix the CA Inter recordings with CMA Inter recordings. No, only in revision we have for this chapter alone, that too we are taking and we are giving this CA Inter revision recordings for this chapter. But in our regular batch, because we have given you a commitment that we will be covering 100% of all the illustration questions that are present in our CMA Institute study note, or that is the study material. So we have exclusively recorded every single minute for CMA Inter only in our regular batch. Clear with this, guys? This is purely for the purpose of marathon. That too, for 1 chapter we are taking from CA Inter recording and we are giving it. Trust me, you will be getting a lot of clarity on this. And of course, the time you're watching the lectures, you will be able to revisit and recollect all the core concepts that will be helping you to step up your preparation in your CMA exams. Right, guys? This is one thing that I wanted to tell you. So in terms of coverage, it's going to be for about 80 marks. And in terms of the number of chapters, it's going to be 7 chapters. Out of this, only 1 chapter is going to be a common recording for CA Inter and your CMA Inter. Clear with this, guys? And one more thing, this chapter, marginal costing, is a common chapter for paper 8 cost accounting and paper 12 management accounting. So if you are a student, right, who is appearing for both the groups, Then, and if you've already watched our paper 8 marathon, in that the marginal costing, if you have watched, you need not watch it once again because it is the same. So technically speaking, this marginal costing chapter has been repeated twice, one in paper 8 and once again in paper 12. Clear over this? So that's the reason why I wanted to clarify that also. Now guys, there is one common question that generally students ask. Sir, is this revision marathon enough for me to go and write the exam and score well? First of all, as the name suggests, this is a revision marathon. This is not actually, we will not be starting everything from the scratch. So the prerequisite here is, right, you should have definitely covered the subject once. Now, it is not necessary that you should have watched my lectures only, then you can attend this revision marathon. No, you could have either watched my lectures, or maybe you could have watched some other faculty's lectures, or you could have also prepared by yourself, self-study, right? Either which case, the prerequisite is, if you have prepared the subject once and then you are watching it, you will be able to actually recollect all the core important points that are being covered in this particular revision marathon, which will be helpful for you to step up your preparation. Clear with this, guys? So these are certain things that I wanted to really clarify in our before we get started with this revision marathon. And let me be very clear one more time. In our regular batch, it is exclusively being recorded completely for CMA Inter students, right? So it is not any common recordings of CA Inter that are present here. Exclusively, we record separately for CA Inter and for CMA Inter separately only. So that is how it's being done. For the purpose of marathon alone, this particular chapter we have just taken because the syllabus wise, in terms of concept coverage, it is the same. And of course, it has been very comprehensive in terms of coverage as well. Clear with this, guys? So on that note, let us get started with the revision of paper 12 management accounting. Hey folks, welcome you all to a new session. This is CA Ganesh Bharadwaj, and now we are in the day 2 or the part 2 of this costing revision series. Now in this part 2, we are going to learn 2 chapters. We are going to basically revise 2 chapters. One is marginal costing, the other one is process costing. These 2 are supposedly the most important chapters, or 2 of the most important chapters in our entire syllabus, costing syllabus. And out of this, marginal costing is slightly the biggest chapter of all. So that's why I am starting off this day with marginal costing, so that let's finish it off properly and then we'll move on to the next one. Clear? So that is going to be the agenda for this part 2 of this costing revision series. Now this particular part 2 itself is going to contribute somewhere around 20 to 25 marks in your exams, right? Now the most important part that we are going to do here is as I told you guys earlier in the day 1 as well, marginal costing is the biggest of all chapters in our regular batch. I think about 25 hours approximately, if I'm not wrong. So here in this revision batch, obviously we can't cover all those, the entire number of sums that we did and all in our regular batch, and of course we can't completely do all the concepts. But yes, I have designed this particular revision module in such a way that we are going to touch upon all the important concepts. Predominantly all the concepts will be covered in this particular chapter, right? So the coverage will be as follows. I have just branched this chapter into 3. The first one is the basics, right? And then we have the cost volume profit analysis. I will tell you what all fits into this category. And then finally we have a particular segment called as absorption costing versus marginal costing. So I have just classified this chapter into 3 for the purpose of revision, so that it will be easy for us to recapitulate the entire discussion, right? Clear with this? Fine. So in this CVP analysis, right? CVP stands for cost volume profit analysis. It's another name for marginal costing. So we will be learning about the concepts of contribution, PV ratio, break-even point, cash break-even point, margin of safety, the CVP pairs, or as I call it, CVP jodis, right? Or the CVP couples, whatever it is. Then the break-even chart, the profit volume chart, sales mix, merger of plants, sensitivity analysis, indifference point, shutdown point, and key factor analysis, that's your limiting factor analysis. So we will be touching upon all these areas, and of course we will also be doing some numerical problems. This is what I've planned, and this will be done in such a way that it's going to be a very effective revision, because as of now I've not done a revision, or my revision video on marginal costing is not there anywhere on YouTube. So I thought, let me give a very holistic coverage of this entire chapter, despite the fact that it's going to be a revision, but let's revise almost the entire chapter. This is going to be the objective. So my humble request to you guys is, please participate then and there, use the chat box and just participate. It's going to enhance your learning experience for sure. Catch up running notes, and for those who are going to watch this later on a recorded mode, right, you also participate as if I'm standing in front of you and doing this revision, so that it will definitely enhance your learning experience. Clear with this, guys, right? And trust me, this revision is definitely going to step up your preparation with respect to this particular chapters that we're going to do today for sure. Like that, to that extent, I can definitely give you a commitment. Now, shall we get started, guys? Shall we get started? Right? Fine. Now, this chapter, marginal costing. First, let us get started with the basics. And for the purpose of getting into the basics of this chapter, let me take a numerical example. Now, let us say that the selling price is rupees 10 per unit. The variable cost is rupees 6 per unit. The fixed cost is rupees 10,000, right, in total. And the sales volume, let us say is 6,000 units. Let us say is 6,000 units, right? Now, with this, let us try to prepare a marginal costing income statement, right? Let us revise what is the concept of PV ratio, a concept called as break-even point, a concept called as margin of safety, and of course, we will also try to calculate the profit. These are the 5 things that we are going to see using this particular example. By the way, before you start any chapter, you should know what is the objective that particular chapter is going to help us achieve. This chapter completely revolves around the objective of decision making, which means this chapter needs to be looked at from the perspective of variable cost and fixed cost. So in this chapter, the cost classification will be from the perspective of variable cost and fixed cost. Clear with this, guys? Right. And there is only one concept in this entire chapter that deals with the objective of stock valuation and profit computation. That is the segment C of this particular chapter, which is absorption costing versus marginal costing. That is the only segment in this chapter that deals with stock valuation and profit computation. What it is, I will be doing it. I will walk you through at the time when we are entering into the segment C. But till then, predominantly about 95% of this chapter, all the other concepts of this chapter revolves around the concept of division making, wherein the cost classification will be strictly from the perspective of fixed cost and variable cost. Clear with this, guys? Now, how does the marginal costing income statement looks like? So the first one is the marginal costing income statement, right? So the marginal costing income statement goes as follows. First, you'll be having sales minus variable cost, gives you something called as contribution, minus fixed costs, finally gives you something called as profit. Now, we all know that variable cost makes sense only when it is represented on a per unit level, whereas fixed cost makes sense only when it is represented in total. Why? Because that is the cost behavior pattern of variable and fixed cost. Variable cost, an example would be your material cost, correct? So only if I produce the next unit, this variable cost will be incurred, whereas that is not the case with fixed cost. An example of fixed cost could be your factory rent, right? So in your fixed cost, irrespective of your output level, this 10,000 rupees will always be incurred. You cannot do anything about it. Clear with this, guys? Clear with this, guys? So marginal costing income statement says that, it is better if you present your income statement as sales minus variable cost, that gives you something called as contribution, minus fixed cost, that gives you something called as profit. Sir, why, sir? Rather, I could say sales minus total cost. When I say total cost, it's variable plus fixed, directly gives me profit. Why are you having one speed breaker in between called as contribution, and from there once again you're reducing fixed cost and arriving at a profit? This manner of presentation will enhance your level of decision making. Sir, how? Fine. First, let me just walk you through the statement, and once we are through with this, we will be having a lot of clarity as to how this helps us in our decision making objective. Now, first, guys, now in this case, every time I sell a unit, what is the revenue that I get? I get 10 rupees, right? And every time I sell a unit, I also incur 6 rupees variably, which can be tracked on a per unit level, correct? So every time I sell a unit, I earn 10 rupees, and every time I sell a unit, I need to spend 6 rupees. So technically speaking, this 4 rupees is my variable profit. I can track this profit on a per unit level, correct? Now, is this my final profit? No. Why? Because my fixed cost is yet to be adjusted. So the variable profit is only called as contribution. Clear with this, guys, right? Why is it called as contribution? Wait, I will come to that. The name, the reason for the name, the logic for the name. Now, in this case, you tell me the company has sold 6,000 units. Each of the unit has given them a revenue of 10 rupees. So basically the sales is going to be 6,000 units into 10 rupees. That's going to be 60,000, right? Now the variable cost will be, they have sold 6,000 units and each of the unit had a variable cost of 6 rupees. That's going to be 36,000, right? Now, if you do this, you get a variable profit of how much? You can even calculate this, 6,000 units into 4, that gives you 24,000. Now, how much is your fixed cost? Your fixed cost is going to be 10,000 rupees. So technically you are left with a profit of how much? 14,000 rupees. Now, sir, why is this variable profit called as contribution? Simple. Now, I earn a variable profit of 24,000 rupees, that is called as contribution, right? Now, from this contribution, first I try to recover whatever fixed cost I have actually incurred, and whatever is earned over and above recovering my fixed cost is called as my profit. Or in other words, this variable profit contributes first towards recovery of my fixed cost and then towards generating my profit. Since it contributes towards two things, that is recovery of fixed cost and the generation of profit, they are using the word called as contribution. Are you clear with this? Right? This is the reason why instead of using the word variable profit, they are using the word contribution. Clear with this, guys? Clear with this, guys? Now, using this marginal costing income statement only, the other concepts like PV ratio, break-even point, margin of safety, and all of these are actually developed, and these are actually very much useful for us to take meaningful decisions. We will be seeing that. First, are you guys clear with the marginal costing income statement right now? Sales minus variable cost gives you contribution, minus fixed cost gives you profit. Now, this is the most important thing that you need to know throughout the chapter, because for every single sum that you are going to do, this marginal costing income statement is the base from which you need to enter into any kind of numerical problems in this chapter. Clear with this, guys? And are you all able to understand the logic for this income statement? Right? Fine. So now let's move on to the second one, B. Let's move on to the second one, B. Now, what have they asked for? They've asked for the PV ratio. Now, here we have sales minus variable cost gives you contribution, right? Now, on a per unit level, what is the sale? Or in other words, my selling price is 10 rupees. And on a per unit level, what is my variable cost? My variable cost is 6 rupees. And on a per unit level, what is the contribution, also known as the variable profit, to put it in layman words? So that is going to be 4 rupees, correct? Now, in terms of total value, that is for 6,000 units, what is going to be my total sales? My total sales is going to be 60,000 rupees. My total variable cost is going to be 36,000 rupees. And my total contribution is going to be 24,000 rupees. Agreeing with me on this or not? Guys, yes, right? Now, what did I do? Very simple. On a per unit level, I generate a revenue of 10 rupees. I incur a variable cost of 6 and I make a variable profit known as contribution. From now on, I will be using the word only as contribution. I earn a contribution of 4 rupees. Now, for any kind of output level, I just need to multiply each of these three figures with the volume. In this case, 6,000. So for any volume level, I can find out the total sales, the total variable cost and total contribution. Agreeing with me on this, guys, right? Now, if I say that if I want to express all these things as a percentage by keeping my sales as 100, right? That is, if I want to express my variable cost as a percentage of my sales. Now, variable cost expressed as a percentage of sales is how much, right? If I generate a revenue of 10 rupees, I know that I will be incurring a variable cost of 6 rupees. Or in other words, can I say my variable cost ratio is 60%? Agreeing with me on this or not? That is, every time you generate a revenue of 100 rupees, 60 rupees is your variable cost, correct? Yes. So the variable cost can be represented both on a per unit level as well as a percentage expression. Agreeing with me on this? Similarly, contribution also move proportionately only. So can I say every time I generate sales worth 10 rupees, I am earning a contribution of 4 rupees. Or in other words, contribution can also be expressed as a percentage of sales. Now that percentage in this case is going to be how much? 40%. Agreeing with me on this or not? Right? This 60% is called as VC ratio, variable cost ratio, and this 40% is called as PV ratio, profit volume ratio. Are you clear with this? Sir, how is this profit? I told you contribution is nothing but variable profit. Are you clear with this, guys? So when they say PV ratio, it is nothing but contribution expressed as a percentage of sale. Are you clear with this, guys? Yes, you guys are all clear with this, right? Fine. So now, why do we use this expression? If I want, I can track my variable profit on a per unit level, or if I want, I can track my variable profit, that is my contribution, as a percentage level. Every time I sell a unit, I will earn 4 rupees of contribution. Or I can say, if I generate sales worth 100 rupees, I will make a variable profit of 40 rupees. Correct? Suppose they are saying, this year I'm planning to earn generate a revenue of 1 lakh rupees. In that case, 1 lakh into 40%. So 40,000 rupees is going to be your contribution. Directly we can arrive at the figures. Are you clear with this? So if the sales is given in the units, you can multiply it with contribution per unit to arrive at the total contribution. Or if the sale is expressed in value, you multiply that with PV ratio to arrive at the same contribution value. Are you clear with this, guys? These are all multiple ways of doing it. These are all multiple ways of arriving at the figures. Are you all clear with this? Are you all clear with this? Right? Next. So now your PV ratio is done. Your PV ratio is done. Now let's move on to the next one. So what is the other one? Yes, your break-even point. So now the next concept is called as break-even point. Now what do you mean by a break-even point? The break-even point is a point where I exactly make a profit of 0. That is, it is a point of sale at which there is no profit, no loss. Are you clear with this, guys? It is a point of sale where there is no profit, no loss, right? Now in this case, in our example, when will we be having a no profit, no loss? Can I say when my sales, total sales is exactly equal to my total cost, there will be a no profit, no loss. Agreeing with me on this? Agreeing with me on this, right? Or can I say when my contribution is just sufficient to recover my fixed cost, that is when my profit will be 0. Agreeing with me on this or not? Guys, are you all clear with this? That is, when I earn a contribution that is exactly sufficient to recover my entire fixed cost, right? Then the point of sale at which my contribution is equal to my fixed cost is called as my break-even point. Now this contribution should not be more than your fixed cost. In that case, you will be starting to earn a profit. It should also not be less than your fixed cost. That will be a loss scenario. Your contribution earned should be exactly equal to the fixed cost. The point of sale at which my contribution is exactly equal to my fixed cost is called as my break-even point. Are you clear with this, guys? Are you clear with this? Now, guys, please do not mug up any formulas, right? mark my words, there is not even a single formula that needs to be mugged up here. Everything is absolutely logical. Spend some little time and you are done. That's about it, right? So now in this case of break-even point, I told you it is a point of sale, right, where my contribution is equal to what? My contribution is equal to fixed cost, right? So it is a point of what? It is a point of sale. So how many units? So how many units should I sell so that my profit is equal to 0? So we need to find that sales units only. So how do we do it? Can I say the number of units? So the sales units, I don't know what it is. I need to find out, into the contribution per unit, which we got here. The contribution per unit is how much? 4, right? Should be equal to the total fixed cost. In our case, what is the total fixed cost? 10,000 rupees. Correct, guys? Yes. So now, can I say the required sales units to exactly earn a 0 profit or 0 loss is going to be rupees 10,000 upon 4. This is nothing but how much? 2,500 units. Agreeing with me on this. So if I exactly sell 2,500 units, right, I will reach a break-even point. That is, there will neither be a profit nor will there be a loss. My contribution will be exactly sufficient to recover my fixed cost. Are you all clear with this, guys? Or in other words, this is nothing but fixed cost divided by contribution per unit. That is, I need to earn a contribution that is equal to my fixed cost, and every unit gives me a contribution of 4 rupees. So how many units should I sell to recover my entire fixed cost? That is the meaning of this. Are you clear with this, guys? Are you clear with this, guys? Right? Now, another way of doing it is, I told you, contribution can also be calculated by saying that it is nothing but sales in value into PV ratio. Correct? No? So sales can be expressed in units, or sales can also be expressed in value. Sales in units into contribution per unit gives you the total contribution. Similarly, sales in value into PV ratio also gives me what? The contribution value only. Right? Can I say sales in value into PVR should be equal to my fixed cost? Right? So now sales in value into, what's my PV ratio here? My PV ratio is 40%. So can I say into 40% should be equal to rupees 10,000, or the sales, required sales in value should be equal to rupees 10,000 divided by 40%. So how much is that? 10,000 divided by 0.4, that gives you, yes, 25,000 rupees. Are you clear with this? Or in other words, if you directly want to calculate the break-even point in value, see, break-even point is nothing but a point of sale. And whenever they are mentioning about a sale, it can either be expressed in units or can be expressed in value. So if you want to calculate the break-even point in value, you can use directly the formula fixed cost divided by PV ratio. Are you clear with this, guys? Are you clear with this? Or there is one more way of doing. We found out the break-even point in units, correct? 2,500 units, right? And every unit actually has a selling price of 10 rupees. So 2,500 units into 10 rupees. This way also you can find out 25,000 rupees. So basically break-even point, remember, can be expressed as can be expressed in units, or it can also be expressed in values. Are you clear with this, guys? So now the break-even point formula, to put it short, if you want to express in units, it's going to be fixed cost divided by contribution per unit. If you want to express in value, it's going to be fixed cost divided by PV ratio. Are you clear with this, guys? Are you all clear with this? Always remember, if you want to find out something in units, use contribution per unit. If you want to find out the same in value, instead of contribution per unit, use PV ratio. As simple as that. Clear with this, guys? Clear with this, guys? This is one trick that you can use in marginal costing, a very logical trick as well. Clear with this, guys? So now, can I say that in our case, what was the break-even point in units? 2,500 units, correct? So if I am exactly selling 2,500 units, now there will be 0 profit or 0 loss. Correct, guys? No profit, no loss. Suppose I start selling more than 2,500 units, this will be a profitable situation for me. Suppose I am not even able to reach 2,500 units, this is a loss situation for me. That is, at this point of time, my contribution earned will not even be sufficient enough to recover my fixed cost, and I will end up reporting what? A loss. Are you clear with this, guys? So So the break-even point is a parameter. Any businessman will first calculate the break-even point and he will say, now, when am I going to achieve this? I need to first achieve this 2,500, and after that, whatever sale I make, that will only go on to generate my profit. Are you clear with this, guys? Are you all able to understand this? That is the concept of break-even point. Now, let us move on to the next concept called as margin of safety. Let us move on to the next concept called as margin of safety. Margin of safety. Now, how is it getting calculated? Now, what is this margin of safety? Now, guys, in our example, now tell me what is the total number of actual units sold. In our example, the company has sold a total of 6,000 units, right? So the actual sales is how much? 6,000 units. Now we just calculated that the break-even point happens at where? It happens at 2,500 units is what your break-even point is, right? Now margin of safety means the number of units sold in excess of my break-even point. Are you clear with this? So in this case, how many units have I sold in excess of my break-even point? I have sold 3,500 units in excess of my break-even point. This is called as margin of safety. Clear with this, guys? Are you all able to understand? Are you all able to understand? So I have sold 3,500 units over and above my break-even point. This is called as my margin of safety. Sir, why are we using the word margin of safety? Basically, what the businessman will look at is, okay, currently I am selling 6,000 units. I know that my break-even point is 2,500, which means currently I'm in a comfortable position. Now, tomorrow, even if something goes wrong, max I can afford to lose a volume only to the extent of 3,500. If I lose volume beyond 3,500, I will end up in a loss situation. So to that extent of 3,500 units, I have a cushion, right? That is why it's called as margin of safety. Are you clear with this? This is the logic for the word margin of safety. Are you all able to understand this, guys? Right now, how would you calculate margin of safety? First, let me tell you this. Yes, this is nothing but you can take it as the total sales minus break-even point. Right now, have one thing in your mind. Now, in this case, what happens? The company is first, the moment they sell 2,500 units, the entire contribution will go on to recover the full fixed cost. Correct? Suppose they are selling 2,501 unit, right? The contribution generated by that one extra unit will directly go on towards generating profit. In this case, the company's profit will be 4 rupees. Correct? Suppose the company has sold 2,502 units. The company's final profit will be those 2 units into the contribution generated. So, or in other words, margin of safety is nothing but the profit generation sale. Agreeing with me on this? Right? The break-even point is nothing but your total sales that recovers your fixed cost, and your margin of safety is nothing but the total sales that goes on to generate your profit. Are you clear with this? So here the margin of safety can be easily called as your profit generation sales. Now, profit generating sales. Now, you just look at this. Now, I have something called as this entire marginal costing income statement. So, look at this here. I have sales minus variable cost gives me contribution minus fixed cost gives me profit. Correct, guys? Now, look at this. Interesting observation. So, now in this case, what's going to be my total sales value? So, it's 60,000, right? So my sales is going to be 60,000, right? Then minus my variable cost, which is going to be 36,000, gives me my contribution, which is going to be 24,000, right? Minus fixed cost gives me 10,000, gives me a final profit of how much? 14,000. Correct? Now, can I say, look at this, can I say, this 10,000 rupees of fixed cost was purely recovered by the contribution generated from these 2,500 units. Agreeing with me on this or not? That is nothing but my break-even point. That is, I'm repeating, the fixed cost was completely recovered using the contribution generated by the 2,500 units. Agreeing with me on this or not? Or in other words, can I say the break-even point 2500 units into the contribution per unit. How much is the contribution per unit? 4 rupees, right? So 2500 into 4, that's how we got this 10,000. Are you clear with this, guys? Are you clear with this? Right? Now the overall 6,000 units that I have sold, right? That gave me the overall contribution of 24,000 rupees. 6,000 units into contribution per unit of 4 rupees, that gave me the overall contribution of 24,000 rupees. Agreeing with me on this or not, guys? Yes. Similarly, the profit I am reporting of 14,000 rupees, why? This purely came from the margin of safety units of 3,500. So 3,500 units into the contribution per unit of 4 rupees. That's how I got this 14,000 rupees of profit. Agreeing with me on this, guys? Agreeing with me on this? Or in other words, can I say my contribution is tied to my total sales, my fixed cost is tied to my break-even sales, and my profit is tied to my margin of safety. Agreeing with me, guys? Agreeing with me, guys? So now I'm just writing it down here. So here, what we will write down is, so the total sales, right, is tied to the contribution. The break-even point is tied to your fixed cost, and your margin of safety is tied to your profit. Are you clear with this? And if the sales, the break-even point and the margin of safety, if they are expressed in units, right, you can multiply these figures with contribution per unit, right? If these are expressed in values, you multiply them with what? You multiply them with PV ratio to arrive at these figures. Are you clear with this, guys? Are you clear with this? That is all about it. That is all about it. So marginal costing is nothing but one vertical statement and one horizontal statement. Remember this fully. Remember this fully. That is, your total sale is made up of break-even point plus margin of safety. Correct? Your total sales is nothing but break-even point plus margin of safety. Always remember, break-even point is a point, right? The balancing figure is my margin of safety. This break-even point will not change unless and until there is a change in my fixed cost or my contribution per unit. This will not change, right? Whatever excess sale that I make, if the number of units that I sell increases, only the balance cushion will increase. The margin of safety will only increase. My break-even point will not change. Clear with this, guys? So the total sale is nothing but break-even point plus margin of safety, right? And my total sales is tied up to my contribution. My break-even point is tied up to my fixed cost, and the margin of safety is tied up to my profit. Are you all clear with this, guys? Right? And margin of safety is nothing but my profit generating sale. This is something that you need to understand. This is something that you need to understand. So here, in order to calculate the margin of safety, you can use multiple formulas. Like you can use different formulas. Can I say margin of safety is equal to, now you have, so we know that it is tied to profit, correct? So just now I told you margin of safety into PV ratio gives you what? It gives you profit, right? Or can I say margin of safety is nothing but profit divided by PV ratio? Guys, correct? Guys, correct? So margin of safety is nothing but profit divided by PV ratio. Or if you want it in units, you can say it is nothing but profit divided by contribution per unit. Are you clear with this? Similarly, I can also say margin of safety is nothing but, it is nothing but the total sales minus break-even sales. Correct? Or it can be in value, or if you want, you can also express it in units. Are you clear with this, guys? Yes, you guys are able to follow this, right? There are so many ways of arriving at your margin of safety, your break-even point. These are all different ways of reaching at the same destination. The problem is many students think that, these are all formulas to be mugged up. They will say, this is one formula, this is number 2 formula, this is number 3 formula, and they start on a mission to mug up all these things. It doesn't work that way, right? It can clearly not work that way, because this is absolutely logical. You can come up with the formula by yourself if you know the base understanding of this. Clear with this, guys? We just took about half an hour, and this is all about predominant portion of the entire chapter. Right now we will only be developing and entering into the other advanced areas, keeping this as the base. Are you all clear with this, guys? Are you all clear with this? Now one last time, so tell me, what is that marginal costing income statement vertically and horizontally? Vertically, it's going to be sales minus variable cost. Come on, guys, tell. Sales minus variable cost gives you contribution, minus fixed cost gives you what? Your profit. And here on the horizontal side, you will be having the total sales that is broken up into break-even point and margin of safety. And your total sales is tied to your contribution using CPU, your contribution per unit, or PV ratio, as the case may be. Your break-even point is tied to your fixed cost, and your margin of safety is tied to your profit. As simple as that. And this is about the entire chapter, guys. Right now, if someone is asking you to mug up formulas here, it clearly doesn't work that way. Then you will find marginal costing difficult only. This is all about it. Are you all able to understand this? Right? Shall we proceed into a few numerical problems? Yes. And of course, they've asked for the profit as well. The profit, anyways, we found it. Right? Okay, fine, guys. So now, can you tell me a few formulas as to how do you arrive at profit? Profit is equal to, I can say, total sales minus total cost, or I can also say it is contribution minus fixed cost, correct? Or I can also say it is margin of safety in value into PV ratio, correct? Or I can also say it is margin of safety in units into contribution per unit. There are so many ways in which you can arrive at it. Guys, are you all able to understand this? Right now, these are all different formulas I've seen. Many people, they write it in one full sheet of paper and they start mugging it up. Now, these are something, instead of you're wasting your time in mugging this up, if you spend your time in understanding the logic behind it, you yourself can write all these things by yourself. Clear with this, guys? Don't take the pain of remembering things. If you learn it conceptually, it will stay with you for a lifetime. That's about it. Clear with this, guys? Shall we proceed forward? Right? These are all like, it need not be, remembered. On the spot, you just visualize the vertical and horizontal statement. Marginal costing is sorted for a lifetime. That's about it. Fine, guys. Now, shall we move on to the numerical part? Okay. So this is what I've just mentioned it here in the book as basics and all. Beyond this itself, we have covered it right now. So you can just go through all these things. And one very important thing, the basic assumptions of this particular chapter. The basic assumptions of this particular chapter is selling price per unit will remain constant, variable cost per unit will remain constant, and the fixed cost in total, not the total cost, the fixed cost in total will also remain constant. Clear with this, guys? So what do you mean by this? Let us say I am selling 1 lakh units, right? Now, for this 1 lakh units, for the first 20,000 units, I can't have a different selling price. For the remaining 80,000 units, I can't have a different selling price. No. Right? Sir, in reality, it can happen. Yes, it can happen. What will I do in that case is a subject matter of discussion in CA final. Clear with this? You have a self-paced learning module. There in strategic cost management, we will be seeing. Not here in your intermediate level. That's an advanced level area. Clear with this, guys? In your intermediate level, suppose they have given a particular number of sale units. Right from the first unit till the last unit you are selling, the selling price will be the same. The selling price can change. If at all it changes, it will be changing for the entire 1 lakh units. It will not be partly for some units you will be having one selling price, the remaining units will be having a different selling price. No, that is not a subject matter of discussion in intermediate. Similar is the case for variable cost as well as fixed cost, correct? If at all these changes, we will be seeing a concept called a sensitivity analysis, wherein we will be saying what will happen if there is a change in selling price, variable cost, fixed cost. Yes, but all these changes will be happening right from the first unit till the last unit you sold. Clear with this? It will not be partly for some units and partly for different units. That discussion is there only in your CA final. Are you all able to understand this? Right? This is the basic assumptions on which this entire chapter is being made. Yes, and the uses of marginal costing, of course, it is used for pricing, short-term decision making, and market penetration at a lower price. Now, one more thing, guys. One more thing. I'm not sure if you guys are aware of this. You have two subjects, right? Costing and FM, right? When I say costing, I mean cost and management accounting. Now, costing always focuses on short-term decision making, and financial management always focuses on long-term decision making. Have this very clearly in your mind. The decision making taken by costing is always 100% short-term. Costing will not take long-term decisions. Sir, I want to take long-term decisions, then go refer FM. Clear with this? That's why these two are interconnected. That's the reason why if you notice, only in FM you have the concept of time value of money because we are going beyond 1 year. Have you ever seen the concept of time value of money in costing? No, because costing always talks about short-term duration, right? So which is important, sir? Long-term or short-term? Generally, we prefer long-term only. No, it's not like that. When you're starting a company, you start off with a long-term planning by doing capital budgeting and all that, right? But will everything go as per the plan? Suddenly something happens, a crisis comes in, you need to take an immediate short-term decision. That's when costing comes into the picture. Now this is even more critical. Taking a short-term decision is even more critical because given the scenario, you need to know what best needs to be done, right? Concepts like sensitivity analysis, your limiting factor, that is a scarcity of raw material, which I should use these raw material to produce which type of products. That is a short-term decision making. It's not permanent. If it's a long-term decision making, we need to refer FM. Clear with this, guys? So the ground rules are set. The boundaries are very clear. So long-term decision is taken only by FM. The short-term is taken only by costing. This is something that you all need to know. Right. Coming up here. So now in your CVP analysis, yes, the contribution, PV ratio, break-even point and all we've seen. Yes, the cash break-even point, I will come to that. The margin of safety, CVP pairs is also done. Now, what we will do is, let's move on to a numerical problem. Let's move on to a numerical problem. 1 second. Let me just see. Okay. Yes, guys. Look at this. Yes, please take this illustration. Please take this illustration. Now, they have given that the selling price is 25, the variable cost is 15, and the fixed cost is 20,000 rupees. Now, wait. They are asking a lot of things like contribution. What will be the profit if they are selling 4,000 units? What is the sales required to earn a profit of 50,000? And all these things are given. Now, guys, 1 minute. The moment you read any question in marginal costing, now don't keep on staring at the question. It will stare back at you, right? There is no point in it. What you need to do is immediately drop the marginal costing income statement, plug the figures there. That will automatically lead you to the solution. Clear with this? In this case, what I will do, sales minus variable cost gives you contribution minus fixed cost gives me profit. I will just plug it. Okay, only the units are given. Per unit data is given. So 25 minus 15, the contribution per unit is 10. The fixed cost is given in total as 20,000. Rough work you do and keep, right? This will lead you to the solution. Now, first, what have they asked for? PV ratio. How will you do it? How will you do the PV ratio? It's going to be 10 rupees upon 25 rupees contribution by sales, or say contribution per unit into selling price per unit. Anyways, so 10 upon 25 into 100, that's going to be 40%. Clear with this? Yes. Then what will be the profit if I'm selling 4,000 units? Very simple. The contribution will be 40,000 into, 4,000 units into 10. 40,000. From that 40,000, 20,000 will be reduced for fixed cost. Remaining 20,000 will be my profit. 40,000 minus 20,000 gives me 20,000. Clear with this, guys? Right? That's about the second part. Third part, look at this. Look at this. What is going to be the sales required to earn a profit of 50,000? What they are saying, look, I want to earn a final profit of 50,000, right? What should have been the sales I need to make? Simple. Sales minus variable cost gives me contribution minus fixed cost gives me what? Profit. Now they have said they want to earn a profit of 50,000. This 50,000 will be earned after recovering for my fixed cost of 20,000. Correct? No, guys. Yes. Which means I should have generated a contribution that first recovers the entire fixed cost of 20,000. Plus contributes to a profit of what? 50,000 rupees. So my contribution should be how much? 70,000. Are you clear with this? So to earn a profit of 50,000, I should have generated a contribution of 70,000. Correct? Right? Now for me to generate a contribution of 70,000, how many units should I sell? Very simple. 70,000 divided by the contribution per unit. Every unit gives me a contribution of 10. I need to earn a total contribution of 70,000, which means I need to sell how many units? 70,000 upon 10, 7,000 units. Are you clear with this, guys? Right? Or in other words, how do you do this? The sales required in units is going to be fixed cost plus profit. That is my required contribution divided by what? Divided by, yes, that divided by my contribution per unit. I think there is some mistake here. Just a minute, guys. There's some mistake. Okay, the final answer is correct. Look at this. I will just do it here. It's going to be 20,000 upon 20,000 plus 50,000, which is 70,000 divided by 10. Yes, 7,000 units. I think they have just done a mistake here. So if you want the sales in units, it's going to be fixed cost plus profit divided by contribution per unit. Are you clear with this? So I need to earn a contribution of 70,000 rupees, right? That 70,000 rupees, every unit is going to give me a contribution of 10, which means I can earn the 70,000 rupees only by selling 7,000 units. Clear with this, guys, right? So the required sales is going to be the required contribution divided by contribution per unit. Required contribution is nothing but fixed cost plus profit. Are you clear with this? Similarly, if you want to express this in values, very simple, fixed cost plus profit divided by PV ratio, or in other words, I know that my PV ratio is 40%, meaning what? If I make sales worth 100 rupees, right, I know that I'm going to earn a contribution of 40 rupees, correct? If this 40 has to be 70,000, right, how much should be my 100? Or in other words, 70,000 divided by 40%. Are you clear with this, guys? So wherever you are using the word contribution per unit, instead if you replace it with your PV ratio, you will be getting the sales in value. In this case, it's going to be how much? 1,75,000. Is this figure right? So it's 7,000 into 25. Yes, it's 1,75,000, or 70,000 divided by 0.4. Are you all able to understand this? Yes. To convert the rupees into units, then divide the sales. Yes, you can do that also. That's what I said. If you want, you can also first find it in units, 7,000 units, multiply it with the selling price of 25 rupees, you will get this 1,75,000. Or directly, if you want, you can say it is nothing but your fixed cost plus profit, the whole divided by PV ratio. Are you clear with this, guys? Now, I have seen many people write all these things as formulas and mugging it up, right? Required sales is equal to fixed cost plus profit divided by PV ratio. Tell 5 times, if not write 100 times imposition, doesn't make sense. You just put it up on a statement, it will lead you to the solution. What is the point in mugging up? You have a lot of other things to remember, right? Don't waste your time here. Clear with this, guys? Spend some extra 2-3 minutes, learn it conceptually, it will stay with you for a lifetime. That's about it, right? Then you have the sales required to earn a profit of 40,000 rupees after tax, okay, when the tax rate is 60%. Now, guys, first let me tell you one thing. This is an exceptional case. Generally, taxes are not even considered in our subject. I told you this, right? But for some reason they have given, I want to earn a profit of 40,000 rupees after tax. They have given that the tax rate is how much? 60%, right? So after tax, they want to earn how much? 40,000. So the tax rate is how much? 60%, which means if you earn 100 rupees, 60 rupees goes by tax, right? And the balance 40 is only left with you, right? This 40% is equal to 40,000. How much is the profit before tax that they want to earn? 40,000 divided by 40%, 1 lakh, right? That's all. Now this 1 lakh is a required profit. To earn a required profit of 1 lakh rupees, how much should be the sales that needs to be made? 1 lakh plus 20,000. 1,20,000 is going to be my required contribution, correct? So that divided by PV ratio or divided by contribution per unit, you will get the required sales in value or in units. Are you clear with this, guys? So that is what they have done. 1,20,000 divided by 0.4. So whatever it is, it's going to be 3 lakh rupees. Yes, fine. Or in other words, it's going to be 1,20,000 divided by, what's the contribution per unit? It is 15, 10 rupees, right? It is 10 rupees. 10 rupees, no? Yes, divided by 10, it's going to be 12,000. Are you clear with this, guys? And that's about it. That's about it. So if you want to express the sales in units, it's going to be 12,000. If it has to be expressed in value, it's going to be 3 lakh rupees. Done, guys. Yes, you guys are clear with this? Fine. The next one. What is the sales required to earn a profit of 25% on sales? Now, wait. What do you do? What do you do here? Don't immediately think what formula I should use. Put up the statement. It will lead you. So sales minus variable costs gives you a contribution, minus fixed costs gives you profit, right? So now they have given that. So they have asked us to find out the sales. Let's keep the sales as X, right? So variable costs gives you contribution. So what is the PV ratio, guys? What is the PV ratio? 40%. So can I say, if I keep my sales value as X, my contribution will be 0.4x, correct? Because basically my variable cost will be 0.6x, right? X minus 0.6x, it will be 0.4x, right? My fixed cost anyways is sorted. I know my fixed cost is going to be 20,000 rupees, right? This is going to be 20,000 rupees. So what is going to be my profit? They are saying I want to earn a profit of 25% on the sales. So 0.25x, correct? You have framed an equation. So can I say this is nothing but 0.4x minus 20,000 is equal to 0.25x. Correct, guys? Or in other words, 0.4x minus 0.25x is equal to 20,000. Now 0.40 minus 0.25, that gives you 0.15, right? So 0.15x is equal to 20,000. X is equal to 20,000 divided by 0.15. So how much is that? 20,000 divided by 0.5. So 1,33,333. Are you clear with this? Or if you want to find it out in units, divided by the selling price, but of course there will be some decimal round off. So this is going to be divided by 25, is it? The selling price is 25. Yes, divided by 25, you get in units of 5,333. Are you clear with this, guys? Are you all able to understand? Very logical. This is why I said spend more time on the concepts. Again and again, I'm telling you, remember the Abraham Lincoln's whatever he said. So if you give me 6 hours to chop down a tree, I will spend the first 4 hours sharpening the axe. Spend more time on conceptual learning. The execution will just take a few minutes. That's about it. Clear with this, guys? Fine. With that, we are done with this particular basic illustration. Now, one more thing. Let's go on and do one question here at the back. Yes, this is a masterpiece question. Just a minute. Please take the first question for practice. I mean, not the practice sum, the classroom discussion question. Please take the first one, guys. Please take the first one. Now, what have they given? Read it carefully. Read it carefully. Look, ideally, this I have numbered it as question number 1, but there are 6 parts in this question, right? Once we finish all the 6 here, your basic concepts are going to be sorted. Sir, in exam, can we solve through the statement without using the formula? Now, which one you're talking about? See, in any of these methods that I told you, this statement is something that will lead you to the solution. When you are writing the solution, of course, you need to write the formula. In this case, if you see, there is not much of a formula, but everywhere else, you look at this, I also used a formula. I just asked you not to mug it up, but in exam, it needs to be written for sure. So here, how do I calculate the required sales to earn a profit? I'm saying it is I backworked and I calculated here. Okay, 70,000 divided by contribution per unit. But I need to mention it in the exam. How did you get the 70,000? It's nothing but 20,000 plus 50,000. That is nothing but fixed cost plus profit divided by contribution per unit. So what I told you is this has to be in your, maybe in your rough, or if you want, you can even put it on paper, not a problem. But definitely using this, you will be able to write the formula on your own. That is what I'm saying. I'm not saying formula is not required. Please don't mistake it as, I'm telling don't write the formula. No, I'm asking you not to mug up the formula. I'm saying you can write it on your own if you do the statement. Are you clear with this? So please write the formula like this, but you can easily do it provided you are having the statement with you. Right. So now let's go on to that first question. Where is it? Okay, yeah. Now, guys, read it carefully. If margin of safety is 2,40,000 and it is being 40% of the total sales and the PV ratio is 30%, calculate the break-even sales, the amount of profit on sales of 9 lakh. This is the question. Now, what have they given here? The margin of safety is 2,40,000. So they are saying the extra sale that they have made over and above the break-even point is 2,40,000. And they are saying this 2,40,000 is 40% of the total sales. So how much is the total sale? 2,40,000 divided by 40 into 100. So the total sale would have been 6 lakhs. Agreeing with me on this? Guys, yes? Hello? Yes? So how much is going to be your break-even point? Break-even point is going to be 6 lakh minus margin of safety of 2.4 lakh. Guys, correct? Yes, guys, correct. Or you can say 6 lakh into 60%. If 40% is my margin of safety, the balance 60% has to be my break-even point. Correct? No? Right? 6 lakh into 0.6, that's going to be 3.6 lakhs. Are you clear with this, guys? Are you clear with this? So my break-even point is going to be how much? The break-even sales is going to be 3.6 lakhs. In this question, break-even point cannot be found in units. Why? Because the per unit data is not given. Have they given us the per unit data? No. They have only given us the values and percentages and the PV ratio. So had they given us the contribution per unit, we could have found out. So in this case, we can only express the PV, your break-even point in terms of values. Next, calculate the amount of profit if my sales is going to be 9 lakhs. Right? So what will be the profit if my sales is going to be 9 lakhs? You can prepare the statement and you can find out. Correct, guys? So PV ratio is how much? 30%. Now, can anyone tell me what is the fixed cost in this question? How much is the fixed cost? How much is the fixed cost? So fixed cost is going to be how much?
1,08,000.
1,08,000. Perfect. How did you get 1,08,000? Very simple. I told you, remember the marginal costing jodis. Break-even point into PV ratio gives you your fixed cost. Correct? Break-even point is a point which generates a contribution that is equal to fixed cost. So the contribution generated at the break-even point is equal to nothing but your fixed cost. Correct? So 3,60,000 into your PV ratio of 30%, that's going to be 1,08,000. So you get a fixed cost of how much? 1,08,000. So now with this you can calculate, you can prepare that entire marginal costing income statement when the sales is going to be 9 lakh. So when the sales is going to be 9 lakh, so 9 lakh into 0.3, it's going to be 2,70,000. That's going to be my contribution minus fixed cost of 1,08,000. I will be getting what? I will be getting a profit of 1,62,000. Correct, guys? Yes. Look at this. This is what they have also mentioned. The break-even point is 3,60,000, and your what is this? The profit. Yes, the profit is going to be 1,62,000. If I'm not wrong. Yes, 1,62,000. Now there is another way of calculating the profit. What is it? Using the concept of margin of safety. Guys, we know profit is equal to margin of safety into PV ratio. Correct, guys? Hello? Hello? Guys, yes? Yes, Prashant? You there? Yes. Right? So, remember the jodis that I told you. Your profit is nothing but, can I say, margin of safety into PV ratio. Correct? Now, when I'm generating sales worth 9 lakh rupees, how much is the margin of safety? 9 lakh minus 3.6 lakh. My 3.6 lakh is my break-even point. Any sale I make over and above this 3.6 lakh is called as my margin of safety. 9 lakh minus 3,60,000 is how much extra sales have I made? 5,40,000. That is the margin of safety. That into 0.3. 30%, that is directly going to give me how much? 1,62,000. This way also I can find out my profit. Look, guys, you can play around with the figures provided you have your horizontal and vertical statements of marginal costing. Clear with this? Are you all able to understand? This is much more easier way of doing it. Clear with this, guys? Right. Let's move on to the next one. X Limited has earned a contribution of 2 lakh rupees and a net profit of 1,50,000 on sales of 8 lakh rupees. What is the margin of safety? Now, if you just read the question, you cannot make out anything. What should you do first? Guys, what should you do first? Put up the statement. Scribble it, it's okay. Right? Put up the statement. It will lead you to the solution. And with that, you write the formulas and present it in the exam. Presentation part, you do it. Not a problem. But how do you know what to do? That can be done only if you prepare the statement. Sales minus variable cost gives you contribution, minus fixed cost gives you profit. Right? Now, it has earned a contribution of how much? 2 lakh rupees. Okay. And then they have said a net profit is going to be 1,50,000. So, 1,50,000 here. And then what have they said? The sales is going to be 8 lakh rupees. Right? Now, clearly you know what is the PV ratio? 2 lakh upon 8 lakh into 100. It's going to be 25% is my PV ratio. Yes, guys, yes. Now, what have they asked us? What is the margin of safety? What is the margin of safety? One look you can answer. One look you can answer. What are the jodis? Margin of safety is connected to what? Margin of safety is connected to what? It is connected to profit. Correct? So, margin of safety into PV ratio is going to be equal to your profit. Now what happens here? Or can I say margin of safety is equal to profit divided by PV ratio? Yes, profit is 1,50,000. PV ratio is going to be 25%. So my margin of safety is going to be how much? 1,50,000 divided by 0.25 is going to be 6 lakh. Guys, clear with this? Clear with this? That's about it. But when you're writing in the exam, you should write this formula for sure. I am not saying don't write the formula. Please don't misunderstand. I'm telling you the ways to write the formula by yourself. That's what I'm telling you. Clear with this, guys? Are you all able to follow this? Right? So first they also calculated the PV ratio. And then margin of safety is equal to profit by PVR. It's 1,50,000 divided by 25%, 6 lakh rupees. Are you all able to understand? Guys, yes, this is actually a beauty provided. You are able to understand the base of marginal costing. Next one. Let's move on to the next one, the third one. The ratio of variable cost to sales is 70%. Wait, they have given the VC ratio. So what is the PV ratio? 30%, the balancing figure. The break-even point occurs at 60% capacity sales, right? Capacity sales means what? The company has some capacity, right? Maximum capacity. We don't know how much that is, but they are saying when I am operating at just 60% of my total capacity, at that point itself my break-even point happens. Clear with this? Compute how much is that capacity sales, right? And when the fixed costs are 90,000 rupees, also compute the profit at 75% capacity sales. There are two questions here. Number one, first calculate what is the total capacity sales. That's what they're asking. Number two, if the company is operating at 75% capacity sale, how much will be the profit? Two things they are asking us to find out. Now first guys, now look at this. In this question, once again, what you need to do here is you need to first put up the marginal costing income statement, right? Now I'm just doing it in a rough here, but anyways, it's being done. The solution is being done. Now guys, please participate along with me. Now first, what have they given? The ratio of variable cost to sales is going to be 70%. It means that my PV ratio is going to be 30%. The break-even point occurs at 60% of the capacity. First, can I calculate the break-even point? Will I be in a position to calculate the break-even point? Yes. How can I calculate the break-even point? Fixed cost I have, PV ratio I have. So now the Jody's fixed cost is always tied to my break-even point. Correct? Right? So break-even point is equal to fixed cost divided by PV ratio. We know that, right? So in this case, my break-even point is going to be how much? 90,000 rupees divided by my PV ratio of 30%. So 90,000 divided by 0.3, that gives me how much? 3 lakh rupees. Done guys. Yes, it gives me a break-even point of 3 lakh rupees, right? Now they are saying this 3 lakh rupees is equal to 60% of my capacity, which means how much is the company's 100% capacity? So the capacity sales is going to be, if 3 lakh is going to be 60%, how much is going to be 100%, right? So divided by 60 into 100. So I can say that company has an overall capacity to sell, generate revenue worth 5 lakh rupees. Are you getting this guys? Are you getting this? This capacity sales is not actual sales. They are saying that I have a capacity overall to sell worth 5 lakh rupees. Are you clear with this? Now the second part of the question, compute the profit when the company is operating at 75% capacity. Now the actual sales is going to be how much? 75% of 5 lakhs. How much is that? 3,75,000, correct? When I am operating at 3,75,000, how much is going to be my profit? Right? Very simple. I know that my break-even point is how much? 3 lakh rupees. And now my actual sale is how much? 3,75,000. So what is my margin of safety? Margin of safety is going to be 75,000 rupees. Correct guys? Yes. So margin of safety into PV ratio of 30%. Into PV ratio of 30%. So 75,000 into PV ratio of 30% gives me how much? 22,500. So I would say now 22,500 rupees is going to be my profit when I am operating at a 75% capacity level, which generates a revenue of 3,75,000. Guys, are you clear with this guys? Any issues here? Or if you want, you can also prepare a marginal costing income statement. But if you do that, you need to calculate the fixed cost, and for you to calculate the fixed cost is given in the question, right? That way also it can be done. So in that case, what will happen? The sales is going to be 3,75,000, right, into PV ratio. So 3,75,000 into 0.3, that is going to be 1,03,500. That is going to be what? That is going to be your yes, that is going to be your contribution, right? So 3,75,000 into into 0.3. Okay, it's 3,12,500 minus 90,000 of fixed cost. You will get the same 22,500 rupees. Guys, are you all able to understand this? Guys, are you all able to understand this? Yes, right? There are multiple routes to the same destination. This is why I said, if you know the vertical and horizontal statements of marginal costing, you can play around with it like a puzzle. Right, guys? Done? Done? Shall we proceed forward? Yes, guys? Yes. Prashant, Ramya, Sheba. Yes, the others also. Priya, Bharat, and the ones online and the ones on YouTube live. Everyone, guys, you there? Shall we proceed forward? Okay, great. Fine. Now let's move on to the next one. So the fourth question. PV ratio of X Limited is 50% and the margin of safety is 40%. Now be very clear. PV ratio is calculated as contribution upon sales into 100. That is vertically. Margin of safety is done horizontally. That is, if out of the total sales made, 40% is margin of safety, right? So don't confuse the two. Place it properly. Calculate the net profit when the sales is going to be 1 lakh rupees. How will you do that? How will you do that? They have said my total sales is 1 lakh. My margin of safety is how much? 40%, which means my margin of safety in value is how much? 4 lakh into 40%, 40,000 rupees is my margin of safety. This is nothing but my profit generating sales. So 40,000 into 50% PV ratio is going to give me my profit, because margin of safety into PV ratio is going to be my profit, 20,000 rupees. Guys, are you clear with this, guys? Right?
Yes, sir.
Right? This could all be MCQs. Who knows? Who knows? This could even be MCQs. Ideally speaking, this can be an MCQ question. Clear with this, guys? Let's move on to the next one. Ascertain the profit when the sales is going to be 2 lakh rupees, the fixed cost is 40,000 and the break-even point is 1 lakh 60. So they are asking us to calculate the profit when the sale is 2 lakh, right? The fixed cost is 40,000, break-even point is 160. How will you do that? How will you do that? Can you tell me in this question how much is the PV ratio? Please don't look at the solution. How much is the PV ratio?
25%.
25%. How did you calculate the PV ratio? Now in this question, you need to have some presence of mind. Fixed cost and the break-even point are given, right? Now make use of the marginal costing jodis, right? So your fixed cost divided by PV ratio is equal to break-even point, correct? Or in other words, PV ratio is equal to fixed cost divided by break-even point, correct? No, right? Fixed cost is how much? 40,000. Break-even point is how much? 160,000. So 40,000 divided by 160,000. In this case, my PV ratio is going to be 25%. Correct, guys? Now with this, you can calculate your profit. Sales is 2 lakh. So 2 lakh into 25% gives you how much? A contribution of 50,000. 50,000 minus, yes, the fixed cost of 40,000 rupees. So now you get how much? 10,000 rupees of profit. Guys, are you clear with this, guys? Are you clear with this? Look, this is exactly what I have given here as well. All the solutions are provided. It is not the solution for which you are attending the lecture. It is for the process, the thought process, the way in which the journey is all that is important. Clear with this, guys? This is how you need to look at the questions, and this is how you need to, crack it. Clear with this, guys? Done? Any issues? Shall we proceed forward? Right.
Yes, sir.
The next one. Let's move on to the final one. Ascertain the sales when the fixed cost is 20,000, profit is 10,000 and the break-even sales is 40,000. Look at this. Calculate the sales when my fixed cost is 60,000, profit is 10,000 and the break-even sales is 40,000. Now, one second, I'm just erasing this off. Now, if it is mentioned like this, right? So immediately and all, you cannot, you might not know what to do. That's why I keep on telling you, put it up on a statement that will lead you to the solution. Now look at this. Sales minus variable cost gives you contribution minus fixed cost gives you profit. Now what have they said? When the fixed cost is going to be 20,000, right? The profit is going to be how much? 10,000. Okay. Now they have asked us to calculate how, and the break-even sales is 40,000. They have asked us to calculate, find the sales figure. Now tell me, guys, in this position, how much is my contribution? My contribution is going to be profit plus fixed cost, the balancing figure 30,000, right? Now they have given us the break-even sales, right? They have also given us the fixed cost, correct? So with this, I can calculate the PV ratio, fixed cost divided by break-even sales, that is 20,000 divided by 40,000. 50% is my PV ratio, correct? So, or in other words, contribution divided by PV ratio can give me sales. So if I may generate sales worth 100, 50 rupees is going to be my contribution, right? So if 50 is equal to 30,000, how much is going to be my sales? Or in other words, sales into PVR is equal to contribution, correct? Or in other words, sales is equal to contribution divided by PVR. In this case, it's going to be 30,000 divided by 50%. How much you get? That's going to be 60,000 rupees. Are you clear with this, guys? Are you clear with this, guys? Any issues here? And that's about this question as well. Now, this is why I keep on hammering on conceptual learning, right? Now, if you were to mug up all these charts, right, you might not even know in which sum you need to use which formula. Did we even go as per the formula? We first saw what was the question. We put it on a statement. It led us to the solution. While presenting, we did the formula, right? This is the right way of learning marginal costing. So marginal costing can either be too easy if you learn it by concept, or it will be extremely difficult if you mug up by formula. There is no middle ground here. It can either be on extremes. You can either fall in one of the category, and the choice is yours. Guys, are you all able to understand this, right? At the time when you're learning the concept, you might have felt, sir, why are you doing all these things for half an hour, 45 minutes in a revision batch? But you just see how quickly we did so many number of numerical problems. Fine, do this for all the subjects. That's what I would suggest, because it is a very smart way of cracking all the papers. Learn things conceptually. It is going to be easy for you in your exam. Your life is going to be simple, first of all. Right, guys? Done? Okay, just a minute. Is there anything else left out? Let me just see. In the basic concepts, is there anything else left out? Okay, break even point is okay. Okay, let us also do this. Okay, there's something called as a break-even chart. That is, they might ask you, rarely test it, but if you were to plot all these things on a chart, how would it look like, right? So this is an example given. Selling price is 25, the variable cost is 10, the fixed cost is going to be 15,000 rupees, right? And they have given that the present sales is 1500 units. Draw the break-even chart and the profit volume chart. Guys, am I being audible? Is it fine? Yes, it's going on fine. Okay, right. Yes. Great. Now again, so here sales minus variable cost gives you contribution minus fixed cost gives you profit. So now here we know that the selling price is 25, variable cost is 10. That gives me a contribution of 15 rupees, and the fixed cost is going to be 15,000 rupees. So now first with this we can calculate the break-even point. What is the break-even point here? Fixed cost divided by contribution per unit. 15,000 upon 15, it's going to be how much? 1,000 units. Correct, guys? It's going to be 1,000 units, right? So now if you were to plot this on a graph, you can see that exactly at 1,000 units, what happens? Okay, so I'll tell you what to do here. So here what happens? Now there will be two lines that you need to draw. One is with respect to the total revenue. The other one is with respect to the total cost. Total revenue will start from the origin. Why? If I'm operating at a volume of 0, my sales will be 0. Correct? Slowly as the number of units increases, what happens? Your revenue will also proportionately increase. Are you clear with this? This is a total cost line. If I am selling 0 units, still I will be incurring fixed cost. So it starts at the fixed cost, and proportionately it will increase from there because of the variable element. Are you clear with this? There will be a point where my total revenue is equal to total cost. That point is called as my break-even point. That is going to be 1,000 units. Less than this point, if I am operating at less than 1,000 units, what will happen is my total cost will be more than my total revenue, and hence it will be a loss situation. Clear with this, right? Now the tables will change automatically. If you are operating above the break-even point, your total revenue will be more than the total cost. That will be a profit situation. Are you clear with this, guys? Right? Now the angle that gets formed here, there is an angle, no? Right? When two lines are intersecting, there is one angle that forms there, no? This angle is called as angle of incidence. Are you clear with this? It is called as angle of incidence. Suppose instead of this, suppose it was like, let's say there are two lines here, right? And these two lines were like this. That is, if the angle of incidence is wide, it means that the gap between my revenue and cost is more, which means that it is reporting a more profit. Are you clear with this? Or in other words, wider the angle of incidence, more will be your profit. Are you clear with this? Because at the end of the day, angle of incidence represents the gap between your total revenue and total cost. If the gap between the revenue and cost is more, it means you have a more margin of profit. Are you clear with this? These all could be tested as conceptual MCQs anywhere. So please catch up running notes. Mark this somewhere. Clear? In your institute study material, it runs into pages, right? I am not saying, there's nothing wrong about it, because if I'm explaining it in a lecture, yes, I can give you an examples and right away do it. If it has to be printed, it needs to run into pages. No other option, right? So this is what I said. This is the reason why I'm saying. In fact, institute has honestly done a very good job with respect to coming up with a good material, because the quality has drastically improved as compared to how it was before. So we need to give the credit where it's due. Yes, there are certain things like sequencing which could have been better, certain quality of examples could have been better, but still the quality of the study material as compared to what it was before has drastically improved. So that needs to be said. Anyways, guys, are you clear with this? Are you clear with this? This is about the angle of incidence. It is the angle that gets formed between which two lines? Total sales and total cost. Are you clear with this? Right, guys? Fine. That's about it. Now, if you were to plot the profits, the profit line will look like follows. Clear with this? That is, at 0 units, what will be your profit? Your profit will be equal to, you will be having a loss that will be equal to your fixed cost. Correct? I haven't sold anything. My contribution is 0 minus fixed cost gives you a profit of that is equal to a negative profit equal to the fixed cost. Correct? So it starts off here, right? And at any point you calculate one profit, you touch the two lines here, so automatically you will be getting it. And exactly at the break-even point, you can see that it cuts the origin. That is no profit, no loss. Are you clear with this, guys? You just go through it once. If at all there is, they ask something like this, maybe you can handle it. Are you clear with this, guys? And that's about this particular break-even chart. Now, one more thing I think is the cash break-even point. I saw it somewhere. Can anyone help me out? Yes, here we go. Okay. Now, guys, one more thing. What do you mean by a break-even point? Break-even point is a point where my contribution is sufficient enough to recover my fixed cost. That's why we said it is fixed cost divided by contribution per unit. If you want it in value, it's going to be fixed cost by PV ratio. Correct, guys? Now, what do you mean by a cash break-even point? It refers to the point of sale where my contribution just recovers my cash fixed cost. So the formula is going to be cash fixed cost divided by contribution per unit. Sir, can you give us an example? Yes. Now you have fixed cost here, right? Let us say this fixed cost is going to be 1 lakh rupees. Out of this 1 lakh rupees, the cash fixed cost is 80,000. When I say cash fixed cost, it means the amount that I actually pay and incur. Example is going to be factory rent, supervisor salary, any kind of other fixed cost that involves payment of cash, right? And even depreciation, amortization are also fixed costs. Correct? Depreciation is also a fixed cost, right? Let us say depreciation is 20,000 rupees. You tell me, will I pay depreciation to a third party out of my pocket? Will I pay depreciation out of my pocket? I will not pay depreciation out of my pocket. But why I do it is because of matching concept. I use an asset for production. So I have already capitalized it to the extent I am using it. So over a period of time, I'm writing it off. So though it is ideally a cost for me from a perspective of, an accrual concept, but what we are doing here is we just want to know. I'm just starting off on a business. Generally, when a person starts off on a business, they will not be too greedy to recover the entire fixed cost. They will say, tell me what is the cash fixed cost. I want to know the point where at least my contribution will recover my cash fixed cost. I don't want to recover my full fixed cost. It's enough if I recover my cash fixed cost. In that case, the cash break-even point will be what? Cash fixed cost divided by what? Contribution per unit. It tells you how many units you should sell so that your contribution exactly recovers the cash fixed cost. Are you clear with this, guys? Now, at a cash break-even point, will there be a profit? Will there be a loss? Or will there be a no profit, no loss? At cash break-even point, will there be a profit? Will there be a loss? Or will there be a no profit, no loss? Tell me, guys. No, there will not be no profit, no loss. No profit, no loss will be there only in break-even point. At the cash break-even point, you have still not recovered 20,000 rupees, no? At the cash break-even point, your loss will be equal to the depreciation amount. Are you clear with this? Are you clear with this, guys? At the cash break-even point, you would not have recovered your non-cash fixed costs. Clear with this? So you still will be reporting a loss. That's fine. But I just want to know the point where I will just be able to recover my cash fixed cost. Clear with this, guys? These could be conceptual level MCQs. So please watch out for these things. Maybe catch up running notes somewhere. Clear with this? Yes, done. And that's about the concept of break-even point and cash break-even point. So now, what are the concepts that we have done here? This is, okay, contribution PV ratio, break-even point, cash break-even point, margin of safety, CVP pairs is also done. This chart is also done. Okay. Okay, now, let us move on to another concept, an interesting concept called as, yes, volume analysis. I think I missed mentioning the name, but the illustration is here. Volume analysis. By the way, guys, honestly tell me, the ones who maybe are attending or may have not attended my regular batch, because in regular batch I list out the learning objectives at the start of every chapter. So how many of you are seeing that there are so many concepts in marginal costing? For the first time you're seeing that, okay, there are so many concepts in marginal costing, is it right? So you guys knew this before, like there are so many concepts in marginal costing? Because many students, as I have seen, they know a lot of concepts but they don't know it by name, right? So they don't know, oh, this is called as volume analysis or this is called as sensitivity analysis. Sir, if you give us some, we will be able to answer, but we didn't know that these are the names for this. Okay, so it is better to know it by concept name so that it will be easy for you to revise towards the end. That is the reason why I'm giving the name. Okay, now look at this volume analysis, what it talks of. It's a very, very favorite area personally for me, because I still remember in my, when I wrote my CA intermediate, right? I didn't learn by all these names and all this. I have classified it only, you know, while I started my teaching thing. So I didn't know this. Actually, this came as the first question of my CA Inter costing paper. First question, I was blinking what to do, but again, conceptual learning only helped me. So I just prepared some statement, tried figuring it out, but at the end of the day, fine, I was able to crack it. But again, I'm telling you, this is ideally a concept. After writing the exam only, I got to know that this has a name called volume analysis. Let me tell you what that is. Now, just a minute. I've just coined up an example. 1 second. Okay. Now, I hope you guys are catching up running notes. Are you guys doing it? Yes, good. Now, volume analysis. Guys, in exam, please don't expect the institute to mention the name of the concept and all. It never works that way. You should be able to figure out what concept they are testing in a chapter. Now, let us say, I'm again giving an example. Let us say selling price is 10, variable cost is going to be 6, fixed cost is going to be rupees 10,000. Okay, done. Now, I am preparing a marginal costing income statement for two volume levels, 5,000 units and 7,000 units. Just an example. Now, what's your marginal costing income statement? Sales minus variable cost gives you contribution minus fixed cost gives you profit. Now, so what's going to be your sales at 50,000 units level? It's going to be 5,000 units level. It's going to be 50,000. Variable cost will be 5,000 into 6. That's going to be 30,000. Your contribution is going to be 20,000 rupees here. Your fixed cost is going to be 10,000 and your profit is going to be 10,000 again. Now, suppose I'm selling 7,000 units. So my sales is going to be 70,000. My variable cost is going to be 7 into 6, 42,000. Right? And my contribution is going to be 28,000. Fixed cost remains to be 10,000. And my profit is going to be how much? My profit is going to be 18,000. Now guys, if you make an observation here, now, can I say that in this case, what happens? Your profit increases by how much? Your profit increases by how much? 8,000 rupees. Your profit increases by how much? 8,000 rupees. Can I say this increase in profit is purely on account of the increase in contribution? The contribution has also increased by 8,000. Why else will my profit increase? There is no change in the fixed cost in between. So if at all my profit is changing, the change in profit is always equal to the change in contribution. Agreeing with me on this? And why is my contribution changing? Because now what am I doing? Instead of selling 5,000 units, I am now selling how many units? 7,000 units. So there has been an increase in the volume by 2,000 units. Agreeing with me on this? Or in other words, can I say that 8,000 rupees, right, is nothing but the contribution generated by this extra 2,000 units? Agreeing with me, guys? Right? Or in other words, can I say the contribution per unit is equal to the contribution per unit is equal to delta profit divided by delta units. Delta means what? Change. In this case, it is nothing but 8,000 rupees. The change in profit is nothing but the change in contribution, and that contribution is pertaining to the change in units, correct? So 8,000 rupees is the contribution pertaining to how many units? 2,000 units. So how much is the contribution per unit? 4 rupees per unit. This way also I can find out. Guys, correct? This is what we found out there itself. 10 minus 6 is 4. Suppose the per unit data and all is not given, correct? Assume in the question they have just given you sales 5,000 units, 7,000 units. If 5,000 units is sold, the profit is 10,000. If 7,000 units is sold, the profit is 18,000. This is all they have given. Can you find out the PV ratio? Yes. Yes, just the top figure and the bottom figure they are giving you. Sorry, can you find out the contribution per unit? Yes. How will you do it? Difference in profit is nothing but the contribution pertaining to the change in units. So my contribution per unit, one more formula is now available. That is nothing but delta profit divided by delta units. Are you clear with this, guys? Right? Suppose you want to calculate the PV ratio. How will you do it? Very simple. PV ratio is equal to delta profit divided by delta sales. Or in other words, can I say this 8,000 rupees is the contribution that got generated from the extra sales of 20,000 rupees. Correct? So can I say that 8,000 upon 20,000 into 100, that's going to be how much? 40%. Are you clear with this, guys? Are you clear with this, guys? Right? This is called as volume analysis. So in your volume analysis, suppose in a sum, if they just give you year 1, year 2, 2 top figures and 2 bottom figures, can you end up calculating the PV ratio or the contribution per unit? Yes. Are you clear with this? Right? Here I will say the PV ratio is the delta profit divided by delta sales. I was earning a negative profit, that is a loss of 15 lakh. It has now become how much? 75 lakh, which means I have earned an extra profit of how much? Extra profit of 90 lakhs. This 90 lakhs is nothing but the contribution generated due to the incremental sale of 150 lakh. So 90 lakhs upon 150 lakhs into 100. In this case, the PV ratio is going to be 60%. Are you clear with this, guys? If they just give you the top and the bottom figures, still you can find out the PV ratios or the contribution per unit. Clear with this, guys? See now how many formulas are there for PV ratio? PV ratio is equal to contribution by sales into 100. Correct? Or fixed cost divided by break-even point into 100, or profit divided by margin of safety into 100, or now we also have one more formula, delta profit divided by delta sales into 100. Clear with this, guys? You need not mug this up. The situation, based on the situation, you yourself can arrive at the formula and write it by yourself. Clear with this, guys? Done? Are you all able to understand this? Yes, you guys are able to follow this? Fine. Shall we move on to the next one? Okay, so what have they asked? Yes, now once you find out the PV ratio, now you can prepare the entire marginal costing income statement, right? So you know that the sale, take year 1 or year 2, whichever you want. So the sale is 100 lakhs. What will be the contribution? 60% on 100, 60 lakhs. They have given us the profit was how much? The profit was 15 lakhs. So the balancing figure has to be your fixed cost. Are you clear with this? Are you clear with this, guys? Yes, this way you can find out and prepare the rest of the income statement. Now for any output level, you can prepare your income statement. Clear with this, guys? And that is about the concept called as volume analysis. Done with this? Are you all done with this? You guys are clear with this, right? Shall we move on to the next one? Yes, guys? Yes, done. Shall we move on to the next one? Yes, okay. Now, let's move on to the next one, which is called as sales mix, merger of plants, sensitivity analysis, indifference point. Okay, let me take up sensitivity analysis. Okay, sensitivity analysis. Now, what do you mean by sensitivity analysis? First, guys, what do you mean by sensitive? Have you might have seen this advertisement on Colgate sensitive. What do you mean by sensitive? So, while other things remaining constant, an introduction of a change in one variable impacting the others is called as sensitivity. That is, you would have seen advertisements where they will eat one ice cream and they will say like, it really becomes very difficult for them to, that the way your teeth responds to it, right? That is called a sensitivity. Similarly, even in marginal costing, we are going to see how a change in a variable is going to impact the other components, right? Now, if you see in this chapter as of now, what we have learned, what is marginal costing all about? We are just playing around with four numbers. What are those four numbers? You have selling price per unit, you have variable cost per unit, you have fixed cost in total, and you will be having volume, right? Yes, guys, right? Actually seeing till now, your marginal costing is nothing but we have four input figures. Selling price per unit, variable cost per unit, fixed cost in total, and volume, right? Now, how these four inputs will impact my profit is the study of marginal costing. Correct, guys? To put it in short, right? How these four inputs, change in these four inputs is impacting my profit is what we have been seeing in marginal costing. You take any of the sum, these are all the figures that we have been seeing. So, but what we are doing is, we are seeing how these four figures will impact my profit. So, to understand the study, we are having some tools called as PV ratio, right? You have this break-even point and you have this margin of safety. So, to put it short, your marginal costing is nothing but the study of how these four variables impact the profit through the tools called as PV ratio, break-even point, and margin of safety. This is all the study of marginal costing. Clear with this, guys? Clear with this? Now, what is sensitivity analysis saying? Now, suppose I am slightly increasing my selling price while keeping the other factors unchanged. How is it going to impact my profit? Or suppose I am slightly decreasing my variable cost while keeping the other three input factors unchanged. How is it going to impact my profit? Right? Or in other words, the sensitivity analysis talks about how a change in one variable while keeping the other constant is going to impact my profit through the PV ratio, break-even point, and margin of safety is called as the study of sensitivity analysis. Clear with this, guys? Clear with this, guys? Right? That is about the concept of sensitivity analysis. Now, how and all we will just be seeing right now. Now, I always get reminded of this sensitivity analysis. The moment I say sensitivity analysis, I get reminded of one student who, so in just like how I told you guys that, this Colgate sensitive advertisement and all. So by mistake, I thought of that Colgate active salt, that advertisement is there, no? So I told one madam will immediately break open the wall. She will come and she will ask, do you have your toothpaste and all? By mistake, I said that madam was Kajal Agarwal. That guy said, no sir, now it's Samantha. How can you say Kajal Agarwal? No? I said, dey, evlo highlights ra irukidala. Idella vittittu idha paakranga naan. But see, our students are always on the top of all the current affairs. Okay, right. Coming back here, guys. So, sensitivity analysis. Now, sensitivity analysis. Now, I told you that it is a study of how a change in one variable is going to impact your profit through these three tools called as PVR, break-even point, and margin of safety. Now, guys, you all participate and I want your interaction on this. Now, what we're going to do here is, first, let me just put it up here. The three tools, PVR, break-even point, and margin of safety. Right? Now, first, let me talk about the selling price. Let us say I am increasing my selling price while the other factors remaining constant. I am just increasing my selling price. Let us take an example. Let's say presently my selling price is 10. Variable cost is going to be 6. My contribution per unit is going to be 4. Right? And let's say the fixed cost is currently going to be 10,000. Correct? Just an example, guys. Right? Now, while other aspects remaining to be constant, and let us say the volume is how much you want the volume? Let's say it's 1 lakh. Okay, right. Now guys, now what happens? Let us say while the other factors remaining constant, I am slightly increasing my selling price. Now what will happen to the PV ratio? Now the selling price alone I am changing. Instead of 10, let us say it becomes 12. Okay, right? So now what? The variable cost continues to remain 6. My contribution becomes how much? 6 rupees now. Correct? Now what happens to my PV ratio? Earlier my PV ratio was 4 upon 10 into 100, 40%. An increase in your selling price while the other things remaining constant will obviously increase your contribution per unit, and hence your PV ratio will also increase. Correct, guys? Right? So obviously my PV ratio will increase. Correct? Right? Now what happens to my break-even point? Earlier every unit was generating 4 rupees, right? Now every unit is generating 6 rupees. So now you tell me, logically speaking, it will take lesser time for me to recover my entire fixed cost. Agreeing with me on this? So obviously my break-even point will go down. Correct? Now I am not changing anything else. The volume also continues to remain the same. Now what happens to your margin of safety? So volume is the same, right? But my break-even point has come down. So now the balancing figure will obviously increase. My margin of safety will increase. And when my margin of safety increases, my profit will increase. Are you clear with this? Because margin of safety after all is nothing but your profit generating sales. Clear with this, guys? Clear with this, guys? Now you are able to understand what is sensitivity analysis. A change in one variable impacting my profit through these three tools is called as sensitivity analysis. Similarly, if I'm reducing my selling price, what will happen? Instead of 10, let us say it is now 8. This continues to be 6. My contribution per unit becomes how much? 2 rupees. So 2 upon 8 into 100, that's going to be how much? 25%. Or in other words, my PV ratio will fall down. Correct? Now, since the contribution per unit has reduced, it takes more time for me to recover my fixed cost. My break-even point will increase. Volume is same. Now break-even point is more, which means the balancing figure is going to be less. My margin of safety will increase, and when my will decrease, and when my margin of safety decreases, my profit will also decrease. Clear with this, guys? Clear with this, guys? Now, second one, let's talk about variable costs. Suppose I'm increasing my variable cost. What will happen? So while everything else is constant, let us say I'm keeping everything else is constant. So now selling price is 10. But variable cost, instead of 6 rupees, I'm now making it as 8 rupees. What happens to my contribution? It becomes 2 rupees. Correct? So PV ratio will now obviously fall. Guys, correct? Right? When my PV ratio falls. Now, what happens? Now every unit recovers only 2 rupees of contribution. It takes more time for me to recover my fixed costs. Break-even point increases. And when my break-even point increases, the balancing figure, margin of safety, will obviously fall down. And hence there will be a fall in my profit. Guys, correct? Right? Similarly, what will happen if you decrease your variable cost? Now what happens here? Now let us say instead of 6 rupees, my variable cost is just 4 rupees. Now what happens? My contribution per unit will increase, right? This increases my PV ratio, right? Now I'm generating more contribution per unit. What happens here is, right now I will be able to recover my entire fixed cost more quickly. Correct? So my break-even point will fall down, and when my break-even point falls down, the balancing figure of margin of safety will be more. An increase in margin of safety will result in a higher profit. Guys, clear with this, guys? Right? Done. Next, third one. What is the third input factor we've got? Fixed cost. Now guys, logically think and tell me, if there is an increase in the fixed cost, how will it impact my PV ratio? What will happen to the PV ratio? If my fixed cost increases, what will happen to my PV ratio? Come on, think and answer. Guys, come on, use the chat box.
Overall profit decreases.
I'm not asking about overall profit. I'm asking about the impact it has on the PVR. Exactly. Very good. Very good. So now here, your PV ratio will not get impacted. PV ratio is dependent on contribution and sales only. If directly you increase your fixed cost, that will not impact my PV ratio. I'm not saying it will not impact your profit. I'm just saying it will not impact your PV ratio. Correct? Now, how will it impact your break-even point? Will it impact your break-even point? Yes, it will. Now you have more fixed cost to recover, right? The contribution per unit is the same. You have more fixed cost to recover. What will happen now? Your break-even point will be more. It will increase. And when your break-even point increases, the balancing figure volume will obviously decrease. Are you clear with this, guys? Right? Suppose I'm decreasing my fixed cost. Once again, no change in my PV ratio, but now I have only lesser fixed cost to recover, which means my break-even point will fall down. The balancing figure, margin of safety, will increase. Guys, clear with this? This will end up in a more profitable situation for me. Are you all able to understand this logically? Right? Now let's go on to the last one, the fourth one, volume. Now tell me, if I increase my volume, what will happen to my PV ratio? What will happen to my PV ratio? If I increase my volume, what will happen to my PV ratio? Again, no impact. You are only increasing your volume. How will it impact my PV ratio? On a per unit level, the selling price and my selling price and my contribution per unit variable costs are all one and the same. So it will not impact your what? It will not impact your PV ratio. What will be the impact on break-even point? What will be the impact on break-even point?
Again, no impact.
Once again, no change. Very good. Why? Because break-even point is about fixed cost upon contribution per unit. Fixed cost is also not changing. My contribution components are also not changing. Now, break-even point is a point. Are you clear with this? That point is fixed. That's about it. Unless and until there is a change in your fixed cost or in your contribution per unit, this will not change. Correct? Now, as there is an increase in volume, now what will happen? Only your margin of safety will increase. Are you clear with this? That's the reason why more the volume, more the profit. Clear with this, guys? Right? Now, similarly, what happens if there is a drop in the volume? Right? Now, your PV ratio, there will be no impact on the PV ratio. Similarly, no impact on your break-even point. But now, what happens? Your margin of safety drops, and hence your profit will also drop. Are you clear with this, guys? Are you clear with this? This study is called as sensitivity analysis. This study is called as sensitivity analysis. And remember one thing, if you make an observation here, if my PV ratio gets affected, definitely my break-even point and margin of safety will get affected. Correct? If my break-even point gets affected, definitely my margin of safety gets affected, but it need not be the case where my PVR will get affected. That is, if my break-even point is getting affected, definitely my margin of safety will get affected because it's a balancing figure. But it is not necessary to affect my PV ratio. Similarly, if my margin of safety gets affected, it is not necessary that the PV ratio and the break-even point should get affected. Are you clear with this? Are you clear with this? This is the overall conclusion that you can draw from the concept of sensitivity analysis. Are you clear with this, guys? Are you clear with this? Yes, you guys are fine with this? Yes, shall we move on to the next one? Shall we move on to the next one? Right? Yes. Okay, great. 1 second. I have a question here. The change in profit is equal to change. Okay, right. That's a sensitivity analysis as same in financial management. Yes, it is the same. Sensitivity analysis, the concept will always be the same. It depends on which variable and which final effect that you're talking about. In marginal costing, you're talking about the impact these 4 variables will have on your profit. Yes, in your marginal, in your financial management, in fact, in final and all, we'll be having, even in capital budgeting, we'll be having sensitivity analysis. I think even in intermediate level, to some extent, we have. Yes, the concept of sensitivity analysis is the same, right? The components which you do the sensitivity analysis alone will be different. That's about it. Fine, guys, done. Let's move on to the next one. Right? Any other doubt? Just a minute. Let me just take it up. Okay, fine. Right. Now let's move on to the next one. Now, the next concept is about sales mix and marginal costing. Sales mix and marginal costing. Sales mix and marginal costing. Now guys, what is this? Now, carefully listen. In sensitivity analysis, there is a reason why I did sensitivity analysis first and then I'm moving on to this particular sales mix immediately. In sensitivity analysis, I told you that only 4 components will impact your profit. Correct? Right? That is your selling price, variable cost, fixed cost, and your volume. Correct? These are the 4 components that will impact your profit. Any change in these 4 components alone will actually impact my profit. This is what we saw till now, guys. Yes. Now we will now see there is a 5th component that can also impact your profit, right? Sir, which means till now poi sollitengla, have you lied to us? Not like that, right? It's a gradual learning, that's why. Okay, so there is also a 5th component that impacts your profit, that is called as sales mix. Clear with this? What do you mean by sales mix? Now, let me just take an example to tell you to explain the concept of sales mix and also help you understand how the sales mix is going to impact your profit. Let us take an example of a company called BMW. You guys know BMW? Yes, the automobile company, right? Now, BMW is actually into the business of manufacturing cars, and they also manufacture bikes. They also manufacture bikes, right? So everyone knows that they manufacture cars. Maybe some of you might not know that they manufacture bikes, but yes, they also do. Clear with this. In reality, they also do manufacture bikes. Super bikes they manufacture. It will not be like normal, the price range itself will be high. Fine. Now, what happened was, now BMW, what they are saying, year 1, year 2, right? 2-year data they published. 2-year data they published. In both the years, they didn't change the selling price. They didn't change the variable cost. They didn't change the fixed cost. And in both the years, the total volume was 1 lakh units. They have sold 1 lakh units, right? So as the volume changed, volume also did not change. However, in year 1, the profit was different. In year 2, the profit was different. Why? I'm again telling you, they did not change any of these 4 components. Still, in year 1, the profit reported was different. In year 2, the profit reported was different. Now, what happened was, in year 1, I told you, no? In year 1, I told you that they sold 1 lakh units, right? The breakup was, they sold 60,000 cars, right? And they sold 40,000 bikes. Clear with this, guys? Whereas in year 2, what they did, they sold the same 1 lakh units only, but the internal sales mix or the composition alone changed. They sold 40,000 cars, right? And 60,000 bikes. Are you clear with this? Now you tell me, everything was the same, but the internal composition alone changed. Maybe cars might be having a higher contribution per unit, right? And bikes may be having a lower contribution per unit. In year 1, though the total number of units were the same, but if you see in the internal composition, in year 1, they have sold more of a high profitable product. Whereas in year 2, they have sold only lesser of a high profitable product. Maybe that is the reason why in year 1, the profit reported might have been high, and in year 2, the profit reported might have been less. Are you clear with this? Or in other words, you're not just these 4 factors, one more factor called as sales mix. Sales mix is nothing but the composition of the different products being sold also impacts your profitability, and the study of this is called as sales mix and marginal costing. Clear with this, guys? Right? Now, sir, how is this going to impact our profitability? Now, it is not just that, it is also how do I calculate the break-even point when the company is selling more than one product? These are all a few extra learnings that we are going to do here. Now, guys, remember one thing. This sales mix will be applicable only for companies that deals in more than one product. If the company deals in only a single product, whatever we've seen till now, that alone will stand, right? Over and above all the concepts we have learned, if a company is dealing in more than one product, 2, 3, 4, 100, whatever number of products, in that case, your sales mix concept will come into play. Are you clear with this, right? To understand the concept of sales mix better, now let us do a numerical illustration. Let us do a numerical example question. So please take the second question for classroom discussion. Please take the second question for classroom discussion. Here it is. Yes, guys, please take the second question. Shall we get started? Right. Now, the following set of information is presented to you by your client AB Limited, producing 2 products X and Y. So X and Y, they have given that the direct material is 20, direct labor is 6 rupees per unit for X, for Y it's 18 and 4. The fixed expenses during the period is expected to be 1600 rupees. The variable expenses are allocated to the products at the rate of 100% of direct wages. The selling price per unit of X is 40, Y is 30. The proposed sales mix, they are saying, alternate 1. They are planning to sell 100 units of X, 200 units of Y. Alternate 2, 150 each of X and Y. And alternative 3, 200 units of X and 100 units of Y. As a cost accountant, you are required to present the management the following. Number 1, the total contribution and profit from each of the above sales mixes. Then, number 2, The proposed sales mix to earn a profit of 300 rupees and 600 rupees when the total sale of X and Y being 300 units. Calculate the break-even point when the sales mix is 2:1. Recalculate the break-even point when the sales mix is 1:2. Now, this is about the question. Now, first, what we need to do is let us calculate the contribution per unit of each of the two products. Now, if you look at this, product X, product Y, they have given the selling price 40 and 30, correct? So, this contribution is 40 and 30. From that, reduce all the variable costs. So, you have the variable cost here, your direct material, direct wages. Apart from that, there is one direct expense also, which is equal to 100% of direct wages. So, here if you see 26, and you also have your direct expenses, which is being given, right? Minus 6. So, here it's going to be every unit of X generates a contribution of 8. Similarly, every unit of Y generates a contribution of 4 rupees. Clear with this? This is the first step that we have done. That is calculation of what? The contribution that each of the products are generating. Now, what have they asked here? First, what we need to do? We need to calculate, okay, what should be the proposed sales mix to earn, okay, fine. There are three alternatives given in the question. We need to calculate the profits for each of these three alternatives, right? Now, let us do that. Calculation of profit under different sales mix. Now, suppose scenario 1, 100 units of X is being sold and 200 units of Y is being sold. Now, you tell me guys, what will be the total contribution? 100 into 8, that will be the contribution generated by X. Similarly, 200 into 4, this will be the contribution generated by Y, correct? So, the total contribution generated is going to be 1600 rupees. Now, from this, they have given that overall, the company incurs a fixed cost of 1600 rupees. This 1600 rupees is a fixed cost that is pertaining to both the products put together. Clear with this? It's a common fixed cost. So, from that, you reduce your fixed cost. So, now the profit is going to be 0. The profit will be 0 when I'm selling 100 units of X and 200 units of Y. Suppose in the second situation where I'm selling 150 units of X and your 150 units of Y. In this case, what will be the total contribution, right? So, once again, we've got it here. So, it's going to be 150 into 8 plus 150 into 4, right? That is going to be the total contribution, 1200 plus 600, which is 1800. From there, you reduce your fixed cost, you'll end up with a profit of 200 rupees, right? Suppose I'm selling 200 units of X and 100 units of Y. Then multiply the same with the respective contributions per unit, 200 into 8 and 100 into 4, right? You get a total contribution of 2000 rupees. From that, subtract 1600, you will end up with a profit of 400 rupees. Clear with this, guys? If you notice here, in all the three situations, 100 plus 200, I have sold 300 units. 150 plus 150, here also 300 units. 200 plus 100, here also 300 units, right? Overall, the volume has not changed, but a change in the mix results in different profits here. So, if you see in the first scenario, the profit reported was 100 rupees. The second scenario, it was 200. The third scenario was 400. This way, we can clearly see that a change in the sales mix can also impact your profit. Are you clear with this, guys? Are you clear with this, right? Next, what have they asked as the second one? Now, what should be the proposed sales mix to earn a profit of 300 rupees, right? And the second scenario, they've asked to earn a profit of 600 rupees, but they've given one condition. The total sales of X and Y put together should only be 300 units. So, first, let us calculate how many units of X and Y I need to sell in order to earn a profit of 300 rupees. Now, very simple and logical calculation. Let the number of units of X be X. So, which means the number of units of Y is going to be 300 minus X, because they've given us a condition that number of units of X plus number of units of Y has to be 300. So, if you keep this as X, Y has to be 300 minus X, correct? So, now the total contribution will be how much? 8x, that is every unit of X generates a contribution of 8 rupees and every unit of Y generates a contribution of 4. So, 4 into 300 minus X, we are replacing Y as 300 minus X, right? So, this is going to be the total required contribution minus my fixed cost of 1600 should be equal to 300 rupees. With this, we can frame an equation. So, we can arrive at the fact that it is going to be 4x is equal to 700 rupees. So, now how much is my X value is equal to, I think they have done a mistake here. Just a minute, guys. It's going to be 700 divided by 4, right? So, it's going to be 175, right? This is not 1754. right? It is going to be 175. Are you clear with this? So now with this, we have calculated that I need to sell 175 units of X. Obviously, Y is going to be 300 minus 175, 125 units. So when the company sells 175 units of X and 125 units of Y, they will end up making a profit of 300 rupees. Are you clear with this, guys? Are you clear with this, right? So easily we can find out how many units of X and Y respectively need to be sold in order to earn the required amount of profit. Done, right? Now moving on to the next one which they have asked for. Suppose the company wants to earn a profit of 600 rupees. How many units of X and Y needs to be sold? Once again, you frame the same equation. 8X plus 4 into 300 minus X minus of the fixed cost of 1600 should give you a profit of 600 rupees. Frame the equation. Now you will get the X value as 250 units. The Y value is going to be 300 minus 250. It's going to be 50 units. So when the company sells 250 units of X and 50 units of Y, they will end up making a profit of 600 rupees. Are you clear with this? Right? That's about this particular segment. Now coming to the most important part, calculation of the break-even point. This is where this entire, the crux of the matter lies here with respect to the calculation of break-even point. When the sales mix is 2:1. Now guys, now you tell me what is the issue here. You tell me what is the issue here. Now, let me write it up. I have two products, X and Y. Product X generates a contribution of how much? It generates a contribution of 8 rupees and product Y generates a contribution of 4 rupees, right? And I have a common fixed cost of rupees 1600 to be recovered. Guys, correct now? Yes? Guys, yes, you there? Guys, there?
Yes, sir.
Right. Now, what happens is, generally, we know that your break-even point is nothing but fixed cost divided by contribution per unit. Correct? Now, fixed cost, I know it's 1600. Now, contribution per unit, which one should I take? Should I take 8 or should I take 4 or should I take both? Right? This is where the case becomes little interesting when it comes to your sales mix. Now, basically, you tell me, guys, logically, you tell me, this 1600 rupees of fixed cost is being incurred not only for selling units of X, it is also towards units of Y, correct? Right? And what do you mean by a break-even point? A break-even point is a point of sale where I generate a contribution that is sufficient enough to recover my fixed costs. Now, this 1600 rupees should be recovered not just by any one of the two products. These two products should jointly go on to generate a contribution that is sufficient enough to recover my 1600 rupees. Agreeing with me on this? Agreeing with me on this? So here the contribution per unit is neither X nor Y. It needs to be a weighted contribution per unit. Are you clear with this? What is the meaning of weighted contribution per unit? They have given in this question that the sales will always be in the ratio of 2:1. Correct, guys? It will always be in the ratio of 2:1. Or in other words, every time I sell 3 units, if you see, 2 units will be X, 1 unit will be Y. This is the meaning, no? Guys, correct? Right? Every unit of X generates a contribution of how much? 8 rupee. Every unit of Y generates a contribution of how much? 4 rupees. So if you multiply this here, 8 into 2 is 16, 4 into 1 is 4. Totally, I end up generating a contribution of 20 rupees for every 3 units being sold. So representatively, the contribution per unit is going to be how much? 20 upon 3, it is going to be 6.6666 or 6.67. Are you clear with this, guys? This is the reason why here, when it comes to sales mix, we don't say it's fixed cost by contribution per unit. We use an additional word and call it as fixed cost divided by weighted contribution per unit. Are you clear with this? And how will you calculate the weighted contribution per unit? It is nothing but the contribution of a particular product multiplied by its weights. This calculation, this is nothing but, can I say this is 8 into 2 by 3 plus 4 into 1 by 3. Correct, guys? This is what we did here. Basically, we did 8 into 2 plus 4 into 1, the whole divided by 3. That only we are writing it like this. Or not, this is nothing but the contribution per unit into weights of each of the products. Are you clear with this, guys? If you do this, you get the weighted contribution per unit, and now with this you can calculate the break-even point. How do we do it? Let me just walk you through here. Now in this case, you look at it. Here, if you see, the weighted contribution per unit is going to be how much? 6.667, correct? Right? So now my break-even point is going to be fixed cost divided by weighted contribution per unit. So now please do not round it off, retain the decimals in your calculator, that is 6.66666666, right? So if you say 1600 divided by 6.66666666, right, you will get exactly 240 units. So what does it mean? I need to sell 240 units, right, to exactly recover my fixed cost. I need to sell 240 units of X or Y or both. I need to sell 240 units of both. So this 240 units of both means in what ratio? The mix is given. So this should always be in the ratio of 2:1. Are you clear with this? So out of this 240, 2/3 will be X units and 1/3 will be Y units. With that, you can calculate how many units of X and how many units of Y needs to be sold. Are you clear with this? Or in other words, in this case, first you calculate the break-even point by taking fixed cost by weighted contribution per unit. You will get the total number of units required to be sold. Multiply this with the mix or the weight of the product. You will get the product-wise break-even point. Are you clear with this? If I sell exactly 160 units of X and 80 units of Y, I will be in a position to break even. Are you clear with this, guys? Are you able to understand? Are you able to understand? Right? So when you have a mix of products, what is the formula to calculate your break-even point? Your break-even point is going to be fixed cost divided by weighted contribution per unit. Clear with this? Suppose you want to calculate the break-even point in values, what will you do? It is going to be fixed cost divided by weighted PV ratio. Are you clear with this? Take the PV ratio of the respective products and multiply it with what? Multiply it with the weights. Are you clear with this? That's called as a weighted PV ratio. Are you all able to understand, guys? Suppose what will happen if the sales mix is changed to 1:2? Once again, calculate the weighted contribution per unit. 8 into 1/3 plus 4 into 2/3. So this is what you get as your weighted contribution per unit. Fixed cost divided by weighted contribution per unit. So now you arrive at 300 units. Are you clear with this? So only if you sell 300 units, you will be able to recover your entire fixed cost. 300 units of what? X or Y or both? 300 units of both, right? Break it up and arrive at each and every component. So which means if I sell 100 units of X and 200 units of Y, I will be able to generate a contribution that exactly recovers my common fixed cost. Are you clear with this, guys? Right? You are all able to understand this. You're all able to understand this. This is how you need to calculate break-even points when a company is dealing in more than one products. Are you clear with this, guys? Right? I think this has been mentioned on the top here as a concept. Let me just walk you through that. Just a second. Where is it? Where is it? Where is it? 1 second. I think it's gone. Just a minute, guys. Yes, look at this. The overall break-even sales is going to be what? If the quantity mix is known, I will say it is sales quantity into your weighted contribution per unit. Or in other words, how do you do it is your fixed cost divided by weighted contribution per unit. If the sales value mix is known, you will divide the same by. You will take the fixed cost divided by weighted PVR. Are you clear with this, guys? Are you clear with this? Right? So the contribution value has to be how much? Quantity, the sales, if it is in units, you multiply it with weighted contribution per unit. If it is in value, multiply it with weighted PVR. Are you clear with this, guys? Right? This is what we have seen in the previous question that we just finished right now. Fine, guys. Done. Right? With that, the second sum is also over. Okay. Done. So now, what are the concepts left out? Okay. Let me also do this merger of plants. Okay, what do you mean by merger of plants? What do you mean by merger of plants? Now, guys, simple. Let's say I have a plant A and I have a plant B. Now I want to combine these two plants. Let us say these two plants are adjacent, right? There is a wall in between. Now I'm just removing the wall and making this into one, right? I'm merging two plants together, right? When I merge two plants, right, how will you apply the concepts of marginal costing? Nothing great, nothing great. You will think that, sir, this is nothing, sir. plant 1 plus plant 2 is going to be equal to the merged plant, right? Use the figures and calculate. Prepare an income statement for the combined sales, combined variable cost, combined contribution, combined fixed cost and all. With that you can do it. Absolutely correct. But in these questions, only one thing needs to be watched out for. Suppose they would have given the volume data and they would have mentioned that the plant A is working at 60% capacity, right? Let us say plant B is working at 80% capacity. Now you should always be careful. What you need to do is convert both the plants into 100% capacity, right? And then you add it up. Clear with this? Because 60% capacity of plant A and 80% capacity of plant B can't be added as such, because presently they are working at the 60% and 80% capacity respectively. When you are merging, what is totally available is 100% capacity. So you convert everything into 100% and then apply the concepts of marginal costing for the merged plant at 100% capacity. Clear with this, guys? An example is given here. Look at this. Company A is presently operating at a capacity of 60% and at 60% capacity level, they are generating sales of 300 crores or 300 lakhs or whatever it is, right? The VC ratio is 50%, which means the PV ratio is how much? 50%, right? And the fixed cost is 30 crores. Similarly, company B is operating at 90% capacity level with a sales of 540 crores, right? The VC ratio is 70%, which means the PV ratio is 30% and the fixed cost is 75. Now, when I am merging the two, I can't say, okay, company A plus company B, merged plant, sales is going to be 300 plus 540, so it is going to be 840. No, please do not do that. What you need to do, first convert both into 100%, because when two plants are merging, obviously what is getting merged is 100% capacity, right? Once you convert that, then you decide what needs to be your activity level of the merged firm. That is different. But when you are merging, you merge it at 100%. So now this is 300. Convert it into 100%. How will you do that? If 300 is 60, how much is 100, right? So the merged, the sales value at 100% capacity level of A is going to be 500. Similarly for B, it's going to be 540 divided by 90 into 100. That's going to be 600. Add the two. Now, if I'm merging these two firms, the total capacity sale is going to be how much? 1100. Similarly, they have given that the VC ratio is 50%. So here, obviously, apply this 50% on the 100% capacity level. So 50% of 500 is 250. Here it's going to be 70%. 70% on 600 is going to be 420, right? Add the two, you will get how much? 670, right? Now you get the contribution of the merged firm. Are you clear with this? So now you can say that the merged firm's PV ratio is going to be 430 divided by 1100. It's going to be 39.09%. Are you clear with this, guys? Are you clear with this? Now fixed cost, don't do the same thing for fixed cost also. Don't say fixed cost is going to be 30 divided by 60%. No, fixed cost remains constant irrespective of your activity level. So fixed costs are addable as such. Correct? No, guys? This 30 crores of fixed cost, what they have given here, whether this company operates at 60% capacity or it operates at 100% capacity, it will continue to be 30 only. That is the concept of fixed costs. If you say this is also 30 divided by 60 into 100, then you're treating fixed cost as variable cost. Are you clear with this? So fixed cost can be addable as such because they are not dependent on the capacity or the output level. So now what will I say? The fixed cost of the merged firm is 30 plus 75. How much is this? 105. Are you clear with this? So the break-even point of the merged firm is going to be your 105 crores, the total combined fixed cost divided by the PVR of the merged firm. So now I will say, look, I need to generate sales worth 268.61 lakh rupees in order to break even. Are you clear with this? This is post the merger. Are you clear with this, guys? Right? You guys are able to follow this, right? Next, one more thing. What is the sales required in the merged firm to earn a profit of 20 lakhs? Simple. So the required contribution will now be 20 lakhs plus 105 lakhs, right? So the required contribution divided by, take up the PV ratio of 39.9%, 39.09%, you will get the required sales to earn a profit of 20 lakh rupees. The remaining part are all similar to the basic concepts. The only thing that you need to know here is when you're merging two firms, convert both the firms into 100% capacity and then merge it. Clear with this, guys? Are you all clear with this, right? Yes, please respond, guys. Use the chat box. Are you guys there? The whole point of having a live session is only for that. Done, right? Fine. So sensitivity analysis is also done. Merger of plants is also done. Okay, so now we are left with a few more concepts. Just a minute. Let us just go and take the scoreboard. So this is done. This is also done. Okay, so I think we are just left with three more areas in this one, in this particular CVP analysis, and apart from that, we've also got something to do in absorption costing versus marginal costing. Right? Done. Not a problem. So now, guys, can we take a small break now, and we'll just come back and finish off the remaining part of the chapter? Yes, you guys want a break now?
Yes, sir.
Right? Okay. It's been about 2 hours plus. So yes, we'll take a break right now. Maybe we'll meet back at at 10:45 works, right? About 15 minutes break. Okay, great. Now let's move on to the next concept called as indifference point. Right, so now we are left with three concepts plus ones. So overall 4 concepts. We'll be doing it right away. So the next one is the concept of indifference point. Just a minute. Right. Now, what is this concept of indifference point all about? I'm using a short form, IDP. Now guys, right now we all have this, you all must be using this Geo SIM, right? But before 2016, that was before when Geo, entered the market with a bank. Now we all had the other players, like there were so many players, like Aircel, Uninor, there were so many players. And there was always one, decision that we all had to take in our real day, everyday life. So that was regarding prepaid versus postpaid. Now we don't have this decision to be taken, because anyways, though we all go for a prepaid plan, it's all unlimited calls and all that. But back then, these guys were looting us literally. They used to charge hefty amount, and they say we are complimentarily giving you 750 MB per month, it seems. So now we use about 2 GB per day. So that's what they used to do quite a while back. That was before 2016 when Jio entered the market. Now guys, using this example of a prepaid versus postpaid SIM, we can understand the concept of indifference point, and let's see what it says. Now in prepaid SIM, generally what happens is, now they will say per call you need to pay how much? 50 pice. An example I'm saying, they will say per call, or let's say per minute of talk time, you need to pay 50 pice, right? And since we are giving you that SIM card and we are blocking the number for you, that is, they are giving you the mobile number, so the SIM usage charges monthly is going to be 100 rupees. Or in other words, here the variable cost is going to be 50 pice and the fixed cost is going to be 100. Whereas if you go for a postpaid plan, what they will say is, look, it's a postpaid plan. That is, you can talk for how many number of hours you want. It's fine. At the end of the month, we will prepare a bill and we will give you, right? So what happens here is, per minute, they will charge us, let us say 30 pice, right? That's 0.3 rupees. Okay. And they will say monthly rentals for us is going to be 500 rupees. Generally what happens in a postpaid plan, if you see, they will have a monthly fixed charges, right, which is slightly higher, and they will be having a lower cost per every minute of talk time. This is how it used to be. And of course, in the prepaid, if you see, the fixed cost will be less, right? But every time you make a phone call, the charges will be high. Now, you tell me guys, out of prepaid or postpaid, which one is better? Out of prepaid or postpaid, which one is better? Now, there is no one such answer, a flat blanket answer saying always prepaid is better or always postpaid is better. Had that been the case, then there would have been only one plan. They wouldn't be having two plans, fully aware of the fact that always one plan is better than the other. Now, sir, how are you saying that, we can't come to a conclusion like that? Because both the alternatives have one disadvantage and one disadvantage. In case of a prepaid plan, the advantage is by way of a lower fixed cost. Whereas in case of a postpaid plan, the advantage is by way of a lower variable cost. Clear with this, guys? So now imagine you are a person who is a missed call party, right? So that is, you will not call anyone. Now suddenly after Jio, everyone started becoming generous. They didn't become generous. That is because of unlimited talk time now being available. But before, let us say you are a missed call party, you don't want to spend much, but you need to have a mobile number for sure. Which one will you prefer? You will only prefer prepaid. Why? Because anyways you are not going to make much calls, right? You just need to have a number. You will go for that option that gives you a lower fixed cost. Correct, guys? Yes, the reason is that anyway your volume is less. Correct? The number of phone calls you will make is less. If at all once in a while I make a phone call, it is okay. I am ready to pay some 0.5 rupees instead of 30 paise. I am ready to pay 50 paise. That is fine. But I will not be ready to commit a higher fixed cost. 500 rupees and all, I will not be ready. I will obviously go for the option that has a lower fixed cost. Correct? Suppose you are a businessman, you need to make a lot of phone calls necessary. Now, predominantly since your volume is higher, your overall cost will be having more of a variable component. So you will be driven by that alternative that gives you a lower variable cost. So now in this case, it makes sense to go for a postpaid plan. Or in other words, to put it simple, when your volume is less, it is always better to go for that option that has a lower fixed cost. And when your volume is high, it is always preferable to go for that option that has a lower variable cost per unit. But there will be exactly one point where both the alternatives will give you the same result, and that point is called as an indifference point. You are not being different to the both alternatives. It's called as an indifference point. Are you clear with this? Right? Are you clear with this? So the point, again, the point here is what? The point of volume, the point of sale, where both the alternatives will give me the same cost, right, is called as my indifference point. Now, how do you calculate the indifference point? Very simple. I need to find out at what point of volume both the alternatives will give me the same cost. Let the volume be X. We need to calculate X only right now. So, alternative 1's total cost will be how much? 0.5X plus 100, correct? We should be equal to 0.3X plus 500. Yes, guys? Right? So now this is going to be 0.5x minus 0.3x. I am bringing this to the LHS and taking this forward to the RHS is equal to 500 minus 100. Correct? Right? Or in other words, I will take x common out here and say x the whole into 0.5 minus 0.3 is equal to 500 minus 100. Or in other words, x is equal to 500 minus 100 divided by 0.5 minus 0.3. This is nothing but 400 divided by 0.2. How much is 400 divided by 0.2? That is going to be 2000. Are you clear with this? 2000 units, or in this case, I will say 2000 calls. If you are a person who knows that in a month you will definitely make 2000 phone calls, right? If you're exactly making 2000 phone calls, whether you go for a prepaid plan or you go for a postpaid plan, your final bill amount will be the same. But if you are planning to make a number of phone calls which is less than 2000 numbers, which is less than 2000 phone calls, in that case, it is preferable to go for prepaid because it has a lower fixed cost. No, sir, I'm a businessman. I'm going to make more than 2000 calls. Now, predominantly, your total cost will be driven by variable cost. So, you go for that option that gives you a lower variable cost per unit. Are you clear with this? Or in other words, how this indifference point concept helps us is, so there is an indifference point in this case, which is 2000 units. Right? In this case, it's a phone call. Suppose, let's say a company is manufacturing. They have two alternative ways of production. Right? Which alternative should I go for? Using both, let's say machine 1, machine 2, right? One machine has a higher fixed cost, lower variable cost. Another machine has a lower fixed cost, higher variable cost, as the case may be. Now, in this case, which machine should I use for production? First, you calculate the indifference point, right? If your planned volume is less than your indifference point, go for that option that has a lower fixed cost. And if your planned volume is more than your indifference point, go for that option that has a higher, again, talk in terms of advantage. So that has a lower variable cost per unit. Are you clear with this, guys? And at exactly the break-even point, whether I go for alternative 1 or I go for alternative 2, I will end up getting the same result. And this is the concept of indifference point. Clear with this, guys? So how do you calculate indifference point? If you look at this, it is nothing but difference in fixed costs divided by difference in variable cost per unit. Are you clear with this, guys? Are you clear with this? So your indifference point formula calculation is going to be difference in fixed cost divided by difference in variable cost per unit. Are you clear with this, guys? Done? You guys are able to understand this? You guys are able to understand this? Now, let me just add up one more, let me just continue with this example. Let us say we are running a call center. Okay. Let us say we are running a call center. Now, in this call center, so what is the work of a call center? Basically, a bank will hire a call center. They will say, in a month, you need to call and disturb so many number of customers. Correct? So that's why we keep getting a lot of phone calls for all these loans, credit cards and all that. Why are they doing? Are they doing it because they like you or they want to talk to you? Absolutely no. They have targets. Correct? So that is the reason why they do it. Now, let us say a bank has approached us. We are running a a call center. They are saying, look, for every call you make, I am going to pay you 1 rupee. For every call you make, I am going to make you 1 rupee. Now you tell me, guys, will the bank be bothered whether I use a prepaid SIM or a postpaid SIM? No. The bank is not going to get bothered whether I use a prepaid SIM or a postpaid SIM. Correct? Now, what happens if I use a prepaid SIM, if I use a postpaid SIM, right? The scenario will be as follows. The selling price will be 1 rupee. That is from the perspective of the call center. It anyways will get 1 rupee. Correct? No? Whether I use a prepaid SIM or a postpaid SIM, per call I will get 1 rupee. Who will pay me? The bank will pay me. Correct? Right? Minus variable costs. If I use a prepaid SIM, my variable cost is going to be how much? 0.5 rupees. Whereas if I use a postpaid SIM, my variable cost is going to be how much? 0.3 rupees. Correct, guys? Yes. Now, what's going to be my contribution per unit? My contribution per unit or per phone call is going to be 0.5 if I use a prepaid SIM, and it's going to be 0.7 if I use a postpaid SIM. Correct? Now, what will be the fixed cost? The fixed cost will be, if I use a prepaid SIM, it's going to be 100. If I use a postpaid SIM, it's going to be 500. Clear with this, guys? Now, in this case, now, what is the indifference point? Indifference point is the point, right, where both the alternatives will give me the same amount of profit. Correct, guys? Indifference point is that point where both the alternatives will give me the same amount of profit, right? The results could be either calculated as a cost or the results can be calculated from the profit angle. Correct, guys? So now, at what point of sale, or in other words, how many phone calls should I exactly make so that whether I use a prepaid SIM or I use a postpaid SIM, both will give me the same profit. So now I need to calculate the X value, which is nothing but the indifference point. Can I say the profit generated by a prepaid SIM is going to be 0.5x minus 100 rupees. Correct? Yes, guys. Right? Minus 100 rupees. Similarly, this will be equal to the postpaid's profit is going to be 0.7x minus 500 rupees. Right? The profit is going to be contribution minus fixed cost. Guys, correct? Or in other words, can I say this is nothing but 0.5. Okay. So let me just bring it up here. So this is going to be 500 minus rupees 100 is going to be equal to 0.7x minus 0.5x. Correct? Right? Or in other words, again, so here I will just take x out in common and say it's 0.7 minus 0.5 is equal to rupees 500 minus rupees 100, or here x is equal to rupees 500 minus rupees 100 divided by 0.7 minus 0.5. So this is going to be rupees 400 divided by 0.2. So how much is 400 divided by 0.2? Once again, that's going to be how much? Same 2000. Are you clear with this? So exactly if I am planning to make 2000 phone calls, that is at the indifference point of 2000 phone calls, right? Whether I use a prepaid SIM or I use a postpaid SIM, both alternatives will give me the same amount of profit. Clear with this? Suppose I am planning to make a lesser phone call, I mean a lesser number of phone calls, that is if my volume is lesser than the indifference point, then what you need to do, you go for that option that gives you a lower fixed cost. Clear with this? Suppose you are planning for a volume which is more than the indifference point, you go for that option that gives you a higher contribution per unit. Lower variable cost means what? Higher contribution per unit only, no? Are you clear with this, guys? Right? It gives me a higher contribution per unit. Are you clear with this? Or in other words, I can also say that my indifference point calculation is nothing but difference in fixed cost divided by difference in contribution per unit. Agreeing with me on this? Because the difference in contribution per unit is purely nothing but happening because of difference in variable cost per unit only. Are you clear with this? In both the scenarios, the selling price is the same. Still, why am I having a different contribution? It is because of the change in variable cost. So the difference in variable cost is equal to the difference in contribution. Are you clear with this, guys? So in this case, can I say that indifference point is nothing but difference in fixed cost divided by difference in variable cost per unit, or I can also say it is difference in fixed cost divided by difference in contribution per unit. Are you clear with this, guys? Are you all able to understand? Right? Indifference point means what? It is a point of sale, clear, at which two alternatives are giving me the same result. Right? Clear with this, guys? Now since it is a point of sale, this can also be expressed in value, correct? If I want to express in units, I do it like this. If I want to express in value, what will I do? Instead of variable cost per unit, I will use VC ratio. Instead of contribution per unit in the denominator, I will use PV ratio. That's about it. So it will be difference in fixed cost divided by difference in VC ratio, or it is difference in fixed cost divided by difference in PV ratio. Are you clear with this? Now, what am I going to do? Why do I need an indifference point? Only if you calculate an indifference point, right, you will know when to choose which alternative. If the volume level is going to be lesser than the indifference point, always go for that option that gives you a lower fixed cost. If the desired volume is going to be greater than the indifference point, always go for that option that gives you a lower variable cost, or you can, in other words, you can say a higher contribution per unit. Are you clear with this, guys? Right? In your everyday life, you can use the concepts of indifference point. Now, another real life example for indifference point would be, right, in your everyday life, you can maybe help your parents with this, whether to buy a water can or whether to buy an aqua guard and keep it. If you buy an aqua guard, the fixed cost will be high. You will not be having any variable cost, because anyways you take the water from the tap, correct? Whereas on the contrary, if you are buying a water can, right, the variable cost will be high. Every time you buy a can, you need to pay him 30-40 rupees, whatever it is, right? Whereas the fixed cost might not be much. So now when will you go for which alternative depends on the water consumption in your house. If you are a joint family, it makes sense to buy an aqua guard. If you are a nuclear family, it really makes sense to buy a water can, because the consumption will be relatively less. These kind of practicalities you can apply in your everyday life as well, and that is about the concept of indifference point. Now clearly understand, guys, the concept of indifference point comes into picture only when I am evaluating two different alternatives. Do not mistake your indifference point as break-even point. Break-even point, I need not have two alternatives. Break-even point is given a fact, given a particular product's income earning capacity, like sales, contribution and all. For this, when will I recover my fixed cost? That's all. There is not much of comparison between another alternative. The concept of indifference point will kick in only when I need to evaluate between two alternatives and take the best one out of it. Are you clear with this, guys? Right? Yes, you guys are clear with this. Please use the chat box. Just tell me if you guys are understanding this. We'll proceed to the next one. And let's see, is that about the number of questions we've got here? Yes, I think that's about this particular concept as well. Okay, So now look at this. This is what we have mentioned here. You can just be, you can just go through it once. That's about the concept. It's nothing but your change in fixed cost divided by change in variable cost per unit, or in other words, it's change in fixed cost divided by change in contribution per unit. And if your expected volume is exactly at the indifference point, you can go for any option. Less than your indifference point, you should always go for the lower fixed cost option. If your volume is expected to be greater than the indifference point, go for the option that has a low variable costs, or in other words, I can say a high contribution per unit. Are you clear with this, guys? Right? And that's about this particular concept of indifference point. See, this is what they are saying, right? At the indifference point, the two alternatives are better, right? Two alternatives will give you the same result. Below the indifference point, if you see, one alternative is better than the other. Beyond the indifference point, the second alternative is greater than the first one. Clear with this, guys? And that's about the concept of indifference point. And I think, yes, they have given one example as well. Let's quickly do this. Now, let's say I can carry out the production either using machine 1 or machine 2, right? If I use machine 1, the fixed cost is 1 lakh, but the variable cost is 5 rupees. If I go for machine 2, the fixed cost is 60,000 only, but the variable cost is more, 9. Now, which machine is better? Now, I can't come to a conclusion on the face of it, because machine 1 has an advantage of a lower variable cost, whereas a machine 2 has an advantage of a lower fixed cost. Both the alternatives are having one advantage and one disadvantage. Only then, the concept of indifference point will kick in. If, let's say, only one option has all the advantages, then I need not even take a decision. I will only go for that. Are you clear with this, guys? Right? So now in this case, what happens, right? Find the indifference point and recommend the range of activity where one machine is better than the other, and suggest which one to buy if the production is 12,000 units. So now what do? The cost indifference point is going to be the difference in fixed cost divided by difference in variable cost per unit. So here the difference in fixed cost is 40,000, difference in variable cost per unit is 4. So 40,000 by 4, it's going to be 10,000 units. So now what will I do? If my desired volume is exactly 10,000 units, whether I use machine 1 or I use machine 2 for production, it's going to give me the same total amount of cost, correct? If my desired volume is less than 10,000 units level, then here I should go for that alternative that has a lower fixed cost. That is, I will go for machine 2, correct? And if my desired output level is greater than my 10,000 units level, the indifference point, now it makes sense only to go for that option that gives me a lower variable cost per unit. Are you clear with this, guys? This is the reason why, if you see startups, what they do is they don't invest huge amount in fixed cost. If you look at small companies which are just starting up, at the beginning stages, they will not buy any office space. They will take it on rent because they don't want to commit a huge fixed amount. The moment they grow big, now they buy multiple properties and keep, because now their volume is increased. They will be heavily driven by variable cost. Now they can't afford a high variable cost. They are fine with a high fixed cost. That's when they will end up buying properties for themselves. Clear with this, guys? These are some real life scenarios where indifference point can also be used. Done, guys? And that's about this particular segment. Look at this. If the expected level is greater than 10,000 units, so you go for what? M1. And if it is less than 10,000 units, go for M2. And exactly at 10,000 units, you use any machine. And to answer the second part of the question, so if my expected volume is 12,000 units, it's beyond 10,000, so I will go for the first machine, right? Go for M1. Clear with this, guys? And that is about the concept called as indifference point. Clear with this? Shall we move on to the next one? Guys? Yes. Okay. Now, next one is a concept called as shutdown point. Now this concept again is an extension of indifference point, but it's slightly different, and let me tell you what it is. So this area is also known as shutdown or continue decision. Shutdown or continue decision. Now, what does this concept talk about? I mean, what are we going to learn in this particular concept? Now, let's say I am running a company and it's super successful. It is super successful, not at all a problem. Suddenly, COVID came. Suddenly, a temporary feature is hindering my business. Okay, a temporary feature is hindering my business. Now Now the government has announced a lockdown, let us say for the next 3 months. Okay, now what happens, the decision that we are going to take here is there is going to be a temporary downfall in the market, right? A temporary downfall in the market. Now during this 3 months, I know that before this period my business is running fine. After this 3 months also my business is going to run super fine. I don't have a problem with that, but I know that there is going to be a temporary hindrance in my business. Now during this time I know that the market is going to be dull. The decision that we are going to take here is, should I shut down my business temporarily for the next 3 months, or should I continue? The question is not about a permanent shutdown. We are not taking a long-term decision. If there is a temporary recession in the market, right, does it make sense for me to continue, keep my shop open for those 3 months also, or is it better to keep it shut down? Clear with this, guys? This is the decision that we are going to take here. Now let me just give you an example. Let us say, example, guys, I am running a physical academy. I am running a physical institute, a physical academy, CA coaching. Example I'm saying. Now what happens is, now during this COVID time, institute cancelled one attempt. You know that, right? I think in 2020, yes, they cancelled one attempt. May attempt was cancelled, I think so. Now let us say that, okay, I am running a physical academy. I'm being very clear because only that will relate to this example. A physical academy I have where students will come and attend. Now what happened is there was this attempt got cancelled by the institute, right? Now I have to decide whether I need to keep my shop, that is the physical academy, I need to keep it open for the next 6 months or not, because I know that till now many students were coming. Even after the 6 months also many students will come. The question is only about the temporary period of the next 6 months. Should I keep my business open? That is, should I keep my shop open or should I shut it down? Basically meaning what? If I shut down, will there be any benefit and all? I need to analyze. Clear with this? Now what will be the cost and benefit of shutting down? If I shut down, what will be my benefit and what will be my cost? Now let us say I am running this academy, I told you, and let us say that I have hired faculties also for other subjects. Example I'm giving you guys, right? Now what happens? There are two types of fixed costs that I am incurring in this particular business model. One is called as an avoidable fixed cost. The other one is called as unavoidable fixed cost. Now what is an example of avoidable? What is an example of unavoidable? Now let me say I have taken a place on rent, right? Now irrespective of whether the next attempt is going to get conducted or temporarily if I shut down or keep it open, definitely I need to pay my landlord. Correct, guys? I need to pay my landlord for sure, right? So let us say I need to pay about 1 lakh rupees every month as a rent. Now that is, rent is an example of unavoidable fixed cost. Are you clear with this? Right? Now I also hired faculties, right? And let us say I am paying the faculties a fixed amount if they conduct one batch. If you take one batch, I will give you so much amount of money, right? Now the faculty fee is an example of avoidable fixed cost. Sir, how is it an example of avoidable fixed cost? Suppose the next batch is getting cancelled, the faculties need not come and take, right? So if they are not coming and taking, I need not obviously pay them. Are you clear with this? Sir, is it a variable cost? No, it doesn't depend on the number of students who enroll. I just pay them a flat fee. Example I'm giving you, right? Now a faculty fee is an example of avoidable fixed cost, whereas a rent is an example of unavoidable fixed cost. I need not pay the faculty any fee if the batch is not conducted, whereas I need to pay my landlord the rent irrespective of whether the batch is conducted or not. Are you clear with this? Now in this scenario, what happens is, if I shut down the business, now what will be the benefit for me? I can save the avoidable fixed cost. Correct? No? If I'm shutting down the batch for the next 6 months, if I'm shutting down my business, what happens is the faculty fees need not be paid. Are you clear with this, guys? Right? The faculty fees need not be paid. That is one savings for me. Right? Now, what will be the cost? What will be the cost? Now, there are two types of costs that I incur. The first one is called as shutdown cost. Now, this shutdown cost is not unavoidable fixed cost. No. Because I am shutting down, I will be incurring some extra cost. For example, let us say I have a factory during the COVID time, many people shut down their factories, correct? Now, you know what? When the machines are being run every day, it is slightly easier to maintain. If the machines are not being run, they require some additional maintenance. A typical example is during COVID time, they had imposed lockdown restrictions and you guys would have been having your vehicles and all, no? Right? You were supposed to not take your vehicles outside. I don't know whether you did, but yes, we're not supposed to take it. Let's say you never touched your vehicle for about 1 month. So on the 31st day, when the lockdown got lifted, so the first place that you visit is the mechanic shop, correct? Because when a particular engine is not being used, a machine is not being used, it requires some additional level of maintenance. Had you maintained it properly during those 30 days, maybe then your your vehicle would be working properly. So why am I saying this? When you are shutting down, you need to spend some extra money on maintaining your machines. This otherwise I will not be incurring. Are you clear with this, guys? So if I am shutting down, extra what I will be incurring, the extra cost is shutdown cost. Are you clear with this? And there is also one more thing, the contribution lost on shutdown period demand. On shutdown period demand. On shutdown period demand. What is it? Now, I know that generally every batch, example I'm giving you, 100 students will come and attend face to face if I announce a batch, right? Now, during the COVID time, even if I announce, only 5 people were ready to come. Example I'm saying, suppose I shut down, right? That 5 people's contribution that I will be earning, that also I cannot earn, correct? No, that is, if I shut down, I will be losing out on the contribution that I could have possibly made during the shutdown period demand. Are you clear with this, guys? Are you clear with this, guys? So basically, there is a cost benefit analysis that needs to be done. If I shut down, the benefit is savings in avoidable fixed cost. That's all. And if I shut down, I need to incur 2 additional costs. One is the shutdown costs. That is the additional cost that I need to exclusively incur if my business being shut down, and the other one is if I'm shutting down, I lose out on the contribution that I can possibly make during the shutdown period demand. Clear with this, guys? Clear with this, guys? Now I need to evaluate this cost and benefit, right? If my benefit is greater than the cost of shutting down, then I will go and happily shut down. If not, then I will continue. Are you clear with this, guys? Right? Now let me just give you an example. Let us say I am just shutting down. Oh, one second. Yeah. So now let us just take an example. Let's say I'm planning to shut down, right? And the benefits and cost details are as under. Let's say the avoidable fixed cost is going to be 1 lakh rupees. This is the amount I will be saving. Okay. And the cost will be, if I shut down, I will be incurring a shutdown cost of 40,000 rupees, right? Of 40,000 rupees. And let us say the contribution lost will be, during the shutdown period, I am expecting my demand to be 3,000 units only, right? And every unit gives me a contribution of 4. Example I'm giving you, right? So now what will be the contribution lost? If I shut down, even these 3,000 units I will not be able to sell. So the contribution loss will be how much? 32,000 rupees. So now you tell me, if I shut down, the benefit is how much? 1 lakh, but I am only losing how much? The cost is going to be 72,000. So I will be having a net benefit of how much? I will be having a net benefit of 28,000. Now in this case, it makes sense to shut down, correct? I will say, sir, fine, please shut down, because the benefit of shutting down is more than the cost of shutting down. So it's going to be a 28,000 rupees is the net benefit. You do it. Clear with this, guys? Now, same example. Yes, hello.
The contribution loss is 3,000 or 8,000. 3,000 into 4 or.
It's 3. I'm sorry, it's 8,000. I'm so sorry. Yes, it's 8,000 into 4. Right, you're right. It's 8,000 into 4. I'm sorry. I just, thanks for telling me that. It's 8,000 units. Okay. So it's 8,000 units into 4, right? So the contribution loss is going to be 32,000 rupees. So assuming that during the shutdown period, the demand is only going to be 8,000 units. Generally, I'm running a business where I'm going to sell 1 lakh units every month. Then I will not be having a question of shutdown and all. Now, because of some temporary phenomenon during this period, there is going to be 8,000 units of demand only. Now, because of this recession, I am thinking. Clear with this, guys? So yes, I stand corrected. It is 8,000 units is going to be the shutdown period demand with a contribution per unit of 4. So now the contribution loss, if I shut down, I cannot even honor this 8,000 units of sales. So it's going to be 32,000 rupees. Clear with this, guys? Now I am just giving another example with a small change. Now let us say in this scenario, again the avoidable fixed cost is going to be the same 1 lakh rupees, right? And if I shut down, the shutdown cost will continue to be 40,000 rupees. I'm just making one change. During the shutdown period, I am estimating a demand of 20,000 units instead of 8,000. Now I am expecting a demand of 20,000 units. So now you tell me, so the contribution loss will be how much? 20,000 units into 4, correct? So if I shut down, I'm losing out on 20,000 units of sale, which each of which can generate me a contribution of 4 rupees. So that is going to be how much? 80,000 rupees. Are you clear with this? So now this is going to be how much? I will be losing out 1,20,000, but I will be getting a benefit of 1 lakh rupees. So now tell me, if I shut down, the costs of shutting down is much higher than the cost of, the benefits that I get out of shutting down. Here it is going to be a negative 20,000. The net benefit of shutting down is going to be a negative 20,000. Or in other words, in this scenario, it makes sense for me to continue my business, even though there is my business is not up to the mark, I know. But even in this scenario, it makes sense to continue because the benefit of shutting down is less than the cost of shutting down. The costs are more. If I shut down, the costs are more. So it's better to continue. Are you clear with this, guys? Are you clear with this? Or in other words, once again, the hero of this area is what? The demand, the volume. That's why we call this marginal costing as cost volume profit analysis. So, sir, when should I shut down? When should I continue? The decision depends on the shutdown period demand. If you're having a very good demand, right, you can actually, no problem, you can continue. If you're having a very low demand, then you should definitely shut down. But there is an exact point where whether you shut down or you continue, you will be indifferent. That is basically what your benefits will be equal to the cost, correct? No, that point is called as shutdown point. Why do we need to calculate the shutdown point? If your shutdown period demand is expected to be greater than the shutdown point, then it's always better to continue. If your shutdown period demand is less than your shutdown point, then you should always shut down. And at the shutdown point, if you want, you continue, or you don't want, you don't continue. But anyways, it is going to be the same benefit. Are you clear with this, guys? So now, how do I calculate the shutdown point? The shutdown point is a point of, the volume or the demand where my benefit is equal to cost. Agreeing with me or not? Or in other words, can I say it is going to be 1 lakh is equal to 40,000 plus 4x. That is, I need to calculate x. X means what? The shutdown point, that is exact demand. Clear with this? The demand, the shutdown period demand, which makes my benefit equal to cost. Here the benefit is 1 lakh. The cost is going to be 40,000. That is your shutdown cost plus your contribution loss of 4x. Clear with this, guys? So now, how do I calculate this? Can I say 4x is equal to 1 lakh minus 40,000, right? Or x is equal to 1 lakh minus 40,000 divided by 4. So how much is this? This is going to be 60,000 divided by 4. That is going to be 15,000 units is my shutdown point. What is the meaning of this? So the shutdown point of 15,000 says that during the next 6 months, right? If I am expecting a demand of less than 15,000 rupees, it is better to shut down. If I am expecting a demand of more than 15,000 rupees, then the market is vibrant. only then it makes sense to continue. If it is going to be exactly 15,000 rupees, whether I shut down or I continue, I will be getting the same result. Are you clear with this? The formula for shutdown point hence is nothing but avoidable fixed costs minus shutdown cost divided by contribution per unit. This is also nothing but difference in fixed cost divided by difference in contribution per unit. So then only one contribution per unit is there, no sir? Because if I shut down, I will not be selling anything, correct? So the contribution of that alternative is 0. This 4 rupees is the contribution that I will be getting only if I continue, right? So it's ideally 4 minus 0. Are you clear with this? So this is actually based on the concept of indifference point, but clearly understand my shutdown point formula is going to be what? Avoidable fixed cost minus shutdown cost, the whole divided by contribution per unit, right? Again, shutdown point is nothing but a demand or a sales volume. If you want to express this in value, shutdown point in rupees is equal to avoidable fixed cost minus shutdown cost divided by what? Divided by PV ratio. Are you clear with this? Wherever demand comes in, whether as sales or as break-even point or as margin of safety or as indifference point or a shutdown point, right? Wherever you are using contribution per unit, replace it with PV ratio to arrive it in value. Are you clear with this, guys? Right? This is the formula which can be logically arrived. It is a point where my benefits is equal to cost. So if your expected volume is greater than shutdown point, please continue your business temporarily only. All these are temporary decisions. If it is going to be if your expected demand is going to be less than your shutdown point, then it makes sense to shut down your business. Are you clear with this, guys? You guys are able to follow this? You guys are able to follow this, right? Fine. And that's what has been mentioned here. Okay. So now, yes, look at this. This is the formula. Avoidable fixed cost minus shutdown cost divided by contribution per unit. Okay. And if your expected sales is going to be less than the shutdown point, you shut down. And if it is going to be greater than the shutdown point, you continue. Clear with this, guys, right? There's one question given here. I think it's just relating to, yes, look at this. The selling price is 20, the variable cost is 14, the fixed overheads is going to be 7,92,000. How many units should be sold to earn a 10% of the takings? Takings means what? Takings means sales. Clear with this? So how many units should be sold here? So now, how do you find this out? It's pretty much simple. So now what you need to do here is, okay, so again, put up the marginal costing income statement. Sales minus variable cost gives you contribution, minus fixed cost gives you profit. Right? So your sales is going to be, so they've given the selling price, so 20x, variable cost is going to be 14x, so your contribution is going to be 6x, right? Your fixed cost is going to be 7,92,000. So they are expecting a profit of 10% on sales. So 10% on 20x is going to be 2x, correct? So now we have framed an equation. 6x minus 7,92,000 is going to be equal to 2x, or in other words, 6 minus 2, 4x is equal to 7,92,000. X is equal to 792,000 divided by 4. That gives you how much? 1,98,000, right? So you need to sell 1,98,000 units to earn a 10% profit. This is very simple. Now, the second part of the question is relating to shutdown point. Calculate the shutdown point if 30% of the fixed overheads are avoidable and interpret the result. Now, what they are saying, out of a total fixed cost of 7,92,000, 30% of it is going to be avoidable, correct? 30% is going to be avoidable. Clear? Now in this case, what do? Shutdown point, what is the formula? Shutdown point is equal to avoidable fixed cost minus shutdown cost divided by contribution per unit. Now, what's my avoidable fixed cost? Avoidable fixed cost is 30% on 7,92,000. So 792,000 into 0.3. How much is it? 2 lakh. So it's going to be 2,37,600. Now, what many students do and commit a mistake is they take the balance 70% as shutdown cost. No. See, unavoidable fixed cost is not shutdown cost. Shutdown cost means what? Because I'm shutting down, what is the extra cost I incur? In this question, have they given anything? Have they given any shutdown cost? No. Which means in this case, the shutdown cost is 0. Which means I did not spend any extra money because I'm shutting down. Are you clear with this? Right? divided by the contribution per unit. In this case, the contribution per unit is going to be 6 rupees. So now how much is that going to be? 237,600 divided by 6. It's going to be 39,600 units. Are you clear with this? So if during the shutdown period, you are expecting a demand of less than 39,600, you please go ahead and shut down. The market is not vibrant. It is not feasible for you to run the show, right? If you are expecting a shutdown period demand to be greater than 39,600, then it's always better to continue, because the benefits will be, it's better if you continue the business, right? And at the shutdown point, you either shut down or continue, both will give you the same result. Are you clear with this, guys? Right? And that is about the concept of shutdown versus continue decision and the shutdown point area. Clear with this, guys? Any issues? Any problem here? Guys, done? Shall we proceed forward? Let's move on to the next concept called as key factor analysis. Just a minute. Yes. Now, let's move on to the next concept called as key factor or limiting factor. So, key factor stroke limiting factor analysis. I hope the YouTube live is fine. Guys, can you just respond on the chat box, please? I just want to make sure that the live is functioning fine. Is it? Okay, great. Okay, thanks Aarti, thanks Murthy. Yes, Aishwarya. Fine, great. Okay, guys. Yes, Gokula. Fine. Okay, Anup. Okay, fine. Now looks like it's working fine. Now, guys, coming on to the another important concept here, which is called as key factor or limiting factor. Again, guys, let me give you an example. Please catch up running notes for this. Now, what is this concept all about? Now, let's say a company is in the business of manufacturing two products, A and B, right? The selling price, variable cost, and the contribution per unit details are given as follows. Now, A and B, just a second. Yes. So every unit of A has a selling price of 10, variable cost of 6. So that gives it a contribution of 4 rupees. And let's say product B also has a selling price of 10. The variable cost is only 4 and the fixed cost is going to be, the contribution per unit is going to be 6 rupees, right? Now, you tell me, guys, which of the two products will you manufacture? Product A or product B? Product A or product B? You will manufacture which of the two products? Product A or product B?
Product B.
Product B, is it? Okay. Now, I would say, why should I take a decision? Why should I say product B? I want to manufacture both the products. As long as a product is giving me a positive contribution, I will be happy to produce both, no? Who is asking me? So contribution per unit can be more. I will also sell unlimited units of B. I will also sell unlimited units of A. What is the problem? Clear? So practically speaking, who is limiting me on telling that no, only produce B? Right? I'm finding another profitable product. Relatively, it is lesser, right? So what? I can produce both, together, right? So why am I taking this example is, when there is no constraint or when there is no scarcity of resources, right? I can go for all the options. I need not say that only one or only two, right? The question of choosing between which one to do happens only when there is some scarcity or there is something that limits my production. Are you clear with this? Suppose I am saying, no, maximum you can produce only 10,000 units, right? Whether A or B, maximum 10,000 units only can be produced. Now you tell me, now I will say, now I want to produce B only more, because that gives me a higher contribution per unit. I will go for it. Are you clear with this? Or in other words, only when there is a constraint or a scarcity will there be a question of choosing which one to produce. Are you clear with this? If I don't have a constraint, unlimited capacity I can have, I will try to produce as many number of profitable products as possible. Are you clear with this, guys? Are you clear with this? Right? Yashwant depends on fixed cost. No, it doesn't depend on fixed cost at all. It doesn't depend on fixed cost. Fixed cost is irrelevant for your decision making, because whether I produce A or B, my fixed cost will be fixed cost. Correct? In a factory, I'm going to pay a rent. Using the same factory, I can produce A as well as B. Right? Now, it has nothing to do with the factory rent, has nothing to do with which product I need to produce. So, fixed cost is completely out of this question. Right? Clear with this? Now, so the concept of key factor or limiting factor comes into picture only when there is a constraint. Now, let me just take an example here. Let us say both these products A and B, both of them use a common raw material called as raw material X, and raw material X has an availability of only 10,000 kgs in the market. Or in other words, let's say I have to import a raw material called raw material X. Using this raw material, I can produce both A as well as B. Clear? Both these outputs require the same raw material. Now, the government of India has imposed a restriction saying that, look, you can only import a maximum of 10,000 kgs, right? Now, raw material is a constraint, correct guys? Right? Raw material is a constraint, correct? Now, what happens? They are also giving me a data that, look, raw material X, for me to produce 1 unit of one unit of product A, it requires 1 kg of raw material X, and every unit of B requires 2 kgs of raw material X. Clear with this, guys? This is what they have given, right? And they have also mentioned the demand details. The demand details in the market, right? Product A has a maximum demand of 2000 units, and product B has a total demand of 8000 units. Clear with this, guys? These are the situations, these are the scenarios and constraints that we have got. Now you tell me, right, which product will you be interested in manufacturing? To which product will you give the topmost priority? Tell me, guys, to which product will you give the topmost priority?
Product A, sir.
Which product will you give the topmost priority? Yes. Now, some of you might feel that, sir, then what is the question here? Now, obviously, I will go for product B because it gives me a high contribution per unit. No. The actual answer is you need to give the top priority for product A. And let me tell you why. First of all, find out what is the constraint. Now, I know that there is a market demand of 2000 units of A and 8000 units of B. Suppose if I were to fulfill the entire market demand, tell me what is the total raw material X, quantity of raw material X that I will be needing. So 2000 into 1, right, plus 8000 into 2, 16,000. So if I want to fulfill the entire market demand by producing 2000 units of A and 8000 units of B, the total raw material required will be 2000 into 1 plus 8000 into 2. Agreeing with me? I need 18,000 kgs of raw material X. But how many kgs of raw materials X have I got? Only 10,000 kgs of raw materials X I've got, which means in this case, clearly I know that raw material X is a constraint, or it is a limiting factor. What do you mean by a limiting factor? A factor that limits your production. Are you clear with this? Now what I will do, I will not take the decision based on contribution per unit. I will take the decision based on contribution per limiting factor. Sir, what are you saying? So here product A and B are there. The contribution per unit of A and B is going to be rupees 4 and rupees 6 respectively, right? And then they have given that the kgs of raw material required, for every unit of A it's going to be 1 kg, for every unit of B it's going to be 2 kgs, right? So contribution per kg of raw material used is going to be rupees 4, and here it's going to be 6 divided by 2, it's going to be rupees 3 per kg. Are you clear with this? Now if you see, the rankings will be, I will give a first rank to product A and a second rank to product B. Sir, why, sir? Now in this case, guys, clearly we established the fact that raw material X is a limiting factor, it is a constraint, correct? Now if you see, no doubt product B has a high contribution, no doubt, per unit. But what happens? It takes 2 kgs of raw material X to generate 6 rupees of contribution. So technically speaking, every time I lift a kg of raw material and use it to produce product B, I earn only 3 rupees. Whereas though product A has a low contribution relatively, it has an advantage by way of a lower consumption. For me to generate this 4 rupees through product A, I only need to use 1 kg of raw material X. So if I lift to 1 kg of product X from my stores and use it for producing product A, then itself I can generate 4 rupees of contribution. Or in other words, every time I use a single kg of raw material for producing A, I earn 4 rupees of contribution. Whereas if I use the same raw material kg for producing B, net off I earn only 3 rupees per kg. Now, since raw material is a constraint factor, I need to use it so judiciously and properly. So I will go based on the contribution per kg of raw material, and that is the concept of limiting factor. Are you clear with this? So step one, what I do is, first I establish the fact that my raw material is a limiting factor. Then step two, what I do, I calculate the contribution per limiting factor and do the rankings. Clear with this, guys? Now I do step 3, which is allocation of the limiting factor. Allocation of limiting factor. Sir, how will you allocate the limiting factor? First, you will use the raw materials for producing product A. As many units of product A as possible, you do it. Then if there is any kgs of raw material left out, you use it for producing product B. Are you clear with this? How we do this is, we use this template, rank product units, kgs per unit, kgs and sigma kgs, right? So first rank product is product A. Now in the market, we know that the maximum demand for product A is 2000 units that I just told you, and every unit of product A requires 1 kg of raw material. So now to fulfill the entire market demand for product A, you would have consumed how many kgs? 2000 kgs, right? So now as of now, you've consumed how many kgs? 2000 kgs, that is sigma kgs, that is cumulative kgs. Now you go on to the second rank product, which is B. Now come from the back. After producing product B, that is A as well as B put together, what is the total raw material you would have consumed? 10,000 kgs, because that is the maximum you've got. Out of this 10,000, you've already consumed 2,000, which means only 8,000 kgs of raw material are left for producing what? Product B. Are you clear with this? This is nothing but 10k minus 2k, that is 10,000 minus 2,000. And every unit of product B requires 2 kgs of raw material, and I have only 8,000 kgs left for the purpose of producing product B. So max, how many units of product B can be produced? So I would say 8,000 kgs are available, and every unit of B requires 2 kgs. Max, I can produce only 4,000 units of product B. Now this is the best possible sales mix that can give you the maximum amount of profit given the limiting factor. Are you clear with this? So if you want to make the maximum profit given the constraint, now what you need to do is, you need to produce 2000 units of A and 4000 units of B. If you deviate from this, definitely your overall profit will be lesser only. Are you clear with this, guys? Are you clear with this? This is the concept of limiting factor. Are you clear with this, guys? Yes, done. Now, shall we quickly do one numerical problem in this regard? I've kept one numerical problem here. So, yes, it's question number 3, I guess. Yes, question number 3. 1 second. Yes, look at this. The following particulars are extracted from the records of a company. So, product A, product B there, right? So, they have given the sales, consumption of material. Every unit of A requires 2 kgs. Every unit of B requires 3 kgs. Material, direct wages, direct expenses, machine hours used is also given. The overhead expense, fixed is unitized and given, right? And variable is given. Now always remember, for the purpose of decision making, the fixed costs are irrelevant. Why? Whether I produce or not, anyways I'm going to incur it, right? Then why would I consider it? Are you clear with this? So fixed costs are not considered for the purpose of decision making. Now the direct wages per hour is going to be 5 rupees. So this is what they have given. Now A, comment on the profitability of each product, assuming that both the products use the same raw material, when A, raw material is in short supply, and B, the production capacity in terms of machine hours is a limiting factor. First, they are just asking you to comment on the profitability. That's all they are asking you. They are not asking you to do the allocation and all. They are just asking you to comment, which means what? When raw material is a limiting factor, what will you do? You will do the rankings based on raw material contribution per kg of raw material, correct? Similarly, when your machine hour is a limiting factor, you will take the decision based on contribution per machine hour. Clear with this, guys? Clear with this, guys? Right? So that is what you need to mention here. First, they have listed out the selling price and the variable costs. Finally, they have arrived at the contribution per unit of A, contribution per unit of B, and as I just told you, fixed cost should be ignored for the purpose of decision making, because as the name suggests, they are fixed. Okay, so based on your decision, this is not going to change. Clear with this, guys? Right? Now, ranking of the two products when raw material is a limiting factor. So contribution per unit is given. Contribution per unit is given. Yes.
Expenses are they having 15 rupees and 16 rupees?
Sorry, ma. What is it?
Direct expenses.
Direct expenses.
15 rupees and 16 rupees are they?
Okay, just a minute. I think there has been some. Okay, is this calculation coming out to be correct? 1 second.
No.
No. So then this is not 15 then. Then this has to be. This is 5, ma. I'm sorry. This is okay. Direct expense is 5. Right, this is 5 and this is 6. Sorry, that's a typo error. Thanks for pointing out. That's a typo error. So remove this. They have just done. The calculation is correct, I think. The calculation is correct, no? So it's 10 plus 15 plus 5 plus 15. So it's 30, 40, 45. Yes. Here it's 30, 45 and 51. Correct. Right. So it's they have just, it's a typo error, but the calculation they have considered only 5 and 6 respectively. Okay. Right. Hope your doubt is solved. Okay, so now yes, this is what it is, guys. So they have arrived at the contribution per unit. Now in case your raw material is a limiting factor or a constraint, what do? You take the contribution per unit of both the products divided by the kgs of raw material consumed. You will get the contribution per kg, right? Contribution per kg of raw material. Obviously, based on that, I will give a first rank to product A and a second rank to product B. Are you clear with this, guys? Are you all able to follow this? Right? Similarly, suppose in this case, machine hours is a limiting factor. Machine hours is a limiting factor. What will you do? You will take the decision based on contribution per machine hour. So you take the contribution per unit. Every unit requires 3 hours of machine hours and 2 hours of machine hours respectively for A and B. Right? You calculate the contribution per machine hour based on contribution per machine hour. So I will go for product B first, right? And then only if any machine hour is left out, I will use that towards producing product A. Are you clear with this, guys? Are you clear with this? Right? That is about this particular, that is about this particular part A. Now, one more thing I want to tell you, guys. One more thing I want to tell you. Limiting factor. So what could be a limiting factor? Raw material could be a limiting factor. Your direct labor could be a limiting factor. Your units could be a limiting factor. Your machine hours could be a limiting factor. Anything could be a limiting factor. Correct, guys? Guys, yes, you guys are able to follow this, right? Now, if raw material is a limiting factor, we saw in this sum, right? So what happens? I will first give the priority to product A. Anything left out, I will give it to product B. Correct? If machine hours is a limiting factor, I will give the first priority to B. Then anything left out, I will give it to A. Correct? Now, you might be having a doubt, sir, what happens? Can there be two limiting factors parallelly? In real life, that can happen, no? Import restrictions are also there. Local machine hours are also a constraint. Both together can also happen, right? So now, sir, if I do this based on raw material, which is also a constraint, it is asking me to produce product A first. But machine hours is asking me to produce product B first. There is a conflict of ranking. What will I do? In this case, marginal costing cannot be used. In this case, marginal costing cannot be used. Instead, you use a concept called as LPP, linear programming. You guys would have studied in your 12th standard that linear programming, some graphs will be there, shaded region and all. They will say maximize Z is equal to so and so, subject to constraints. They will say 3x plus 5 is less than or equal to so much. 4x plus y is greater than or equal to so much. So you will list the constraints and try to maximize your profit. Using a graphical method or a simplex table, you can arrive at your decision when you have more than one constraint that is anyways not there in your syllabus, in your inter syllabus itself. It's not there. It is a subject matter of discussion in CA final. But remember, those LPP which you would have already studied in your class 12th basics, that is your graphs and all. You guys remember that maximize Z is equal to something subject to constraints and all. They will give you 5x plus 3y is less than or equal to 0, is less than or equal to 5000, something like that. They will list out the constraints, and where x comma y is greater than or equal to 0, they will list out the constraints and they will solve it, right? So basically, to put it short, when you have more than one constraints, marginal costing will not be able to do it, right? It can be done only using something called as linear programming problems, which is a subject matter of discussion in CA final. Just giving you a bird's eye view on that, right? Now, B they are asking, that is part B of the question. Assuming raw material as a key factor availability of, and the availability of which is going to be just 10,000 kgs, and the maximum sales potential of each of the products is 3,500 units, find out the product mix which will yield the maximum profit. Now what you need to do, you need to do the allocation. So they are saying clearly, assume that raw material alone is a limiting factor, right? In that case, ranking will be what? First I will try to produce A, then any raw material left out I will try to produce B. Correct, guys? So what will I do first? Now allocation of 10,000 kgs of raw materials to maximize the contribution. So first rank product is A. So 3,500 units is the maximum market potential. Every unit of A requires how many kgs? 2 kgs. Yes, it requires 2 kgs of raw material. So for producing A, I would have consumed a total of 7,000 kgs. So sigma kgs, that is as of now the cumulative kg consumed is only going to be 7,000 kgs. Clear with this, guys? Now after producing B also, the total consumption would have been how much? 10,000 kgs. Out of this, I have used 7,000 for A, which means only 3,000 is available for product B. And every unit of product B consumes 3 kgs, which means the maximum possible number of units B that can be produced is 3,000 divided by 3. It is going to be 1,000 units. Are you clear with this, guys? So now this is how I allocate the limiting factor, and when raw material is a constraint and I have only 10,000 kgs of raw material, the best possible mix that can yield my maximum profit is going to be 3,500 units of product A and 1,000 units of product B. So what would be the contribution in that case? 3,500 units into 55 rupees, that gives me 192,500, and 1,000 units into 69 rupees, it's going to give me 69,000. If you add up the two, you get what? 2,61,500. Are you clear with this? This is the maximum possible contribution that you can earn when raw material availability is only 10,000 units. Are you clear with this, guys? And this is the concept of limiting factor analysis. Are you clear with this, guys? You are all clear with this, right? Fine. So in exam, this could be a 10-mark question as well. And one more thing, some students are saying, some students and some even in some YouTube channels, I've seen this. They feel that limiting factor has been removed from our syllabus. Absolutely not. It has not been removed, guys. So what they have done is, earlier in the earlier version of the material, there was one sum that they have removed. They have not removed the concept of limiting factor. That one sum they removed. So many people started creating a buzz saying that, you know, the limiting factor concept itself they have removed from the new syllabus. Absolutely not. It is very much a part of your new syllabus only. Clear with this, guys? So don't fall for it. It is definitely there because it's one of the key aspects of marginal costing. Now, with this, we are done with all the aspects of CVP analysis. We are just left out with marginal versus absorption costing, which we'll be doing right now. Okay. So now all these things are done: indifference point, shutdown point, and key factor analysis. So now we are left only with the last concept or the segment C of this chapter, which is called as absorption costing versus marginal costing. Now, shall we get started, guys? Yes. Right? Shall we get started? Okay. Now, absorption costing versus marginal costing. what is this concept all about? But before that, let me tell you, this is the only segment in this entire chapter that talks about stock valuation and profit computation, right? Now guys, absorption costing is nothing but the overage chapter that we saw. Now, what does absorption costing say? Now, as per absorption costing, we have seen that costs can be broadly classified into two: manufacturing costs, right, and non-manufacturing costs. Correct? When I say non-manufacturing costs, I mean your AOH and SOH. Clear? That is all the costs incurred outside the factory. Non-manufacturing cost. Correct? Right? And you have manufacturing costs. Right? Manufacturing costs, I can further split it into four. I can further split it into four: direct material, direct labor, direct expense, and production overhead. Right guys? Yes. So overall in costing, these are the costs that we consider. Correct guys? And again, I'm telling you, this segment of discussion talks about what? Stock valuation and profit computation. That's why we are looking at cost from the perspective of your manufacturing, admin and selling. Clear with this guys? Now in your production overheads also, if you see, there could be fixed production overheads, there could be variable production overheads. For example, your power and fuel could be a variable production overheads, whereas a factory rent could be a fixed production overhead. Correct guys? Correct? Yes, done. Okay. Let me just change the sequence here. I will put it here. I will put this one as variable and I will put this one as fixed. Now what is it? Now a company can follow either marginal costing or absorption costing. A company can either follow marginal costing or absorption costing for the purpose of maintaining their costing records. I'm not talking about decision making, I'm talking about records. Costing records, a company can either follow marginal costing or they can follow absorption costing. Now, what we have seen in absorption costing, all the non-manufacturing costs, that is any cost incurred outside the factory, these are all period costs. These are all period costs. Correct? Period cost means what? Not considered for stock valuation directly. P&L items, they get knocked off against your revenue, so they are not used for stock valuation. Correct? Yes guys. And what does our absorption costing says? So stocks, every unit should be valued at full manufacturing cost. Correct? No? Right? That is, to value every unit of a product, it should be valued at the prime cost components, direct material, labor, overheads, and your entire production overheads, that is variable as well as fixed production overheads. Correct guys? Yes, this is what our absorption costing says. Now what our marginal costing says is, look, we are also saying any cost incurred outside the factory should not be considered for your stock valuation, so they are all period costs, no problem. But they are saying every unit should be valued at variable manufacturing cost. That is, marginal costing is also saying use direct material, direct labor, direct expense, and also variable production overheads. So these four are always product costs. They are always product cost, whether I follow marginal costing or I follow absorption costing. Clear with this? But what marginal costing says is, look, fixed production overheads. First of all, marginal costing says over your fixed cost itself should never be unitized, right? Fixed cost doesn't make sense if it is unitized. Marginal costing says just because that fixed cost is incurred inside a factory please do not consider it for the purpose of stock valuation and all. So what your marginal costing says is, wait, fixed production overheads will never form part of your product cost. That is, treat your fixed production overheads as period cost. Who says this? Marginal costing. Whereas absorption costing says, no, even fixed production cost will be considered as a part of your product cost. So here the issue arises only with respect to the fixed production overheads, right? Wherein the absorption costing says that it needs to be considered as a product cost. It needs to be considered as what? As a product cost. Whereas my marginal costing says, no, anything which is fixed, irrespective of the location, is always treated as a period cost. So now marginal costing treats this as a period cost. Are you clear with this, guys? Are you clear with this? So remember this, marginal costing and absorption costing, both of them are agreeing on this area, right? And both of them are agreeing on this area also, right? Both the methods or both the techniques of costing say any non-manufacturing costs are always period costs, right? And the prime cost components and even the production overheads, variable production overheads, are always product costs. The issue arises only with respect to fixed production overheads, where marginal costing says we will not unitize anything that is fixed. So even the fixed production overheads should not be unitized and should not be considered as a part of your stock valuation. Clear with this, guys? So anything that is fixed production overheads, you directly take it to your P&L. Don't take it to my trading account. Clear with this, guys? Don't consider it for stock valuation. Whereas absorption costing says, no, I will value the stock at full manufacturing cost. Clear with this, guys? Are you clear with this, right? This is the only difference. So look at this. Absorption costing says product cost is going to be direct material, direct labor, direct expense, and my production overheads. Production overheads means what? Full production overheads, variable and fixed. Marginal costing says every unit should be valued at material, labor, direct expense, and only the variable component of production overheads, which means what? The fixed component of production overheads should never enter into my stock valuation as per marginal costing. Clear with this, guys? Right? Now, in both these, so in case of absorption costing, what is a period cost? Only the non-manufacturing cost, that is my AOH and SOH. Whereas in my marginal costing, what happens is not just my admin and selling overheads, but even my fixed production overheads is also forming part of what? It is also forming part of my period cost. Are you clear with this, guys? Are you clear with this? So in marginal costing, the fixed production overheads and admin and selling, not fixed, even if it is a variable. See, guys, admin and selling, even though they are variable, they are also treated as period only, even under marginal costing. See, your AOH and SOH, whether they are fixed or variable, I don't mind, right? They are incurred outside the factory. Both the methods say that they should not be considered for the purpose of stock valuation. So the only difference is happening with respect to the fixed production overheads. Are you clear with this? The fixed production overheads is not considered as a product cost under marginal costing, whereas it is considered as a product cost under absorption costing. Are you clear with this, guys? Then the fixed production overheads are charged as product cost under what? Under absorption costing, whereas the fixed overheads are not charged the products. They are always taken as a period cost on actual basis. Now let me tell you one thing. Now look at this, guys. AOH and SOH are there, right? Whether they are variable or they are fixed. Now whether they are variable or they are fixed, they are incurred outside the factory, right? They are always period cost under both the techniques of costing. Clear with this, guys? Don't think that in marginal costing, if it is variable, I will always treat it as a product cost. No, I'm being very clear. Marginal costing considers only variable manufacturing cost, which means what? The cost needs to be variable and it needs to be incurred inside a factory. Clear with this, guys? So don't say that all variable costs are considered as a product cost under marginal costing. No, if it is a variable cost incurred outside the factory, marginal costing also says don't include it. Are you clear with this? In fact, marginal costing is being extremely cautious, extremely conservative. Here you are taking the full manufacturing cost. I am only taking the variable manufacturing cost. So clearly, I am avoiding the fixed production overheads. Are you clear with this, guys? Basically, what marginal costing says is, if a cost is fixed, right, irrespective of its location. that is whether it is incurred in the factory or if it is incurred outside the factory, fixed, whenever the word fixed comes, it should not be unitized and it should not be considered for the purpose of stock valuation. Clear with this, guys? Clear with this, guys, right? This is similar to that, the dialogue that we have in a movie. நண்பன்ல ஏதுமா நல்ல நண்பன் கெட்ட நண்பன் நண்பனாலே நல்லவன் தான், something like that. Marginal costing says, right, fixedல எங்க product or period, fixedனாலே period தான். So whenever fixed comes in, marginal costing says it's always a period cost, do not unitize it, right? Because it really doesn't make sense if you unitize a fixed cost and push it into the product. Clear with this, guys? Are you all able to understand this? Yes, that is what our marginal costing says. Clear with this, guys? Now, based on this, of course, there is one major difference again. In your absorption costing, you have all the procedures of absorption. That is, first, we need to calculate the absorption rate, charge it off with the products, compare it with the actual, and at the end of the year, you need to calculate the under or over absorption. Are you clear with this? Whereas, if you're following your marginal costing approach, there is no concept of absorption only. Why? Because I've made life simple. Your fixed production overhead should not be unitized. Just now we saw. Then where is the question of absorption? Sir, variable production overhead is there, no, sir? Yes, but it is variable, no? So, as and when the product comes out of the machine, I will know how much it has actually gone into it. Are you clear with this, guys? Are you clear with this? Yes, you guys are understanding this. There is no concept of absorption when it comes to what? When it comes to your marginal costing. Whereas, since we are doing it under absorption costing, in this case, at the end of the year, I need to do that rectification entry of under or over absorption. Are you all clear with this? Are you all clear with this? Now, with this, let us go and do a numerical problem. Let us go and do a numerical problem. Take question number 4. Please take question number 4. A very, very good example. It's a masterpiece. Mark this sum as important because, again, this sum is there in CA final as well. The exact sum, because in marginal versus absorption costing, this is all the concept is. Fine. This is all the concept is. Of course, there are some advanced level as well, but yes, this is a common example which is used in both inter and final. So in your final self-study, self-paced modules, you can also find the same example maybe. Right, now look at this. From the following data, compute the profit under marginal costing and absorption costing and reconcile the differences in profit. Now what they have given, the selling price is 8, variable cost is 4, and fixed cost per unit is 2, right? Now, be very careful here. What they have said is, if I am using absorption costing, right, every unit will be valued at 6 rupees, 4 plus 2, correct, guys? Full manufacturing cost. If I am using marginal costing, every unit will be valued only at 4 rupees. Are you clear with this? Are you clear with this? Right? Now, the normal volume of production is 26,000 units per quarter. So per quarter, the normal volume is 26,000 rupees, right? Now, so with this, you can clearly make out. So 2 rupees is the fixed cost they have given. 2 into 26, it's going to be how much? 52,000 rupees is the fixed cost per quarter. Are you clear with this? So the fixed cost planned per quarter is 52,000 rupees. This will be needing for marginal costing approach. Why? Because marginal costing says fixed cost doesn't make sense if it is represented on a per unit level. Convert it into total value and remove it. That's all. Contribution minus fixed cost. Bulk figure only. No per unit and all. Clear with this, guys? Now, the opening and closing stocks consisting of both fixed goods and equivalent units of WAP are as under. So they have given it here. Quarter wise, they have given us how much is the opening stock, how much is the production, how much is the closing stock, and how much is the sales and closing stock. Quarter wise data is given. Clear with this, guys? Clear with this, guys? Now, they have asked us to prepare a quarter wise profitability statement under marginal costing and under absorption costing. Yes, shall we get started with this? Shall we get started with this? Right? Done? Shall we do this, guys? Right. Now, first, let us do it under the marginal costing income statement. Now, marginal costing income statement, how it looks like, we all know. Sales minus variable cost gives you contribution minus fixed cost gives you profit, right? But till now, we didn't see any kind of stock adjustments and all. So when stock comes in, how do you prepare? The base is the same, but there are some extra things that need to be taken care of for your stock adjustment, right? So first, what do you have? The sales figure. The sales figure will be what? The respective month's sales units, the respective quarter sales units multiplied by the selling price. So you will be having the sales value. Correct, guys? Yes. So from my sales, right, I need to reduce the variable cost. When I say variable cost, not the entire variable cost, the variable cost incurred in respect of units sold. Matching concept only, no, guys, correct? So sales minus variable cost gives me contribution, correct? But what variable cost will I reduce? Variable cost incurred in respect of units sold only. Clear with this? How will I arrive at the variable cost of goods sold? Very simple. Opening stock plus my variable cost of production minus closing stock. If you look at this is my FG, right? If I want to calculate the value of my cost of goods sold, say opening stock plus the current period cost of production minus closing stock. If I adjust for these three, only then I will get my cost of goods sold, correct? But remember, we are in marginal costing area, so which means all these units are only valued at variable manufacturing cost. Hence, I use the word opening stock plus variable cost of production minus closing stock. So variable cost of production means what? Every unit is valued at 4 rupees. Are you clear with this? Are you clear with this? Sir, are you ignoring this 2 rupees, sir? No. 2 into 26. I take it as 52,000. 52,000 will come and hit in bulk. After my contribution, I have minus fixed cost. There I will adjust. I will not unitize it, because if I unitize it, a part of it will enter into the stock valuation and escape to the next year. That I don't want to do. Are you clear with this, guys? Right? So now what happens? The respective number of units are there. So here, opening stock, quarter wise, it's there. So whatever is the number of opening stocks, right, multiply that with 4. Opening stocks are also valued at 4 rupees. Even if there is a closing stock, that is also valued at 4 rupees only. All the units are valued at 4 rupees only. So here, if you see the production and all, so 4 into 26,000, that gives you how much? 1,04,000, right? Here into 30,000 gives you how much? 1,20,000. Then into 24,000 gives you 96, and into 30,000 gives you 1,20,000. Basically what you do, opening stock plus variable cost of production minus closing stock. If you do quarter wise, you get what? Variable cost of goods sold. Are you clear with this, guys? Variable cost of goods sold. Are you clear with this? So now sales minus my variable cost of goods sold. Sir, it gives me contribution. I call it as gross contribution. Why, sir, is it gross contribution? It is not net contribution, because now we have only considered the variable manufacturing cost. There could also be some variable cost on the selling side and the admin side, correct? No? Even AOH and SOH could be having some variable component. That's why I'm calling this as gross contribution. From here, I will subtract the variable admin and selling. Right? In this question, it is not there, but I am preparing the format and I'm giving you. Clear with this, guys? If there is a variable admin and selling, remove that also, you get the net contribution. Are you clear with this, guys? Are you all able to understand this? You will get the net contribution. Clear with this, guys? Now from here, reduce the fixed cost. Sir, what fixed cost, sir? Whether it's going to be POH, or is it going to be AOH, or is it going to be SOH? I am not bothered. Fixed means period, always, right? Irrespective of the location, take all the fixed costs and knock it off here. Are you clear with this, guys? Are you clear with this? In our case, quarter wise, it's going to be 52,000. AOH and SOH data is not given. If that is given, you can also add it up here. Clear with this, guys? You reduce that also, you will end up with a quarter wise profit, which is being reported as 52,000, 44,000, 60,000 and 76,000. Clear with this, guys? Clear with this? This is the way to do it. Are you all able to understand this? Are you all able to understand this? Right? Right? Now, suppose we are doing the same question under the absorption costing system. Now, what do? Under absorption costing system, every unit is valued at full manufacturing cost. That is 6 rupees fully. Right, guys? Basically, this is nothing but this 2 rupees is nothing but the absorption rate. Correct? No? Yes, they would have used the absorption rate and arrived at the fixed cost per unit level. Clear with this, guys? So now, what would have happened? So you have the same sales figure. Now here, what will I do? From sales, I reduce my cost of goods sold. How do you do that? Opening stock plus the full cost of production minus closing stock. Here, I value all the units at 6 rupees. Are you clear with this? So multiply the respective units with 6 rupees. You will get what? You will get what? You will get sales minus cost of goods sold gives you your gross profit. This is like your trading account. Are you clear with this? From your gross profit, you reduce your selling and admin. Selling and admin, whether it is variable or fixed, both will come. variable and fixed, both will come. Here we are following absorption costing system. We don't bifurcate variable separately, fixed separately and all, arrive at contribution. No. So after gross profit, right, all the variable and your fixed selling and admin overheads will be coming here, right? And one more adjustment is required, which again many students miss, is under or over absorption. Sir, in this question, will there be an under or over absorption? Yes, of course there will be. Of course there will be. Now look at this. In this question, what have they given? The absorption rate of fixed overheads is how much? 2 rupees. Correct, no? 2 rupees per unit, right? So which means 2 into 26,000 is going to be 52,000 rupees was the budgeted fixed overheads. Correct, guys? Budgeted fixed overheads. Now, in the question, have they given how much was the actual fixed overheads? It is not given in the question. If nothing is given in the question, you can take that as the actual fixed overheads. Also, you can assume that budgeted fixed overheads is equal to actual fixed overheads. Clear with this, guys? Right? Now, when budgeted fixed overheads is equal to actual fixed overheads, will there be an under or over absorption? Will there be an under or over absorption? Guys, will there be an under or over absorption? Yes, there could be. Because under or over absorption is a comparison between absorbed overheads and my actual overheads. It is not between budget and actuals. Are you clear with this? Now, in this case, can you calculate the absorbed overheads? Yes. Every unit I absorbed 2 rupees, and month-wise I know actual number of units of production is 26,000, 30,000, 24,000 and 30,000 respectively. Correct, guys? So now what will I do? I will calculate under or over absorption. Actual overheads is 52, 52, 52, 52. Absorbed overheads will be month-wise units produced, the quarter-wise units produced into 2 rupees. So I will be getting the figures respectively. So now for first quarter, there is no under or over absorption. Second quarter, what has happened? Actual overheads is 52, but I have accounted how much? 60,000. So now what has happened here? There is going to be an 8,000 rupees of over absorption. Are you clear with this? Which means what? I have accounted for 60,000 rupees of overheads. Ideally, I should have accounted for only how much? 52,000. So now what should I do? I should add back 8,000 rupees to my profit. I have already accounted for more cost. Reduce your cost. If you reduce your cost, your profit will increase. So add back this 8,000 in Q2. Are you clear with this? In Q2, I added back. Now what happens here in Q3? You should have accounted for 52. Till now, you have only accounted for 48. So now you go and further include a cost of 4,000. If you further include a cost of 4,000, your profit will reduce by 4,000 now. That's why they have put it within the bracket. Clear with this, guys? And in the fourth quarter, you should have accounted for 52,000. That's your actual, but you have absorbed 60,000. You have considered a cost of 60,000 rupees. So now what has happened here? Now you have over absorbed. You have already accounted for a more cost of 8,000. Now reduce your cost by 8,000. Or in other words, a reduction in cost will only increase your profit. Your profit should stand increased by 8,000 rupees. Are you clear with this, guys? Are you clear with this? So now, having considered all these things, now you find out that your overall profit under your absorption costing system is going to be 52,000, 56,000, 52,000 and 72,000. Are you clear with this, guys? Any problem here? Any issues here? Right? Now comes the most interesting part of this entire discussion. That's the final part of it. Now the profit under absorption costing is 52, 56, 52 and 72. Right? Now, what is the profit under marginal costing system? It is 52,000, then 44,000, then 60,000 and 76,000. Right? Now what happened? Why is there a difference in profit reported under the absorption costing system and the profit reported under the marginal costing system? Can anyone tell me? Why is there a difference between the profit reported under the marginal costing system and under the absorption costing system? Can anyone tell me, guys? Can anyone tell me why is this happening? Yes, Ramya, can you tell me? Yes, Bharat, anyone? Tell me, guys. Yes, you can even use the chat box. Come on, tell me. Why is there a difference in profit reported under the marginal costing and the profit reported under the absorption costing? In both the methodologies, the units sold, everything, units produced, stocks, everything was the same, right? Cost also didn't change. But what happened here? What happened here? Now, some of you might be thinking, It is because of under or over absorption. Under or over absorption? Absolutely not.
Because of fixed transaction cost.
Yes, very good, right? So yes, it is because of the fixed cost. Now let me come to it. If some of you are thinking it's because of under or over absorption, it is not right, because in marginal costing, what we do, we have no concept of absorption, right? Directly, whatever is the actual fixed cost that hits my P&L, correct? In absorption costing, what we do, we first absorb something, right? That is different from actual, but at the end of the year, we match it with the actual by doing an under or over absorption. So technically speaking, even in absorption costing, finally the fixed overhead that has entered into my profit and loss statement is also actuals here. Are you clear with this? So it is not the under or over absorption that causes the difference in profit. Then what is the reason for the difference? The reason for the difference between the profit reported under marginal costing and absorption costing is wholly and solely the fixed cost lying inside my net stocks. The fixed cost lying inside my net stock. So what do you mean by that? Now, you see here, always absorption costing, right? In our example, values every unit of stock at 6 rupees, whereas marginal costing values every unit of stock at just 4 rupees. Correct, guys? Right? Now, what happens is, right? Let us say I am having a closing stock. I am having a closing stock here, right? In a particular question, I'm having a closing stock. Now, what happens? This closing stock, let us say I have 1000 units, right? Each of these 1000 units are valued at 6 rupees by absorption costing, whereas they are valued at only 4 rupees by marginal costing. This closing stock is on the credit side, correct? So if there is a closing stock, what happens? Obviously, the credit side will be more under absorption costing, because of which the profit under absorption costing will be greater than the profit under marginal costing, correct? Suppose instead of this, I am having an opening stock of, let us say, 1000 units, right? Each of these 1000 units will be valued at 6 rupees under absorption costing and 4 rupees under marginal costing. Anyways, whether it's on the opening stock or on the closing stock, the stock valuation will be done higher by absorption costing system as compared to marginal costing system. It depends on which side it is. If you are having a net closing stock, right, then marginal costing will be reporting a higher amount on the credit side, and hence your absorption costing will be reporting a higher amount on the credit side, and hence absorption costing will be reporting a more profit. If there is a net opening stock, right, more the debit side, it means what? Obviously lesser will be your profit. Now absorption costing will be reporting a lesser profit. Or in other words, now in this scenario, if you see in our example, in the first case, what happened? How much was the opening stock? 0. How much was the closing stock? That was also 0. So the net stock was 0. Opening, closing, both adjusted together, it was 0. Since there was no stocks here, if you notice, the profit reported under the absorption costing and marginal costing was the same. Are you clear with this? Now, in the second situation, what has happened? Do I have an opening stock? No. Do I have a closing stock? Yes. I had 6000 units as a closing stock, correct? Now, closing stock is on the credit side, correct? And absorption costing values every unit at 2 rupees more, correct? No? So 6000 into 2. So absorption costing has a higher amount of 12,000 rupees on the credit side, because of which, to the extent of 12,000 rupees, absorption costing's profit will be more. That's why marginal costing was 44, right? The absorption costing's profit was 56. Are you clear with this, guys? Are you able to understand this? Similarly, in the third quarter, what has happened? There was an opening stock, right? Opening stock of how much? 6000. There was a closing stock of how much? 2000. If you see net of the two, there was a net opening stock of 4000 units. Correct, guys? Right? And each of these 4000 units would have been valued more. Always absorption costing only values more by 2 rupees, right? 4000 into 2, 8000 rupees. The debit side was more in absorption costing by 8000 rupees. So more the debit side, it means what? Lesser will be your profit. So now your absorption costing will be reporting a lesser profit to the extent of 8,000 rupees. So look at this. That is the reason why absorption costing was reporting only 52 while marginal costing was reporting 60,000 rupees. Are you clear with this, guys? Are you all able to understand this? And finally, if you see, I think that is also another scenario. Yes, you have what? An opening stock of 2,000, a closing stock of 0. Once again, this fourth quarter is also a scenario where you have a net opening stock. So 2,000 into 2, 4,000 rupees more on the debit side, which means a lesser profit as per absorption costing. So absorption costing would have reported a lesser profit to the extent of 4,000 rupees. Look at this. Absorption costing has 72,000 rupees of profit, whereas your marginal costing is reporting a 76,000 rupees of profit. This is what we have reconciled here. Are you clear with this? We have taken opening stock, we have taken closing stock, and we have taken the net stock. Are you clear with this? If I'm putting net credit, it means that it is lying on the credit side. That is, there is a net closing stock. This case, the third case, is going to be a net opening stock, right? And the fixed cost sitting inside the next net stock is going to be 2 into the net stock. Are you clear with this? So this is going to be the reason for the differences between your absorption costing and your marginal costing profit. Are you all able to understand, guys? Are you all able to understand? This has been explained here as a conceptual, as a concept point. Just a minute, let me just show this. Look at this. Have they given it anywhere here? Okay, I don't think it's been mentioned. Okay. Now let me just write a conclusion here. Please write it down if you want. Now, yes, when opening stock is equal to closing stock, right? So the marginal costing profit is equal to absorption costing profit. Correct, guys? Correct, guys? Or let me just put it, let me keep absorption costing as the base. Absorption costing profit is equal to marginal costing profit, right? Or when there is no opening stock and closing stock, even then my absorption costing profit is equal to marginal costing profit. That is, there is no net stock. No net stock can happen in a scenario when you don't have any stocks, or when your opening stock is exactly equal to your closing stock. Clear with this, guys? Suppose my opening stock is greater than my closing stock. That is, now my debit side is more in your absorption costing. When the debit side is more, the profit will be less. What happens? The absorption costing's profit will be lesser than the marginal costing profit. Why? Because absorption costing always has higher only, right? That higher you should see whether it's on the debit side or the credit side. If there is a net opening stock, absorption costing will be having a higher debit side, which will report a lesser profit. Suppose if the closing stock is greater than the opening stock, now absorption costing has a higher credit side, which will increase its profit. So absorption costing's profit will be greater than marginal costing profit. Are you clear with this, guys? This is the conceptual understanding of the differences between your absorption costing and marginal costing. Are you all able to understand this? Are you all able to understand this, guys? Yes? You guys have got this? You guys have got this? Right? And that is about this entire chapter. We have taken about 4 hours approximately, right? And we have covered almost the entire chapters. I mean, the revision, obviously it was revision, because in our regular lectures, as I told you, we'll be doing more than about 35 numerical problems will be done, along with detailed explanations for every single concept. But here we have touched upon all the major aspects. There are even some small aspects that we generally cover in the regular batch, but of course in a revision we can't cover everything. But the maximum extent possible, that has been covered here, and I hope you guys are also clear with all the concepts that we just finished. Fine, guys, right? And with that, we are concluding with this particular chapter called as the mighty marginal costing. Right? Have we left out anything? Can you guys just check and let me know? Have we left out anything? I hope I've covered everything. All the concepts mentioned. Let me just see. Yes, I think yes, I've just ticked up everything. Yes, guys, and that's about this chapter. Please don't fall into the trap of mugging it up. Marginal costing is an absolute beauty. It's an absolute beauty. So now, guys, have you all understood it? Are you all getting the confidence in this chapter? Are you all getting the confidence in this chapter? Please use the chat box. Right? Please use the chat box. Tell me, let me know, are you all getting the confidence in this chapter? Is there even a single formula to be mugged up? Absolutely not. There is not even a single formula to be mugged up, right? Please tell me, guys, are you all clear with this? right? Even if you are later on watching it on a recorded mode, please use the comment box or on the comment section. Please tell me whether you have understood this or not, right? Fine, guys. Fine, guys. I hope you found this very useful. Fine. Done. Great, guys. Great. It's good to know. It's good to know that you guys are getting a lot of confidence in this. Superb. Great. Fine, guys. Done. Now, let us revise the next chapter, which is chapter 4, applications of marginal costing in short-term decision making. Now, guys, this chapter has the following learning objectives. So, number 1, opportunity cost. Then number 2, pricing decisions. Then make or buy decision, accept or reject offer, limiting factor or key factor analysis, which we just saw in the revision of the previous chapter, marginal costing. Then replacement decision, evaluation of alternative choices, subcontract or not decision, expansion of business, shutdown or continue decisions, and other decision making problems. Clear with this? Now, out of this, so we have actually covered the limiting factor analysis and the shutdown or continue decisions, right, in the previous chapter revision itself, in marginal costing revision itself. Now guys, this chapter, applications of marginal costing in short-term decision making, is nothing more than the extension of the previous chapter, marginal costing itself. But in this particular chapter, there is broadly one major thing that you need to understand, which is the concept of opportunity cost. And apart from that, you also need to have some common sense, right? So the base for this particular chapter is nothing but the previous chapter, marginal costing, plus some common sense that is being involved. Apart from that, one major component called as opportunity cost, the concept of opportunity cost. Clear with this, guys? Now, based on this, so there are so many learning objectives. You are saying this is all it is. Yes, these are all different scenario they will give you, right? They are just giving a name for these scenarios. So it is being listed out as different learning objectives. However, this is nothing more than the concept of marginal costing with opportunity cost and some common sense. Based on this, scenario wise, you can apply your knowledge and you can easily, crack these kind of questions. Are you clear with this, guys? Right? So now we have seen in depth the revision of the concepts of marginal costing. Now let us see those incremental aspects that are getting covered in this chapter 4, applications of marginal costing. Now guys, let me be very clear at the beginning of this particular chapter's revision. Now, in this particular revision, right, in our regular batch, every one of these learning objectives will be covered in detail in terms of so many numerical problems. In this particular revision batch, what I will do is, first, I will focus on the concept of your opportunity cost, right? What is that opportunity cost? Not just the definition, with a proper example, a few examples I will just take, increment it, and I will clearly explain you the logic, right? Apart from that, I will just handpick a few numerical problems across these learning objectives. I will just handpick a few numerical problems and I will be explaining. This will enable you to have a proper revision of this particular chapter. Clear with this, guys? That is going to be the agenda for this particular chapter. Now, first, sir, what do you mean by opportunity cost? Now, let us go and see what is the definition of opportunity cost. Now, don't worry, I will just not leave you with the definition. So, I will actually explain what it is. But for you to understand, let us first go and see what the definition says. Where the choice of one course of action, requires that an alternative course of action be given up. The financial benefits that are foregone or sacrificed are known as opportunity cost. Opportunity cost thus represents the lost contribution to profits arising from the best alternative foregone. They arise only when the resources are scarce and have alternative uses. Opportunity cost must therefore be included in the analysis when presenting relevant information for decision making. Sir, what is this, sir? Right? So now, based on, by just reading, you will not understand anything. Now, let me just give you an example. Example number 1, some basic level example. From that slowly we will increment. Let us say you have finished your CMA course, you are now a qualified cost accountant. Now, two companies, you are sitting in a campus placement and two companies are actually interviewing you and you got selected in both the companies, right? Company A is offering you a salary of 1 lakh per month, right? And company B is offering you a salary of 1.5 lakh a month. Clear with this? Now, let us assume both the companies have a very similar job profile. The other non-financial parameters are assumed to be the same. Now, you tell me, guys, which company would you prefer joining? Right? Assume all other things are all similar. Which company would you prefer joining? You will say, hands down, sir, obviously, I will go for company B. Right? Why? Because you will say that I am earning 50,000 rupees more if I opt for company B. Right? Now, how did you arrive at this decision? You did something called as a cost benefit analysis. Without even knowing that you did a cost benefit analysis, you've actually done it. What is it? If I go for company B, what is the benefit that I will be getting? 1.5 lakhs a month. Correct? But if I go for company B, I will have to give up my company A's offer because parallelly I cannot work in two companies at a time. So what is the cost? Cost doesn't mean, whatever you pay out of your pocket. It also refers to opportunity cost, your sacrifice. Are you clear with this? So because I'm going for company B, I am losing out on this 1 lakh rupees that I will be getting from company A. So net benefit is going to be 0.5 lakh rupees. This is how you make the decision. This 1 lakh rupees, though not paid out of your pocket, it was a sacrifice made by you because you went for this company B alternative. Clear with this, guys? So the value of the next best alternative foregone is only called as opportunity cost. In this case, in deciding whether or not to go for company B, now this 1 lakh was taken as an opportunity cost that was relevant for our decision making. Are you clear with this? That's why we say that opportunity costs are very much relevant for the purpose of decision making. In this case, we call this 1 lakh rupees as opportunity cost. Clear with this, guys, right? Sir, fine, we understood this. Then they are seeing some lost contribution, scarce resources. What is it? Now, let me just come up with example number 2. Now, let's go to example number 2, slightly advanced as compared to example number 1. Now, let us say presently the company is dealing in one product. Selling price per unit is 10 rupees. Variable cost per unit is 6 rupees, which means every time I sell this product, I get how much? A contribution of 4 rupees and there's a fixed cost of 10,000 rupees. Clear with this, guys? Now, let's say the company has a maximum capacity to produce and sell 10,000 units. The factory's capacity is 10,000. But actually, the company is running only at a capacity of 8,000 units. Why, sir? Why? Maybe because in the domestic market, the demand is only for 8,000 units. There is no point in producing 10,000 units and keeping 2,000 units as idle. Are you clear with this? I mean, producing 10,000 units and, wasting, that is not being able to sell 2,000 units. Why would I produce it? So that is a demand of only 8,000 units. Let me keep that clear with this. This is the present scenario. Now, presently, what will be the income statement of the company? Right, they have produced and sold 10,000, 8,000 units, assume no stocks and all, whatever they are producing, they are selling. 8,000 into 10, sale value is 80,000 rupees. The variable cost is going to be 8,000 into 6, 48,000. The contribution is going to be 8,000 into 4, 32,000, minus my fixed cost of 10,000. Presently, the company earns a profit of how much? 22,000 rupees. Correct, guys? Right? Now, in this scenario, what has happened? Suddenly they get one export order. One guy from, let us say, US comes in. He says, look, I am planning to purchase 2,000 units of your product, right? I want to place an order for 2,000 units. Are you clear with this? He says, but I will pay only a selling price of 9 rupees. I will pay only a selling price of 9 rupees. Now, the decision making that I need to do here is, should I accept this order, export order of 2,000 units at a selling price of 9 rupees? Now, if I accept this order, what will happen? So, domestic sales, that will continue to be 8,000 units. right? So 80,000 minus 48, 32,000 minus 10, 22,000 profit. So I will generate a profit of 22,000 rupees out of my domestic sales. That will not change. Over and above that, now I've got an order for 2,000 units. Now each of these units will be sold at how much? 9 rupees. So 2,000 into 9, I will be getting an extra revenue of 18,000 rupees. However, I will also need to incur variable cost for that. So 2000 into 6, 12,000 rupees I'll be incurring. So what is the extra contribution I'll be getting? So 2000 into 3, that's going to be 6,000 rupees extra I'll be getting exclusively from the export order. What is the fixed cost? I do not incur any specific fixed cost because I am actually going for this order. Clear with this? Because the same factory rent, everything is the same. Whether or not I accept this offer, right? Anyways, the fixed cost will remain fixed. Are you clear with this? So now the extra profit that I will be getting because I go for this particular decision, because I go for this particular export order is going to be how much? 6,000 rupees. Are you clear with this? So now if you add up everything, the total sales, the domestic plus export is going to be 98,000. Variable cost 48 plus 12, 60,000. Contribution totally is 32 plus 6, 38,000 minus fixed cost 10,000. So totally I'll be getting a profit of how much? 28,000 rupees. So presently, before accepting the order, what was my profit? It was 22,000 rupees. If I accept the order, what is my profit? 28,000 rupees. So I earn an extra profit to the tune of 6,000 rupees if I accept the export order, and hence in this case I will just go ahead and accept the export order. Are you clear with this? Are you clear with this? Now sir, this is common sense, sir, right? This we also know. Where is the concept of opportunity cost here? Wait. Now I will increment this with example number 3. Now you will be able to understand the concept of opportunity cost beautifully. Clear with this? This is why I said this chapter is nothing but your marginal costing, previous chapter, plus your common sense and your opportunity cost. Based on this only, any kind of decision will be taken. Basically, the decision that we took right now, it is called as accept or reject decision. Accept or reject offer. I just told you here, this one. Clear with this? This I just gave an example. This could even be used in pricing decisions. This could even be used in what? Replacement decisions. In any of the decisions you can use it. Are you clear with this? This is what? This is the reason why I'm saying there are certain concepts that need to be hit hard, right? So there is a smart way of learning. If you focus on these aspects, everything else will be covered. Are you clear with this? Anyways, in our regular lectures, so we will be covering about 28 or 30 numerical problems in this entire chapter. But since this being a revision batch, I will just cover the core concepts and a few numerical problems for the sake of revising the entire chapter properly. Clear with this, guys? Now, what has happened? I am just taking an example number 3. Now, example number 3, same as example number, the previous example number 2. Let's say I'm dealing in a product, selling price is 10, variable cost is 6, contribution per unit is 4. One change. The company's maximum capacity is how much? 10,000 units. And the actual capacity now is also 10,000 units. Means what? In the domestic market itself, there is full demand. So what am I doing? I have a maximum capacity of 10,000 units, and now I am fully utilizing my capacity for the purpose of my local sales itself. Are you clear with this? And yes, the fixed cost is 10,000. Now, in this scenario, this US guy comes to me and he says, look, I want to place an order for 2,000 units. Every unit I will be paying 9 rupees. Now, should our company accept or reject this export order? Clear with this? This is what we are going to work out. Now, presently, what is my income statement? So, presently, what happens is, I'm selling 10,000 units at the rate of 10, 1 lakh rupees. 10,000 units at the rate of 6 is my variable cost, 60,000. So 10,000 at the rate of 4, my contribution is 40,000 rupees minus my fixed cost. Currently, I am enjoying a profit of how much? 30,000 rupees. This is what is happening. Life is simple. Suppose I accept this guy's export order. Now you tell me, I have a total capacity of how much? 10,000 units. I can only produce 10,000 units. Clear with this? Suppose if I have to accept the export order, now in the domestic market, I will be in a position to sell only 8,000 units. Max, everything put together, I can produce only 10,000. Now, if I have to accept this 2,000 units of export order, which means my domestic sales, I need to reduce it from the present 10,000 level to 8,000. Only then I will be making 8,000 units of domestic sales, 2,000 units of export sale. Put together, overall, I will be using 10,000 units of my overall capacity. Clear with this? If I accept the order, what will happen now? Logically think. Now, my domestic sales will be reduced to 8,000 units. So, 8,000 into 10, 80,000, right? That's my sales. 8,000 into 6, 48,000. That's going to be my variable cost. Contribution is 8,000 into 4, 32,000 minus 10,000. So, it gives me a profit of 22,000. Clear with this? Now, out of this 2,000 units of my export sales, now how much sales will I get revenue? So, every unit he says he will be willing to pay only 9 rupees. So now 2000 into 9 is going to be 18,000. Variable cost is 2000 into 6, 12,000. The contribution is going to be 2000 into 3, 6,000. Right? Incrementally, I don't incur any specific fixed cost because of accepting the particular export order. So the incremental profit arising from my export sales is going to be 6,000 rupees. Clear with this, guys? So now if I add up the two, total 10,000. In this case, totally I'm producing 10,000 units. What is the breakup? 8,000 in domestic, 2,000 in export. So what will be my total sales revenue? 80 plus 18, 98,000. Total variable cost, 48 plus 12, 60,000. Total contribution, 32 plus 6, 38,000. Minus fixed cost, 10 plus 0, 10,000. So now you get your total profit is 38 minus 10, 28,000. Now what has happened, guys? If I do not accept the order, presently, if I continue to sell 10,000 units in the local market, I will be earning a profit of 30,000 rupees. If I accept this guy's export order, my overall profit reduces down to 28,000. Are you clear with this? Or in other words, if I accept this particular order, or if I accept this particular offer, what happens? My profit reduces by 2,000 rupees. Are you clear with this? Why does my profit reduce by 2,000 rupees? Why does it reduce by 2,000 rupees? If you look at this in the domestic market, every time I sell a unit, I get a contribution of 4 rupees, 10 minus 6. If I make the same sale to that US party, I will be getting a contribution of only 3 rupees, 9 minus 6. Correct, guys? Now, I already am running at a full capacity. I am already running at a full capacity. I don't have any idle capacity. Now, in this scenario, if someone is coming to me and asking me to accept a project, if I accept the project, that involves sacrifice of my current resources. In this case, if I accept the export order, what am I doing? I am going to sacrifice 2,000 units of my domestic demand and give it to my export demand. Now, because I am doing this, instead of generating a contribution of 4 rupees on each of these 2,000 units, I am now earning a contribution of only 3 rupees on each of these 2,000 units. So 4 minus 3, 1 rupee is the contribution lost because I am sacrificing my domestic demand over the export demand. Are you clear with this? So in this case, what happens is this 2,000 rupees is of reduction in profit is nothing but this 2,000 units into 1 rupee of contribution lost because I am actually sacrificing my domestic sales and using it for my export sale. That is the calculation of this 2,000. So this 2,000, yes, 30,000 minus 28,000. The other way of calculating this is nothing but sacrificing 2,000 units by what? How do I get this? By sacrificing it from my domestic sales and giving it to my export order. Are you clear with this? This sacrifice is actually called as opportunity cost. So now in this case, what happens? The profit reduces by 2,000 rupees, right? And hence in this case, you do not accept the order. Overall, if you see, it is just in a total approach, you can just say it's 30,000 minus 28,000. But on the face value itself, you can come to a conclusion, right? Now I am operating at full capacity. Right now I'm operating at full capacity. If I have to accept the new order, it requires sacrifice of my present alternative. So now that sacrifice that I make here is called as an opportunity cost. Now this sacrifice what was not even there in the previous scenario. Reason is there I had an idle capacity of 2,000 units. Anyways, it was idle. Right? Now, acceptance of an offer of the export order in this case did not involve any sacrifice of my current resources. Whereas in the second case, when I'm operating at full capacity, in that case, it involved a sacrifice of my domestic sales. Are you clear with this? Or in other words, the concept of opportunity cost will kick in only when you have only when you are operating at full capacity. So the opportunity cost of idle capacity is zero. Idle capacity, anyways, it's idle. Instead, use it for something. So you are not losing out on something. So the opportunity cost of idle capacity is always zero. Are you clear with this? So now in this case, I can say, now this brings us to the example number 4. So now, similar to example number 3, so which means the company is currently operating at full capacity, right? If at all it needs to accept the foreign order, it will involve sacrifice of my domestic sales, domestic resources. Now, in this case, they are asking you a question: what should be the minimum price quoted for the export order? Now, how many units they are asking? 2000 units. For each of these 2000 units, if I am accepting, what will be the extra cost I will be incurring? The variable cost. So 2000 into 6, 12,000 rupees. Anyway, I need to recover from them, correct? One more thing, because I am going to honor this export order, I will be losing out on my current sales, domestic sales. So what is the contribution that is lost from my domestic sales? If I have to honor the export order, it is going to be 2000 rupees into 4. That is, I'm completely losing out on this. They are asking us to calculate the selling price to be fixed. Are you clear with this? They are not saying they will pay 9. They are saying what is the minimum selling price to be fixed for you to accept the order. You pay me the 6 rupees that I am incurring, plus every time I sell a unit in the domestic market, I will be earning 4. So if I have to accept your export order, you pay me that 4 rupees also. Are you clear with this? So now, how much is that? Overall, the minimum price to be quoted is 20,000 rupees for the 2000 units, or in other words, it needs to be 10 rupees per unit. Or very simply, see, if I sell it in the export, if I sell it in the domestic market, I will be earning 10 rupees per unit, right? If you can give me the same 10 rupees per unit, then I will anyways have no problem at all. I can either sell it to you or I can sell it in the domestic market. It doesn't make any difference. Only then I will accept it. Suppose you are quoting less than what I will be getting from the domestic market. In that case, I will not accept your offer. Are you clear with this, guys? Are you clear with this? So in this case, so the relevant cost means what? The cost that is relevant for the purpose of our decision making. So the relevant cost for the 2000 units is the variable cost that I incur plus the contribution that I forego because I have to accept your offer. So on these 2000 units, had I sold it in the domestic market, I would have got 4 rupees per unit. So now 2000 into 4, it's going to be 8000 rupees. Are you clear with this, guys? Are you clear with this? Suppose I had an idle capacity, which means the previous example, I didn't have any kind of, I had the capacity to produce 10,000 units, but I had actually, I have only a domestic demand of 8,000 units, idle capacity of 2,000 units. In that case, the minimum price to be quoted is what? It will be only the variable cost. There is no contribution foregone. If you don't buy, right, I'm anyways I won't be producing anything. I am not involved. It doesn't involve any sacrifice for me. Are you clear with this? So if there is an idle capacity, in that case, for me, the relevant cost is only my variable cost. Relevant cost means what? The cost that is relevant for decision making. Are you clear with this? Suppose I have an existing sales and a domestic sales, and I'm operating at full capacity, and acceptance of your order, the foreign order, involves sacrifice of my domestic sales. In that, the contribution lost should also be considered for the purpose of decision making. Are you clear with this? Now you go and read. Where the choice of one course of action requires that an alternative course of action be given up, the financial benefits that are foregone or sacrificed are known as opportunity cost. Are you clear with this? The opportunity cost thus represents the lost contribution to the profits arising from the best alternative foregone. In this case, the opportunity cost is how much? 8,000 rupees. Are you clear with this? Right? They arise only when the resources are scarce and have alternative uses. Opportunity cost must therefore be included in the analysis when presenting the relevant information for decision making. So it is actually, opportunity cost concept arises only when the resources are scarce. Means what? I'm fully occupied, right? Now, suppose I have an idle capacity, then my resources are not scarce. I will not be having any kind of opportunity cost. Are you clear with this? So in case of idle capacity, this is what I've mentioned here. In case of idle capacity, the opportunity cost is 0. Are you clear with this, guys? This forms the core understanding of this entire chapter. Clear with this, guys? So this particular concept of opportunity cost with some common sense with the 4 examples that I just gave you right now. And apart from that, obviously the basics of marginal costing, like the concept of your PV ratio, break-even point, indifference point, your margin of safety, and all these things put together, this is all this entire chapter talks about. Clear with this, guys? Now I will just handpick a few numerical problems. I will be solving it so that even in this revision batch, even in this revision marathon, you will be getting an idea of this particular chapter. Now let's take up one numerical problem in this chapter, right? So now a company is manufacturing a product mark an average net profit of 2.5 per piece on a selling price of 14.3. By producing and selling 6,000 pieces or 60% of the capacity, his cost of sales are as under. So what they are saying, presently this particular company is selling 6,000 units of a product, which marks 60% of the capacity. So total overall, he has a capacity of producing how many units? 10,000 units, right? That's his total capacity. Presently, he is selling 6,000 units, right? And each unit, the selling price is how much? 4.3 rupees. Profit per unit, final profit is 2.5 rupees. Here they have calculated the profit, it seems. Clear with this? Next. So they have given the following cost data. Direct material 3.5 per unit, direct wages 1.25, works overhead, production overhead 50% fixed. So the overall total works overhead is 6.25. Out of this, you have a variable component and a fixed component. So 50-50. So 6.25 into 0.5 gives you how much? So 3.125 is variable and 3.125 is fixed. The moment you see fixed, what you need to do, multiply that with the output level. So fixed cost makes sense only if it is represented in total, right? Variable cost can be represented on a per unit level. Similarly, sales overheads, SOH, 25% is variable. So 0.8 into 0.25, 25, right? Okay, so 0.8 into 0.25. So 0.2 rupees, 25% is variable. So it's 0.20 and the balance is fixed, 0.60. So immediately 0.6 into 6,000 you can multiply. So basically you'll get the fixed cost, say SOH in fixed component in value. This is the present cost structure. During the current year, he intends to produce the same number, which means he wants to produce the same 6,000 units, right? But what happens? He anticipates that the fixed charges will go up by 5%. So both the POH and AOH's fixed cost will increase by 10%. Direct labor rate and material will increase by 8% and 6% respectively. So even the material and labor cost will increase, but he has no option to increase the selling price. He has to continue the same selling price of 14.3 rupees. Under this situation, this is the current scenario, he obtains an offer for a further 20% capacity. 20% capacity means what? 20% of 10,000. He gets a new order for 2,000 units. Are you clear with this? Right? Can he take it up without any sacrifice? Yes. Anyways, currently he has a total capacity of 10,000 units. He is only producing 6,000 units as of now. He can take up 2,000 units more. The question here is, what minimum price would you recommend for the acceptance to ensure that the manufacturer makes an overall profit of 16,730? Now look at this. They have said, look, our guy, he wants a total profit of 16,730. Clear with this, guys? Now they are asking for the present 6,000 units. This is the cost structure. So any units you produce and sell, it happens as the revised cost structure. Now they are asking us what should be the minimum price that you will recommend to make sure on these 2,000 units. On the 6,000 units, you have no other option. The selling price remains the constant, 14.3. On these extra 2,000 units, what price should he quote to make a profit of 16,730? This is the question. This is basically a pricing decision question. One of the learning objectives we saw now, in that the pricing decision objective is one question. This is one question regarding that. Now, what would you do? Now, The company currently sells what? 6,000 pieces. Now, let us first try to calculate what will be the profit he will be generating on this 6,000 units. Are you clear with this, guys? First, we need to calculate after considering all the price increase. What price? I mean, the cost increase. All the fixed components will increase by 10%. Your labor cost will increase by 8%. Material cost will increase by 6%. After all the changes, what will be the final profit arising out of what? Out of the 6,000 units that you need to first calculate. Right now, compare that with the required profit to be earned. The difference should be the incremental profit, the extra profit that you need to earn out of that 2,000 units of the new order. Clear with this, guys? From there on, we will proceed and we will see what it is. Very simple. It is all common sense driven. Clear with this, guys? Since in this case, it doesn't require any sacrifice and all. So there is no concept of opportunity cost. This is one example of just a common sense. You yourself will see how simple it is, right? But since this is a case study based question, they have classified it under chapter number 4. Ideally, chapter 3 and chapter 4 are one and the same, just an extended arm. It's like an elder brother. That's all. Clear with this, guys? So now let's do this. First, computation of profit at present after increase in cost, which means for we are first calculating the profit for 6,000 units. 6,000 units. Now, first, what will be our selling price? That will not change. 14.30. Clear with this, guys? So 14.30. This will be our selling price. Now, what will be my components of variable cost? First, material cost is there. Presently, what's my material cost? 3.5 rupees. They have said the material cost will increase by 6%. Clear. Here they have given direct labor and material will increase by 8 and 6 respectively. So don't interchange it. Generally, we first say material and then we say labor. Here they have interchanged it deliberately. Please don't fall for it. So 6% is the increase in my material cost. So present 3.5 into 106 into 100, or in other words, it's nothing but 3.50 into 1.06, 6% increase. So how much is my revised material cost per unit? 3.710. Clear with this, guys? Similarly, what's my labor cost? Presently it's 1.25. There is going to be an increase of 8%. Are you clear with this? So it's going to be 1.25 into 1.08. How much is that? It's going to be 1.350. Clear with this, guys? Then what's going to be my works overhead? Variable component. We just calculated 50% of that. 3.125. So there is no any change or increase in your variable component of your works overhead. Continues to be 3.125. Clear with this, guys? How about your SOH variable component? 25% of 0.8. That is going to be 0.20 rupees. Are you clear with this? So 0.20 rupees you get. So this is going to be your total variable cost per unit. This is going to be your total variable cost per unit, right? So sales minus variable cost per unit, 14.3 minus 8.385 gives you how much? A contribution per unit of 5.915. Are you clear with this? Right? So now what is the total contribution? 6,000 units, each generating a contribution of 5.915. The contribution right now generated from 6,000 units is going to be 35,490. From this, I need to reduce my fixed cost. Correct. So now let's reduce our fixed cost. So what is the fixed cost here? So we have a fixed cost of 3.125 per unit. It's given here. And this is POH. SOH is 0.60. So you add up the two, 3.125, 0.60. You add up. How much is this? 3.125 plus 0.6. You get 3.725. Right? This is the fixed cost, right, per unit. So multiply it with 6,000. So 3.725 into 6,000. That is going to be how much? Into 6,000. Presently, the total fixed cost is 22,350. Wait, now they have said the fixed costs are going to increase by 10%. So into 1.10. So into 110 by 100 or into 1.10, the revised fixed cost now is going to be how much? 24,585. So contribution minus fixed cost. So out of these 6,000 units, what is the total profit that I'm going to earn? 10,905. Clear with this, guys? But they had mentioned in the question that the company wants to earn a total profit of how much? 16,730. Out of the 16,730 rupees of desired profit, he is able to earn 10,905 rupees of profit by just selling 6,000 units, right? So minus 10,905. So how much extra profit he is supposed to earn? 16,730 minus 10,905. So how much is that? Second. So 16,730 minus 10,905, that gives you 5,825. Are you clear with this, guys? So now he needs to generate a further profit of 5,825 from this new order of 2000 units. So what should be the minimum price that he needs to quote? Now he is planning to get a new order for 2000 units. Now for these 2000 units, what should be the minimum price that he should quote? The selling price should recover the variable cost that he is incurring for these 2000 units. Over and above that, it should contribute towards a profit of 5,825, correct? So the minimum price that he should quote for the new order, the computation of the selling price of the new order is what? So the variable cost of the new order, 2000 into 8.385. This is what we've got right now. 8.385 is the new selling price of a new variable cost of the current period, right? So 2000 into 3.835, 8.385. So 2000 into 8.385, that gives how much? 16,770. So the selling price should recover obviously the variable cost, and over and above that should generate an extra profit of how much? 5,825. 5,825. So the sale value that I should be getting from these 2000 units is how much? 22,595. 22,595. So now what is this? So basically this is going to be the sale value that I need to generate from those 2000 units divided by 2000. You get how much? 11.2975 exactly, or they have rounded it off 11.30. So I need to fix a selling price of 11.30 for those 2000 units, the minimum selling price I need to fix, right, in order to make an overall profit of 16,730. Clear with this, guys? This is all about it. Application of marginal costing in short-term decision making. This is a short-term decision. This is not permanent, lifelong. From now on, am I going to sell this guy 2000 units at the rate of whatever we have calculated, 11.3? No, it is a one-off order. Immediately he's asking, look, today I have an order ready. Do you want or not? What is your minimum price? He's coming and knocking my doors. I need to take a decision. Clear with this, guys? Always remember, your cost and management accounting deals with short-term decisions. Long-term decisions are taken only in financial management. Are you clear with this, guys? Right? And that is about this particular question. Isn't it common sense driven, guys? Right? This is what I was talking about. This chapter number 4, applications of marginal costing in short-term decision making, is nothing but your basic concepts of marginal costing, along with some common sense and opportunity cost concepts. That's about it. Now, let us do one more sum in this particular revision of this chapter before we move on to the next one. Now, this concept is about one of the learning objectives that we saw, which is make or buy decision. Make or buy decision. So what do you mean by make or buy decision? First, let me read this question and then I will explain this. Prem Industry is considering making its own motor casting, which it currently purchases for rupees 20.50 per unit. The purchase price does not include the ordering, receiving and inspection cost, which Prem estimates to be rupees 2 per unit. Prem feels that it can manufacture the 6,500 required units at a lower cost. So they feel that they can manufacture it at a lower cost than it pays by purchasing externally. The relevant cost for both producing and buying alternatives are as follows. So now what they are saying is, let us say there is a company, right? We're talking about a make or buy decision. Make or buy. So what do you mean by make or buy decision? Let us say a company is in the business of manufacturing cars, correct? So for them, the FG is what? The FG is a car, right? Now, one of the raw material for manufacturing the car, which is a component, we can say raw material or component, let us say is an engine, right? Engine or a motor. Now, make or buy decision is a decision that you take as to whether this raw material needs to be made or it should be bought. Are you clear with this? Are you clear with this? So should this raw material be internally manufactured or should it be purchased outside? Are you clear with this, guys? That is the decision we are taking. Many students are getting confused. They think, sir, should I be in the business of manufacturing this FG or buying it? No, that is not the question here. Then where is the question of costing for a manufacturing sector here? Right? Nothing will come. If you're just buying and selling the FG, you will become a trader. Clear with this? Here the question is about whether the raw material needs to be purchased or need to be manufactured in-house. Are you clear with this? Now, a very beautiful illustration. This is an example illustration explained in the study material. This is not technically a question and answer format. Okay. Now, what they are saying is this component, motor casting, let's say this is one of the raw material component. If they purchase it from outside, what will be the cost? The cost to buy, they are saying, okay, so they need a total of 6,500 units of that raw material. If they buy it, every unit needs to be bought at how much? 20.50 rupees. So 20.50 into 6,500 is 1,33,250 rupees. Clear with this, guys? Apart from that, every time they place an order, right, of course, they need to incur 2 rupees per unit. This is for covering all the ordering, receiving, inspection costs. This will be incurred only when I am buying. So one more 2 rupees per unit into 6,500, 13,000 units. So if I buy for this 6,500 components will cost me a total of how much? 1,46,250. Are you clear with this? No, instead of buying, let us say I start a small workshop inside the factory itself and manufacture the raw materials that I need. In this case, the motor casting. What will be the cost? They are saying, so to manufacture this raw material, the component, you obviously will be needing material, labor, overage and all. That data is given. 6.25 rupees the material cost into 6,500. That gives you the total material cost. The labor cost is given. The variable factory overage is given. So if I manufacture this entire 6,500 units, then what happens? I will be incurring a total cost of 1,35,125. Clear with this, guys? Now you tell me, guys, should I make or should I buy? Should I make or should I buy? So obviously you will say yes. Obviously the cost of making is how much? 1,38,125. If I go buy it from the outside party, he is charging me 146,250. What is the difference between this? 146,250 minus 138,125 gives me how much, guys? Gives me 8,125. Gives me 8,125. So now what will you say? Sir, if I make it by myself, I will save a cost of 8,125. Savings in cost will obviously increase my profit by 8,125. It is better to make. Correct, guys? Are you clear with this? Yes, absolutely correct. Right? Now, always remember this. Generally, as a thumb rule, the cost of making will be less than the cost of buying. Clear with this? The cost of making will be less than cost of buying. Now you might be asking me this question. Sir, if the cost of making is always less than the cost of buying, then why should there be a decision here? It is always make, no? Then why make or buy decision? That is what we are going to see in the second part of this particular question, which has been, this question, as I told you, is just an illustration given in the study material. Now, look at this. Assuming that the Prame's facility will remain idle, meaning what? If I start manufacturing, I need to set up a workshop manufacturing what? My component, right? And assume I have the space for that. That is, assume there is an idle capacity, right? There is no alternative use of that workshop. In that case, right? What happens is, yes, if they do not manufacture, look at this. What would happen is, right, it would increase their income by 8,125 rupees. 8,125 is nothing but, right, if I use this facility, if I make my own component, I'll be saving a total cost of 8,125, which will in turn increase my income. Now, what they are saying is, yes, this is provided you have an idle capacity. Idle capacity means what? Obviously, if I want to make, I need to use a portion of my factory, right? And let us say it is idle, then it is fine. Yes, some machines are idle. Your men, your labor is also idle. Fine, okay, you do it, no problem. Suppose a scenario where, this is where they are giving you one more scenario. if however the Prem could use this company Prem Limited, or if however Prem could use the idle capacity to manufacture a new product line instead of producing their internal motor component, the contribution margin of the new product line must be considered as an opportunity cost to the make decision. The estimated revenue and cost data of the new product is given. Now, what they are saying, if that particular workshop is idle, you can yes, obviously you can just compare and say, okay, the cost of making is less than the cost of buying, then go for it. Suppose they are giving a scenario. We just said if we have to make, we need to use a workshop. Workshop basically is some set of machines and all that. Suppose using this machine, right? If they do not use this for manufacturing the component, let us say they can explore the possibility of a new product line, and the sale and cost data of the new product line are given below. Let us say this particular, whatever is the capacity the workshop used by this particular company or Prem to manufacture the component can be used to produce 4,800 units of a new product. Let us say it can be used to produce 4,800 units of the product, and the product data is given below. So the selling price per unit of the new product line, if they use this particular workshop for producing a new product line instead of going for manufacturing the component, let us say it fetches 31.25 rupees per unit of the new product line. So that's the total sales. These are the cost data, variable cost and all, right? So technically speaking, they are saying overall, each and every unit that could have been produced using that workshop, let's say it generates a contribution of 4 rupees, 4,800 units could be produced and sold into 4. So that would have generated a profit of how much? 19,200. Let us say this is the scenario. I am currently using the workshop, right, for the purpose of a specific product line that is presently generating 19,200 rupees of profit. Suppose in this scenario, if I am deciding to if I am deciding to make my own component, then what will I do? This workshop, instead of using it for the new product line, I will have to use it for manufacturing my component. Are you clear with this? This involves sacrifice of the contribution of 19,200. If I'm using that particular workshop right now, what will happen? I need to sacrifice this particular 19,200 rupees of profit that I'm earning out of that particular product line. Are you clear with this? Now that becomes a relevant cost for the purpose of my make or buy decision. Now in this scenario, what will happen? If I buy, what is the cost? Anyways, my cost, that doesn't change. 1,46,250? Absolutely. 1,46,250. Clear with this? 1 second, it just got stuck. Yes, 1,46,250, right? Now, if I am making, what happens? Absolutely no doubt, this is going to be your total cost. 1 second, guys, it just got stuck here. Yes, the total cost of making, actual cost of making is 138,125. Yes, so the actual cost of making is 138,125, right? But because I am making, I am also losing out how much? 19,200 rupees. That is also my opportunity cost that need to be added. Are you clear with this? So technically speaking, if I make, what is my total cost? Total cost, that is I am incurring 138,125 plus losing 19,200. So now my cost becomes 157,325. Are you clear with this? Whereas if I buy, what will happen? My total relevant cost is just 146,250. Now you tell me what will you do? Now it makes sense to buy. Are you clear with this? The firm would benefit how much now? It would benefit 11,075 by buying. If it elects to buy the motor castings and instead of manufacturing this part and start manufacturing the new product line. Because now what happens in this case? What was the deciding factor? Now I was not having an idle capacity, I was operating at full capacity. So now if I decide to manufacture my own motor castings, now I will have to sacrifice on the contribution that I will be otherwise generating from the new product line. So once I considered that, now I felt it doesn't make sense to actually manufacture. So now what I will do, I will just buy this. I will just buy it at by paying a total of 1,46,250. No doubt, if I do that, now I will not be using my production facility, my workshop for the purpose of manufacturing my component. I can use this for my new product line that will generate 19,200. That is what they are saying. So the firm would benefit by 11,075 rupees if it elects to buy the motor component and manufacture the new product line. Are you clear with this? This is what they are saying. Clear with this, guys? So this is a clear-cut example of just this overview of this chapter. Are you getting it? See, in this chapter, what we saw was the basics of marginal costing, that is your variable cost contribution and all that, right? With some common sense in the first part, right? When you had an idle capacity, and number 3, with concepts of opportunity cost, when you are not operating at idle capacity, that is, you had some use for this particular for this particular capacity level, and if you take a decision of manufacturing a component that involved sacrifice of resources. Are you clear with this, guys? Right? So this is actually the overview or the big picture of this particular chapter, application of marginal costing for short-term decision making. Of course, there are many more aspects involved in this chapter, which generally we cover everything in our regular batch, but I wanted to handpick the most important concepts at the time of revision, and of course we also did 2 numerical sums in this particular chapter. Clear with this, guys? Right? So with this, we are done with the revision of this particular chapter. Let's move to the next one. Now let us move on to the revision of the next chapter, which is transfer pricing. Now guys, the objective of this chapter, transfer pricing, is control. Now you might be wondering, if you notice in the institute study material, right? So as per the syllabus given by the institute study material, CMA Institute study material, now this chapter, transfer pricing, falls under decision making tools. It falls under decision making tools. But sir, you are saying that this particular chapter actually achieves the objective of control. So how exactly does it work? Yes, it is not contradictory. Here, this chapter helps you achieve the objective of control through internal decision making. So here there is an internal decision making. What do you mean by that? Fine. So now let us enter into this chapter, right? Revise it in the best possible manner so that you will immediately get the pulse of it. Now guys, this chapter helps to promote the interdivisional competition, which in turn will increase the efficiency of all the divisions in the organization. Now, sir, what is this concept of transfer pricing? Now, let me just quickly summarize this for you. First, now let me just take an example of Pepsi, right? The same example that we took in our regular batch. Now, let us say, hypothetically, Pepsi has 2 divisions. Division A, the duty of Division A is to manufacture empty bottles. So, if you actually buy a bottle of Pepsi, right? So, Pepsi actually needs to be packed in a bottle, and that's how you get it, right? Let's say Division A, right? It purchases plastic, right? Converts it into PET bottles, right? And it transfers the PET bottles to Division B. And Division B, what it does is, it manufactures that cola, that is the soft drink, the soda. Are you clear with this, guys? Right? Now, this Division A, it actually manufactures the empty bottles, right? And Division B manufactures a soft drink, which is the final product. Now, Division A, the empty bottle that it manufactures gets transferred to Division B, right? This empty bottle in this case is called as an intermediate product. There are certain terminologies that you need to know in this particular chapter. Intermediate product means what? The product that gets transferred by Division A to Division B. And now Division A supplies this intermediate product to Division B. Yes, it is called as the supplying division. We are just talking about the 2 divisions inside a company. Clear with this, guys? And Division B, it receives the intermediate product. It is called the receiving division. Are you clear with this? And the product that gets transferred here is known as the intermediate product. First, these are the terminologies, basic terminologies that you need to know before you enter into this chapter. Now guys, division B, what it does, in that PET bottle, it will pour the soda, in this case your Pepsi, right? Pepsi, all these things are nothing but carbonated water, soda only, right? And then it sells it to the customers, right? Now, this division B is actually called as a profit center. Why? Because it can report profit, it generates revenue, incurs some cost, the net amount, what it reports is called as a profit. Yes, hence we call this as a profit center. Whereas division A, it is not at all a profit center. It is only a cost center. Why? Does division A sell empty bottles? Any empty bottles does it sell to outsider? No. Whatever it manufactures, it just transfers it intermediately to whom? Division B. So now division A is responsible only for incurring cost. Hence, division A is called as a cost center. Are you clear with this, guys? Now, what are the certain terminologies that we've learned here? We have learned intermediate product, supplying division, receiving division, cost center, profit center, all these things. Clear with this, guys? Now, upon introduction of transfer pricing, what happens is this cost center will now become a profit center. This cost center will now become a profit center. Are you clear with this? Now, sir, why should it become a profit center? Number one. Number two, how will it become a profit center? Two questions need to be addressed. Now, let me address the first question. Sir, why should division A now be converted into a profit center? It is better off being a cost center, no, sir. Why should this happen? Now, just put yourself in the shoes of division A manager. Let us say you are the manager of division A and your friend is a manager of division B. Now, you tell me there is a company head office. Now, this head office will always give more preference to division B only. Why? They are a profit center. They report profit. They show the results every time. Clear with this? Whereas you will not even be respected in the organization, right? Or maybe you might be respected, but not as compared to how division B manager will be respected. Why? You are just a cost center. Do you generate profit for the company? No. Are you clear with this? Now you might argue, sir, even my efforts, are one of the reasons why the company is reporting a profit. Absolutely correct. But immediately, can anyone say that, look, you have reported a profit of so much? No. Are you clear with this? So now, if you were the manager of division A, you would never be motivated to perform well. Reason? Now, anyways, you are not judging my capability because I don't report any profit to you. Are you clear with this? Now, in this case, now to motivate all the managers of a company, including those managers who are ideally heading the cost centers, now the only way or the best possible way to do is to convert these cost center into profit center. Now, if you also start reporting some profits, now what happens? Some healthy competition will be there in the organization. Correct? So I can say division A has reported so much profit, division B has reported so much profit, so division C, D, E, F, everyone in the company has reported so much profit. Are you clear with this? So now the performance of each of the divisional managers can also be easily compared. This helps achieve the objective of control. Are you clear with this? So I am able to motivate all the managers equally in such a way that automatically there will be a goal, there will be a growth in the organization of the company because now everyone is motivated. Clear with this, guys? This way, it helps me achieve the control. How? By promoting interdivisional competition, which in turn will increase my efficiency. Are you getting the tagline of this chapter? Are you clear with this? This is what the chapter says. Clear with this, guys? Clear with this, guys? Right? Now, when I do all these things, of course, internally it involves some decision making. That's why this chapter has been categorized under decision making tools. Now, guys, okay, sir, we understood why a cost center need to be converted into a profit center. It creates a healthy competition between the organization, inside the organization, helps achieve the control objective and all. Now, how would we do that? How do we do that? Now, that is what I have just put it here by way of an illustration. Now, before transfer pricing, what happened? Let us say division A incurs a cost of 5 rupees to manufacture the empty bottles. Clear with this, guys? Let us say division B is there. Now they incur 15 rupees to manufacture that carbonated water, soda, that is your Pepsi, right? And apart from that, they, let us say, they pay this 5 rupees of cost, whatever is incurred in division A, that is also being incurred. So 15 is the division B's cost. 5 rupees is whatever is the cost for that empty bottles. So the total cost of the product is 20 rupees. Are you clear with this? Now let us say every bottle of Pepsi is being sold in the market at 40 rupees. So now you tell me, guys, what will be the profit reported by each of the two departments? Now here division A, anyways, they will be getting 5 rupees from division B minus whatever is the cost of 5 rupees. The profit reported will be 0. Whereas division B, what happened? They incurred their own cost of 15 rupees, plus they would have paid 5 rupees, whatever is the cost pertaining to the empty bottle, to division A. So 20 rupees the cost, 40 rupees the selling price, 40 minus 20, 20 rupees would have been reported by division B. Now you tell me, division A reports a profit of 0, division B reports a profit of 20. Clearly, division A manager will never be motivated. Clear with this? Why? Because every time division B only takes the credit for whatever is the profit being earned by the company. Now I am not given any credit. Why should I be motivated to perform better? Are you clear with this, guys? Now, why is there a basic problem here? Because division A is a cost center. Now what they are saying, transfer pricing comes into picture. They are saying, don't worry, Mr. Division A, let us introduce transfer price. Now what do you mean by a transfer pricing technique? Now, in this case, whatever is the intermediate product, always remember transfer pricing is pertaining to intermediate product only. Now, you don't transfer it to division B at 5 rupees, you transfer to division B at slightly above 5 rupees. Let us say, example, the empty bottles are transferred at 8 rupees. Are you clear with this, guys? So the price that is being fixed for the transfer of intermediate product is called as the transfer price. Now this is not a selling price. Why? B is selling to outside market, so that is called as a selling price. Here I'm not selling anything. From one hand I'm giving to another hand. Are you clear with this? So this, I don't call it as a selling price, I will just call it as a transfer price instead. Are you clear with this, guys? Are you clear with this? So now first understand the whole process and then I will consolidate. Now let us say B, division A, transfers the intermediate product, that is the empty bottle, to division B at 8 rupees. Clear with this, guys? Now in this scenario, what will happen? Division A is getting a revenue of 8 rupees, right? Who pays them? B only pays them, correct? Minus its own cost is 5 rupees. So they are now reporting a profit of 3 rupees. Are you clear with this? Right? Next, division B, they are selling the external market, generating a selling price or revenue of 40 rupees. Minus they had incurred their own cost of 15 rupees, that is for manufacturing the the carbonated water, the Pepsi, plus now they are incurring, look at this as two different organizations standalone, right? Now in that case, they are now, division B now has to pay 8 rupees for every empty bottle. From their viewpoint, that is a cost. Are you clear with this? I'm not talking about the company as a whole. I'm just saying, look at it standalone. From division A's perspective, it reports a profit of 3 rupees. Now from division B's perspective, it generates 40 rupees, right? For every bottle of Pepsi sold. The cost is what? 15 rupees for manufacturing the Pepsi, plus 8 rupees was paid to division A for purchasing the empty bottles. Their cost was how much? 23 rupees. Overall, now division B reports a profit of how much? 17 rupees. Are you clear with this, guys? Are you clear with this? Division A reports a profit of 3 rupees. Division B reports a profit of 17 rupees. Now forget division A, division B. Now zoom out a bit. Look at this from the viewpoint of the company, head office, Pepsi as a whole. Now from the viewpoint of the company, you tell me, guys, what is it? Their selling price is how much? 40 rupees. Revenue per unit is 40. What is the total cost that they incur? Now forget all this transfer price and all. What happens here? They incur 5 rupees in division A, 15 rupees in division B. This is from the viewpoint of the daddy, the company, the head office. Clear with this? So the total cost is how much? 5 plus 15, 20. Overall profit is how much? 20 rupees. Are you clear with this? Sir, what are you trying to say here? Now guys, first, what happened? From the viewpoint of the company, actually what was the profit made? 20 rupees. Clear? Yes, that is logically the profit made. So Forget all division A, division B. From the viewpoint of company, all these things are internal only. They get a selling price of 40 rupees, right? 5 rupees plus 15, 20 rupees their cost. They generate a profit of 20 rupees. Before introduction of transfer price, the entire 20 rupees of profit, the credit for the entire profit of profit generation of 20 rupees was taken by whom? Was taken by division B. Are you clear with this? Now what happened? After introduction of transfer price, my overall profit did not change. My overall profit continued to be 20 rupees. But look at the beauty here. Now out of this 3 rupees credit, to the extent of 3 rupees I am saying, it was generated by division A, and to the extent of 17 rupees it was generated by division B. So now basically what am I doing? Overall profit did not change. However, the division wise profit has now changed. Now this will motivate all the divisions to perform better. Instead of just motivating one division to perform better, now all the divisions will be motivated to perform well. Only then the entire organization can grow. Are you clear with this, guys? Are you clear with this? That is the whole concept of transfer pricing here. Now, one very important thing that you need to know here is the presence of transfer price will never affect your overall profitability. Generally, it will not affect your overall profitability. Are you clear with this? Exceptions are there. That's in a very advanced level, right? So now your transfer price will not affect your overall profitability in general. However, it affects only your division wise profitability. Sir, why will it not affect my overall profitability? Very simple. Now, in this case, the transfer price was 8 rupees, right? Now, the transfer price is always a revenue to the supplying division, correct? And it is a cost to the receiving division. So, if you consolidate overall, one division's revenue gets knocked off with the other division's cost. Whether you keep this transfer price as 8 rupees or 10 rupees or 20 rupees or whatever it is, now it is revenue on one side, cost on the other side. When I'm calculating the profit of the company as a whole, it eventually gets knocked off. Are you clear with this, guys? Then why do we need this, sir? It is artificially created in order to promote a healthy competition between different divisions of a company. Now this way it helps achieve first, number one, control, because right now all of them will automatically be motivated to perform well. It's easier for me to exercise control over them. I need not push them to do things because now they all know that their performance is getting fairly evaluated. Are you clear with this, guys? Are you clear with this, guys? This is one very, very important understanding that you need to know. So here I have just made a few observations regarding the overall concept of transfer pricing. So basically, the supplying division is a cost center. However, to promote the interdivisional competition and to improve the efficiency and control, companies may treat the supplying divisions as a profit center. Are you clear with this? The transfer of intermediate product will be deemed to be the sale. It's not actual, deemed to be the sales of the supplying division, and the transfer is made at a price higher than the cost and hence is called as the transfer price. Clear with this? The transfer price is a selling price, not exactly, but it's deemed to be a selling price to the supplying division, and it is a purchase cost to the receiving division, and is neither a selling price nor a purchase cost for the company as a whole. Why? It gets knocked off. Are you clear with this, guys? Yes. Thus, transfer price will affect divisional profit, but will not affect the company's profit generally. Clear with this, guys? And note one more very important thing. For this transfer price to work, this can work only in a decentralized form of organization. What do you mean by a decentralized form of organization? Centralized form of organization means all the decisions are taken only by the head office centrally. Decentralized organization, decentralized form of organization means what? The decision making is delegated to each of the respective units or each of the respective divisions and departments inside of an organization. Are you clear with this? Only if you do that, this particular concept of transfer pricing will work properly. Or in other words, sir, how do I fix this transfer price? In this case, you said this transfer price is 8 rupees. How is it fixed? For fixing this transfer price, the head office, the daddy should not come inside and interfere. The kids should automatically discuss within themselves and fix a fair transfer price. Are you clear with this, guys? If the daddy interferes, if the head office interferes in this case, now it will lose the entire objective here. Clear with this, guys? Then the overall competition that is getting created inside the organization will not be fair. Are you clear with this? So you need to create a proper environment in such a way that the transfer price that gets fixed is fairly accepted by both the parties. Are you clear with this, guys? Right? So first, this is overall the concept of transfer pricing. This, if you're understanding the base of transfer pricing, now you will be able to crack as many sums as possible. Of course, there are certain other aspects involved. Now, guys, first, this is the overall introduction or the big picture of this particular chapter called as transfer pricing. Now, remember one thing, at CA Intermediate, we are here doing a CMA revision, right, for your upcoming CMA exams. It's at CA Inter also, this concept of transfer pricing chapter is not there. Transfer pricing is there only in CA final level, right? However, in CMA course, since CMA course, the focus is on cost and management accounting, they have introduced this chapter called as transfer pricing at the intermediate level itself, right? However, understand one thing, the concept of transfer pricing is very advanced only in your final CMA final level. At the intermediate level, it is fairly simple and only the basic levels are there. Are you clear with this? Now, these ideas, these things will help you score really well, be it in your MCQs or in your theory or in some basic practical numerical problem. Are you clear with this, guys? Now, coming to the next question. Sir, how do I fix this transfer price of 8 rupees? In this case, 8 is an example. It's not always 8, right? Now, there are multiple methods of fixing transfer prices. Broadly speaking, cost-based transfer pricing is there. Market-based transfer pricing is there. Negotiated transfer pricing is there. Cost-based transfer pricing, right? So there are 4 different categories under cost-based transfer pricing. One is called as the marginal cost. The other one is called as the absorption cost. Then you have standard cost, and then you have 2-part tariff. Now, what is this? What is this? Now, guys, cost-based transfer pricing. Number 1, you have what? Variable cost. That is, if you take the variable cost and fix that as the transfer price, right, it is called as basically your marginal cost based transfer pricing. Now, why would someone do that? Again, if you do this, which companies basically follow cost based transfer pricing? Those companies which feel that, it is not necessary for me to convert a cost center into a profit center to exercise control. If a company feels that, look, I don't want to convert a cost center into profit center and exercise control. Without that itself, I can do. Just whenever I am transferring, I will transfer it at cost. If that is the company's mindset, they can follow cost-based transfer pricing. Clear with this, guys? All these methods have its own advantages and limitations. So first, let us understand the different methods of transfer pricing. The first one is called as marginal cost method, which is basically the transfer price is equal to the variable cost of the supplying department. Clear with this? The second method is called as absorption cost method. Absorption cost method is nothing but the actual full manufacturing cost. That is not just your variable cost, but even your fixed production overheads will be added. Full manufacturing cost. But remember, you are going to take the actual figures here. Now comes the third method called as standard cost method. Here also, the transfer price will be the full manufacturing cost of the intermediate product. But remember, it is not the actual, it is the standard price. It is a standard full manufacturing cost. That is the only difference between the standard cost method and the absorption cost method. Are you clear with this, guys? Right? Here in absorption cost method, I take the actual full manufacturing cost. Standard cost method takes only the standard full manufacturing cost. And there is something called as 2-part tariff. So what do you mean by a 2-part tariff? Now let me just give you an overview here. 2-part tariff is nothing but, so it's a combination. That is, you charge them the marginal cost plus you charge them some annual fixed fee. Every year you need to actually, the receiving division needs to pay the supplying division some fixed amount of money. This is actually called as what? This is actually called as 2-part tariff. Are you clear with these? Are all methods, different methods of your transfer pricing. Then comes your market based transfer pricing. Fairly simple. Market based transfer pricing. What do you mean by that? Now let us not break our head in fixing the transfer price. Now suppose let us say we are basically, transfer pricing is something that we need to fix only for the intermediate product, in this case the empty bottle. Let us say the empty bottle is being sold in the market at 6 rupees, example. Now take that market price of the intermediate product and fix it as what? Our transfer price. If you use the market price as the base for fixing your transfer price, then it's called as market based transfer pricing. Are you clear with this, guys? Right? And then there is last one more method called as negotiated transfer pricing. Negotiated transfer pricing means what? Which are the two parties involved here? The supplying division and the receiving divisions. Now these two parties will sit together, they will negotiate the price and they will arrive at a transfer price. Are you clear with this? This manner of arriving at transfer price is known as negotiated transfer pricing. Clear with this, guys? Now do not worry, I will come up with an example for this negotiated transfer pricing. A very beautiful example is that I'll come up with it right now. Generally remember, guys, this is what is given in our institute study material. There are certain rules for transfer pricing. Rules for transfer pricing, basically you can take this as your the minimum and the maximum, the range in which the transfer price should generally lie. Okay, so these are the rules for transfer pricing. What are they? The limits within which the transfer prices should fall are as follows. The minimum amount should be the sum of the supplying divisions marginal cost and opportunity cost of the item transferred. The maximum should be the lowest market price at which the receiving division could purchase the goods and services externally less any internal cost. Now, what is this? Let me just give you an example. A very beautiful example is there. Now, look at this. Division X produces a product called L, right, at a marginal cost per unit of 100 rupees. If a unit is transferred internally to division Y, 25 rupees of contribution is foregone on an external sale, right? The item can be purchased externally for 150 rupees. Now, let me just put it here. Now, what are they saying? They have two divisions, division X, division Y. Clear with this, guys? Now, what are they saying here? Now, they produce a product called as product L, which is the intermediate product. The marginal cost, the variable cost per unit is going to be how much? 100 rupees. Fine. So, the cost for manufacturing this particular product L is going to be 100 rupees. That is the cost, right? Let's say variable cost. Now, what they are saying, if a unit is transferred internally to division Y, 25 rupees contribution is foregone on an external sale. Now, what they are saying, this empty bottle, right, the product L, intermediate product, division X is actually capable of directly selling it in the outside market. Are you clear with this? In this scenario, they are saying that this division X, they can sell it in the outside market. If they sell, what they are saying, instead of selling in the outside market, if they transfer it internally to the division Y, they will be losing out on a contribution of 25 rupees. Or in other words, every time they sell it to the external market, they are able to generate a contribution of how much? 25 rupees. Are you clear with this? Which means how much would have been the selling price? Variable cost 100 plus the contribution. So that gives you the selling price. So, or in other words, can I say the selling price if sold externally by division X would be how much? It would be 125 rupees. So, if this intermediate product is being sold directly in the external market, every unit sold, division X would be getting a selling price of 125, right? Minus variable cost of 100. So, generally, they will be making a contribution of how much? 25 rupees. That is what they are saying here. Instead of selling it outside, if I transfer it to you, I will be losing out on a contribution of 25. Are you clear with this? Similarly, what happened? Division Y is there. They have given in the question, the item can be purchased externally. Just a minute. They are saying the item can be purchased externally. 1 second. Yeah. So they are saying that the item can be purchased externally for 150 rupees. The item can be purchased externally for 150 rupees. So what they are saying, division Y, they also have access to the external market, right? If division Y purchases from external market, they are saying they can purchase it at rupees 150. Are you clear? This is a situation given in the question. Now tell me guys, now tell me, how would the negotiation go on? This is typically an example of negotiated selling price, which is ideally the way every company should follow. This is how every company should follow. What they will do is division X, what they will say. Now, if I sell it in the external market, I will be getting how much? Division X. It will be getting 125 rupees for sure. So division X will say minimum I need 125, else I will not be motivated to transfer the goods to you. Are you clear with this? Right? Because now this is a case of a decentralized environment, decentralized organization. So each and every organization should be given the power to actually fix the transfer price and decide whether or not to transfer. Are you clear with this? Now in this case, division X will demand a minimum selling price, a minimum price of how much? 125. So division X will say nothing doing, minimum I am going to expect 125. If you are paying me less than 125, I will not even transfer to you, I will sell it in the external market. This is what division Y will say. What will division X will say? Sorry, what will division Y say? Externally, they are able to purchase it at 150 rupees, correct? So the maximum that they are willing to pay is how much? The maximum division Y is willing to pay is how much? 150. Suppose division X demands a transfer price more than 150, division Y will not be ready because they have an external market where they can just purchase it at 150 rupees. Are you clear with this, guys? Are you clear with this? Now this is going to be your typical range within which your negotiation will happen. This is going to be your typical range within which your negotiation will happen. So ideally speaking, your transfer price should be greater than 125, less than 150 rupees. Always remember, division X will be wanting more transfer price because it's a revenue for them. Division Y will be demanding for a lesser transfer price. Reason? Because for them it is a cost. Are you clear with this? So now clearly less than 125 rupees, division X will not accept. More than 150 rupees, division Y will not accept. The only range within which it is acceptable for both the parties is going to be this 125 rupees to 150 rupees. So within this, the range negotiation will happen. Maybe it depends on, now what happens is, it is a pure internal competition. Now it depends on the bargaining power of the two managers. Now based on this, maybe they will fix a transfer price of, let us say, 135 rupees or 130 rupees, depending on the negotiation skills of the manager. Now independently, it depends on the capability of each and every manager. Are you clear with this? Why? Because they need to maximize that division's profit. Are you clear with this? Sir, why will the HO not be bothered about this? Irrespective of the transfer price that you fix, it will not affect my company's overall profitability. This is just an artificial price created, right? One man's food is another man's poison. There is a saying. So one division's revenue is another division's cost. It just gets knocked off. Are you clear with this? From a company's viewpoint, it is not even a problem. Are you clear with this, guys? Right? So in this case, what happens? This is how the range fixation happens, and they arrive at it. Are you clear with this? This is ideally the right method. But there are so many other methods. As I told you, cost-based methods, your market price-based methods, and the other one is your negotiated transfer pricing. Are you clear with this, guys? Now you read this, you will understand, right? So the minimum transfer price should be the sum of the supplying division's marginal cost plus opportunity cost. Means what? Here, the minimum amount 125, how did I arrive? Marginal cost 100 plus every time I am transferring into division Y, instead of selling it externally, I am losing out on a contribution of 25 rupees. Add that also. So variable cost plus your opportunity cost of your contribution foregone is nothing but the external market selling price of 125 rupees in this case. Are you clear with this, guys? Right? So that's what they are saying. The minimum price should be the variable cost plus the opportunity cost of contribution foregone. Are you clear with this? That is what is being mentioned here. Look at this. That's what has been mentioned here. Marginal cost plus opportunity cost of the item transferred, right? And the maximum will be the lowest market price at which receiving division Y could purchase the goods externally. Are you clear with this? This is actually externally. Clear with this, guys? Could purchase externally less any internal cost. If they are having any internal savings and all, you just need to remove that. Are you clear with this, guys? This is the big picture of this particular chapter. Clear with this? Clear with this? So now this particular range fixation happens within this period, and depending on who is performing well, their particular respective divisional profits will increase or decrease. However, overall company's profitability will not generally be affected. Are you clear with this, guys? Right? Apart from that, there are so many other small allied areas here in case of transfer pricing, but this is the big picture of this entire chapter. Clear with this, guys? Now let us do one numerical problem in this particular segment, in this particular chapter. Now let me just quickly walk you through one numerical problem. Just a minute. Now guys, let us take up one variety of a problem, right? So right now we have discussed the concept of the transfer pricing, the entire concept of transfer pricing. Then we have seen the different methods of transfer pricing as well, right? Now let us do one different variety of a numerical problem. Now look at this. BC company fixes the interdivisional transfer prices for its products on the basis of cost plus a return on investment in the division. The budget for division for alpha for the year 21-22 appears as under. Now what they have said, so a particular division's investment or the details are given below. Fixed asset 5 lakh, current asset 3 lakh, debtors is 2 lakh. So ideally speaking, this is other current assets. This is other current assets. That's how you need to understand, right? This is as such in the institute study materials. That's why I didn't change it, right? But while explaining, I'm just giving you this. It is other current assets, basically meaning what? Other than your debtors, right? 3 lakh, then debtors is 2 lakh. The annual fixed cost of the division is 8 lakh. The variable cost per unit of the product is 10. The budgeted volume is 4 lakh units per year. Now they are expecting a desired return on investment is 28% on 10 lakh. So what is this 10 lakh? 10 lakh is the amount of the total assets invested in this particular division. How did you get 10 lakh? Sum total of these three. 5 plus 3 plus 2. That is a total asset in value investment, the total gross investment in this particular division. Clear with this, guys? That is what they have mentioned here. So now they want a total desired return of how much? 28%. They are asking you Alpha Limited, what should be the transfer price for every unit being transferred by Alpha Limited? Now guys, fine. So what is the desired profit you want? 2,80,000, correct? That is 10 lakhs into 0.28, correct? You are looking for a desired profit of how much? 2,80,000. So you want to earn a return of 2,80,000, right? Now you tell me how many units are going to be transferred? 4 lakh units. So what is going to be the total variable cost for 4 lakh units? 4 lakh into 10. It's going to be how much? One second. The budgeted volume, yes. It's going to be how much? It's going to be 40 lakhs, correct? This is going to be the total variable cost. Plus what is the fixed cost that you will be incurring? They have given it as 8 lakhs, correct? Now over and above this, the particular division is expecting for a profit of how much? 2,80,000. So the required profit is how much? The required profit is going to be 2,80,000 rupees. Are you clear with this? So totally, what is the revenue that needs to be generated by Alpha division? 40 lakhs plus 80 lakhs plus 2.8 lakhs. So how much is this? 50,80,000. Are you clear with this? 50,80,000 is the revenue that they are planning to generate by selling how many units? Not selling typically, transferring how many units? Divided by 4 lakh. So basically 50,80,000 divided by 4 lakh units gives you how much? Per unit they should be charging a transfer price of 12.7 rupees. Okay, so this is what they have also got, but they've unitized everything. So what they have said is, if the company wants to earn a return on investment at the rate of 12%, 28%, how much should be the transfer price they should be charging? Sir, it is a division, sir. That's why I said in this case, you create an internal competition between divisions, between departments. Are you clear with this? So treat this as two separate entities and let them compete. That is the beauty of a decentralized organization. Clear with this, guys? Right now, if you do this, one of the methods of your transfer pricing fixation, right? There are many various other methods. Broadly, we saw as per the study material, they had given the three methods: cost, market, and the negotiated transfer pricing. Here, if you see, it is a cost plus a return method. Are you clear with this? Here, the return is nothing but a return on the investment made in the decision, in the division. So they have arrived at it. So total variable cost plus fixed cost plus the desired profit, you take that divided by the number of units, or alternatively also you can do it, unitize everything. The variable cost per unit is 10. Fixed cost per unit, unitize it. 8 lakhs divided by 4 lakh, that gives you how much? 2 rupees. Then what is the profit desired per unit? You know that you need to make a profit of 2,80,000. So per unit, what should be the profit? 2,80,000 divided by 4 lakh, 0.7. Add up everything, you will get the required transfer price of 12.7 rupees. Are you clear with this, guys? This is another way of fixing the transfer price. Are you clear with this, guys? So that is about, you know, the overall big picture of this particular chapter, right? Of course, in our regular batch, we have seen so many different varieties of problem, but more or less, this is the baseline on which every single problem was incremented. Of course, there were certain issues as well that we have seen, right? Between multiple divisions, the goal congruence and all that. But the base of this particular chapter, the time when you are revising, these are certain things that need to be at the top of your mind, and that is what this chapter is about. Now, guys, this chapter is at the CMA level, final level as well. The depth of this chapter is very, very advanced in final level. At the intermediate level, only basic level questions are generally asked. Clear with this, guys? So that is about this entire revision of the chapter transfer pricing. So now let us move on to the next chapter.